Yes, hello guys. Please first confirm if my screen is visible and my voice is audible. Please confirm in the chat. Yes, good morning everyone. A very good morning. Everybody please confirm if you guys are able to see the screen and hear my voice. Okay, great. Great. Yeah. Let's start today's session. Today, we are going to discuss VRM chapters. In fact, our agenda today is VRM 1 to VRM 8. That is, we'll cover market risk, VRM 1, 2, 3. Then we'll go towards credit ratings, external, internal credit ratings, country risk, and then two models for operational risk and credit risk that we will discuss. And finally, we'll conclude our discussion with stress testing. Okay. So without wasting any time, let's start the session. So first chapter in our agenda today is measures of financial risk. That is VRM 1, book 4, chapter 1. Okay. So measures of financial risk, like if I talk about financial risk here, they actually mean market risk. Okay. So banks, treasury departments of various financial institutions, they are all involved in trading activities. So it means they are exposed most of the time. The most important risk that any financial institution is exposed to is market risk. And they need to know what all are the measures that can be used to manage this risk, to reduce the severity of this risk, so that when the time of crisis kicks in, they are fully prepared. If not fully, I would say they are prepared to an extent that they can manage their day-to-day operations and the company can keep running. Okay. Now, if I talk about the measures of financial risk, there is one measure that you guys have already studied. In fact, we are all aware of it in one way or another, but maybe we do not realize it. And the most important one, in fact, other risk measures are all built upon this risk measure only, and that is standard deviation or volatility. Okay, so one measure of volatility is a standard deviation. We all know that. And the standard deviation can be used as a measure of financial risk. And we have seen it in the previous chapters of FRM and all. If you guys have studied, you are aware that standard deviation can also help us get an idea about the riskiness of an asset. So if the standard deviation is high, we say that the asset is more risky compared to than an asset which has a lower standard deviation. But the problem with this standard deviation is that we cannot say as to what will be the loss in a very extreme scenario. I cannot quantify that just by looking at the standard deviation. That becomes really difficult. So people realized that, okay, we need to develop certain risk measures which can be quantified and which can actually give us some idea as to what possibly will be the loss in a or let's say on a majority of scenarios, if not all the scenarios. In fact, predicting what will the loss in all the scenarios is very difficult. In fact, it's next to impossible, because the loss can be anything in that case. Okay. But on majority of the scenarios, what will be the maximum loss that I can incur by investing in certain asset or by keeping a certain portfolio? That was something of a pressing question at the time. And in the 1990s, early 1990s, JP Morgan CEO was there. I am not able to recall his name precisely right now, but what he did, he asked his employees, his subordinates, that I want to know what is the daily loss. Every evening 4 p.m. I want to have that daily loss data, that what we are losing every day. Okay. And then what they did, they compiled all the data, did a lot of research, and they gave out the concept of VAR. Of course, the mathematics, the statistics was existing, but it was not fully applied in the field of finance. And that was the first time, I would say, when VAR was used as a risk measure for the first time. Okay, and then we saw it, like the Basel regulations that came after that, it incorporated value at risk for finding out, for identifying the, I would say, market risk capital. Okay. And then we have finally, during the time of great financial crisis, then we saw yet another problem with VAR. It was a good measure, I would say. In fact, today also banks use VAR, value at risk, as a risk measure for market risk. But the problem with VAR was highlighted during the time of great financial crisis. That is the crisis of 2007 and 9. Okay. At that point of time, when I'd just take a simple example of Lehman Brothers. We all know it was one of the biggest bankruptcy in the US economy, or I would say at that point of time. Okay. So at the time of bankruptcy, you would be surprised to be and to know that at the time of even the bankruptcy, the Lehman Brothers was fulfilling all the Basel norms, the then prevalent Basel norms. It had the sufficient, all the risk capital like VAR and everything was in place, but still the bank went bankrupt. Okay, so people realized the limitation, and the limitation was that we don't know if the VAR is breached. Okay, so what tells us, gives us some idea as to what will be the loss that won't be exceeded, let's say 95% of the time or 99% of the time, but it gives us no information about the fact that if the VAR is breached, given that VAR has crossed, then how severe this loss can be. It can be anything. Okay, and that was the problem with VAR. So Lehman Brothers was satisfying its VAR criteria. Okay, it had the market risk capital as calculated by the value at risk, but the problem was during the crisis, the loss went so severe for the Lehman Brothers that VAR was simply not enough. Okay, and people realized, the regulators, the big economists, all of them realized that, okay, VAR is not enough. We need something more. Okay, then what kicked in? Expected shortfall kicked in. Okay, expected shortfall actually tells us what will be the loss, average loss, given that VAR has been breached. Okay, or VAR has been crossed. Okay, so let's say there is a day on which you are making a loss that is greater than VAR. Okay, so how severe this loss can be is actually what expected shortfall tries to measure. Okay, and expected shortfall is an improvement on VAR. And I would not say that expected shortfall is the only measure that can help us better estimate the market risk. There are other measures also. But yeah, our discussion is focused mainly on these two things. Standard deviation, we already know it, what it is. In today's discussion, we'll focus on value at risk and the expected shortfall. Okay, so let's start our chapter with this premise that we have done. So if we talk about risk measures, there are three types. First is standard deviation, second is value at risk, and third is expected shortfall. Okay, VAR is widely used in practice because of its sheer simplicity. And expected shortfall has more theoretical characteristics. Okay, more desirable properties that a risk measure should have. In fact, we know that there are 4 properties of a coherent risk measure. That means a good risk measure. And expected shortfall satisfies all the 4 criteria, all the 4 properties, but VAR satisfies only 3. Okay, so VAR is not a coherent risk measure. Now, let's move forward. So first we'll understand the mean variance frameworks. Of course, we have to, if we are starting with the discussion on market risk, we will start with the most basic thing, that is the standard deviation. And in fact, let me tell you one thing, be it the calculation of VAR or the calculation of expected shortfall, it all depends on properly estimating the value of volatility. Volatility of returns on the portfolio, on the asset, whatever is under consideration. Okay, the volatility estimation, proper good estimation of volatility is really important. Okay, so first thing that we need to understand here is the mean variance framework, which tells us that there is a trade-off between risk and return. The greater the risks are taken, the greater the expected return can be achieved. Okay, and it is true only for the efficient frontier. We all know what efficient frontier is, and I'll give you a brief overview of efficient frontier here also. Okay, so one measure of risk is standard deviation. And if we talk about the risk-free asset, it has 0 standard deviation. And that is why we say that risk-free assets are virtually risk-free, or are virtually, they don't have any risk. They don't pose any kind of risk. Okay. However, in practice, if you will see, it is not exactly true. In theory, we say that, okay, risk-free asset means 0 risk, no standard deviation. Okay, 0 risk, simply 0 risk. But in reality, we know that federal rates can change, which can lead to changes in the return earned on the risk-free assets also. So there is a volatility involved there, but this volatility is comparatively low. However, from the point of view of discussion, we can assume that when we are talking about a risk-free asset, virtually its risk is 0. And that is one of the most important underlying assumptions of the mean variance framework. Okay, because when we build the efficient frontier, when we combine the market portfolio with the risk-free asset to build the efficient frontier line, it is always assume that the standard deviation of the risk-free asset is 0 on paper. Okay. Now, combining investments. So you see, when we are making an investment, one way to reduce the risk, in fact, idiosyncratic risk that we know, okay, that is firm specific risk or a specific risk in general, you can tell that, you can say that. So when we invest in a single asset, we are exposed to whatever happens in that company. So we want to diversify the risk that we are exposed to. One way of doing it is investing in multiple assets. So what you are doing, you are creating a portfolio which is a combination of investments. And how do we combine it? Let's say we have 2 assets, asset 1 and asset 2. Mean return of asset 1 and asset 2 is mu1 and mu2, and the standard deviation is sigma 1, sigma 2. Weights of the asset, of course, you will be allocating certain money. So let's say you have $100 and you're investing $60 in asset 1 and $40 in asset 2. So naturally, the weights of each asset becomes 60% in asset 1 and 40% in asset 2. Okay, so W1, W2, where W2 is nothing but 1 minus W1. That's the weight. Now, in this way, the portfolio return, that means if I want to find out what is the return that I'll earn on this portfolio, that is on the combination of these two assets in simple terms, is given by this formula, that is mu p equals to mu1 w1 plus mu2 w2. And the standard deviation is given by this formula. In standard deviation, we do take into consideration the correlation between the assets. Okay, if the correlation, now here there is a catch that I would like to explain. Okay, in the case of portfolio volatility, portfolio standard deviation, that is, correlation is really important, or in other words, you can say the covariance. Okay, so if the correlation or covariance is positive, then you would see that this sigma p is sigma p can be, if it is positive, okay, sigma p is given as or variance of is given as I would say sigma 1 square, sigma 1 plus sigma 2. Okay, roughly W1 sigma 1 plus W2 sigma 2, that will be it. If it is negative, then the volatility of the portfolio is W1 sigma 1 minus W2 sigma 2. And it's really simple to understand. If you will look at the formula, it's if it is a plus sign, for example, here we have a plus sign, right? So because, and let's say the correlation is positive. So this symbol will be retained. That means this plus sign will stay positive because my correlation is positive. Okay. Now the thing is, this term can be considered a square, this term can be considered b square, and this whole thing can be considered in a way, if the correlation is 1, let's say positive 1, in a way it can be considered as 2ab. Okay, so that transforms into sigma 1 plus sigma 2. Okay, if you will solve it, it will be sigma w1 sigma 1 plus w2 sigma 2 whole square, and the square root of that will be w1 sigma 1 plus w2 sigma 2 if the correlation is 1. If the correlation is exactly -1, then it will become w1 sigma 1 minus w2 sigma 2. It is simple mathematics. The quadratic identities that we have studied in our high school, we can apply that and we'll be getting that result. Okay, and if it is 0, it is w1 sigma 1 square plus w1 sigma 2 square root. Okay, so always remember one thing, there is a relationship that the more the negative the correlation is, the lesser the volatility of the portfolio will be. So if let's say asset 1 and asset 2 have negative correlation, then the risk on the portfolio will be less than the risk on either of the assets. Okay, or you can say will be lower than the lowest of the risk of individual assets. So let's say sigma 1 is 10% and sigma 2 is 12%, and let's say they have a negative correlation between them. So the net risk will be less than sigma 1 also, less than 10%. Okay, so if you want to reduce the risk to a larger extent, you can select, you can choose to go for assets with negative correlation. And if you have assets with positive correlation, then the mean variance framework kicks in and we have to look into that. Okay, so first thing, now in the scenario that we took earlier, it was basically a 2-asset portfolio. We had 2 assets. Can that be extrapolated? Yes, of course, it can be extrapolated to n number of assets, and the formula just gets modified. So mu p becomes summation of wi mu I. It's just a shorthand representation of the fact that I'm writing w1 mu1 plus w2 mu2 plus w3 mu t up to wn mu n. Okay, it's the shorthand representation. And if we talk about standard deviation of the portfolio, then it is given by double summation of rho ij, wi, wj, sigma I, sigma j. Now, this formula might look a little bit complex, that how do we expand this summation? Okay, but it's really easy. I'll tell you, it's really simple to expand this summation, and you can do it like, let's say we have a 3-asset portfolio. So how will this transform into? It will transform into w1 sigma 1 square plus w2 sigma 2 square plus w3 sigma 3 square. That's for sure that it will come in. Okay, then if you have a 3-asset portfolio, how many correlation measures you will have? You will have 3 correlation measures. Correlation between w1, w2, or you can say asset 1, asset 2, correlation between asset 2, asset 3, and correlation between asset 1 and asset 3. So there will be 3 terms related to correlation in the formula of volatility. That will be 2 times rho 1 2, w1 w2, sigma 1 sigma 2. That's for the first correlation you are capturing. Then second correlation, 2 times rho 2 3, w2 w3, sigma 2 sigma 3. And for the third one, 2 times rho 1 3, w1 w3, sigma 1 sigma 3. That will be the expansion. Okay, so the more assets you have, the more covariance terms will be included in the formula for calculating the variance or volatility of the portfolio. Okay. Now, let's talk about the efficient frontier. So once we have understood that how we combine the investments, okay, it is really important to understand the efficient frontier. Okay, so the theory says that if you take into if you take the combination of all the risky investments that are there in the market, you build the efficient frontier of risky asset. And efficient frontier looks something like this. Okay, this line that you are seeing is your efficient frontier. Okay, now in this line, all the assets are considered to provide optimal performance. Okay, this curved line I'm talking about. Okay, this curved line is your efficient frontier. Now, sometimes what we do, if let's say, and let me tell you one thing here, that if you have the combination of assets of all the risky assets, then this line gives you the relationship: the higher the return, the higher the risk, the higher the return. Okay. Now you have considered all of them. Now you still want to earn more return. Okay, still you want to earn a little bit more return. So on the efficient frontier, where you have considered all the assets, you can't have more return beyond that. Okay, so you can't earn a return of, let's say, something which is here. Okay, you can't earn a return on which is this high. Okay, with a risk of this much. Okay, at a given risk, if you want to earn this return, then you'll have to assume a higher risk if you are on the curved efficient frontier line. So one way out that the economists found was that if we combine the market portfolio with the risk-free asset and create a new portfolio. So what you are doing, you are taking the market portfolio, okay, and let's say you have 100 rupees. Okay, so market portfolio comprises of three assets, two assets, for example, for the sake of simplicity, let's say it comprises of two assets. So you took the two asset portfolio, it has certain weights, let's say 30%, 70%. Okay, and you have 100 rupees. So what you are doing, you are not investing all your money in market portfolio. You are investing 70% of your money in market portfolio. Now this 70% of your money, so if you had $100, $70 is invested in market portfolio. Again, in the proportion, which is the weights of assets in that portfolio. That is, let's say 70-30. So 30% of 70, that is 21 and 49. Okay, and the rest $30 that you have is invested in the risk-free asset. Okay, by doing so, we are actually we can actually increase the efficient frontier to a new line which appears as a straight line. Okay, now I know you guys have already studied these things and it's a kind of revision for you, but still, can anyone tell me that till this point, till the point I was considering all the risky assets only, okay, I was getting a curved line, right? This is the curved line that I'm getting, this line. But the moment I combine the market portfolio with the risk-free asset, I get a straight line as the new efficient frontier. What is the reason for this? Why we get a straight line? Can anyone tell me? Intercept. Not satisfied, Divesh, I would say.
Weights are actually, total weight is 100%. So it will be usually straight line.
Weight has to be 100%. Yeah, there is no doubt. But in this case also, in the market portfolio also, if I'm only considering the market portfolio, let's forget about the new efficient frontier line. Let's consider the curve, previous curve. Okay, where I had all the risky assets. There also the sum of weight was 100 now, but why was not getting a straight line there? Okay, it's a very simple thing, but sometimes people don't understand that why it is happening. And Divesh, let me tell you, interest is not always positive. Sometimes federal rates can go negative also. However, it's a thing of practice, of course, but that's not the case. Even if it's an intercept, I still could have a line which looks like this. Let's say like this. Why don't I have like this? Why I have a straight line? Any ideas?
Changes in the risk of market portfolio is balanced by risk-free asset. That is the reason.
Not satisfied, and I'm not sure that will be the answer also. Okay, so let me tell you, we won't waste a lot of time on this. Okay, so let me tell you straight away, it's because of the standard deviation. Okay, so let me tell you why. When I was considering the old efficient frontier, so all the assets were risky assets. That means all of them had their own riskiness associated, their own standard deviation. And we know that standard deviation of the portfolio is a non-linear function of the standard deviation of individual assets. And if I just try to show you what we have here on the X and Y axis, so on the X axis, we have the standard deviation, right? And on the Y axis, we have the expected return. So there has to be a non-linear relationship between the expected return and the standard deviation. But when it comes to the new efficient frontier line, that is basically the combination of market portfolio and the risk-free asset, the risk is introduced only because of one factor, that is market. Market portfolio. Only market portfolio is contributing towards the risk, because by assumption of the mean variance framework, we know that risk-free asset has zero risk. That means zero standard deviation. And that's the reason that when we are trying to plot the risk and return, or you can say the risk reward relationship, okay, I get a straight line, because risk is only being contributed by one of the by one of the factors, that is market portfolio. Risk-free asset is not at all contributing towards the risk of the asset of the portfolio that I have created. Okay, of all the in fact of all the portfolios on the efficient frontier line, because risk-free assets are virtually risk-free, right? So there is no doubt that I'll be so the standard deviation is zero. I can easily take the standard deviation as zero, and the risk is contributed because of only one thing, that is the I would say that is the market portfolio. Okay, so I hope that's clear. Now let's get back to our discussion. So here what you can do is that by changing the weights, so what I said is that I got the new efficient frontier line, which is a combination of risk-free asset and market portfolio. Now I can change the weights of risk-free asset and market portfolio. So instead I can invest in market portfolio, let's say 10% of the money, and in risk-free asset 90%. I'll get a lower return. Okay, the return will be on this side because more investment is on the risk-free asset. So return will be less, risk will be less. Okay, the moment I keep on increasing the weight of market portfolio, my risk will increase, but at the same time, my return will also increase. And at this point, at point M, what I have is 100% investment in the risk-free, in the market portfolio, and zero investment in the risk-free asset. Okay, so that's the idea. Now, if we can assume that we are also able to borrow money at the risk-free rate. So borrowing means short position, you can consider the weight to be negative. Okay, the idea is sum of weight should be equal to 1. Okay, so if let's say the weight in market portfolio is 1.5 and the weight of risk-free asset is minus 0.5. So the sum of these two weights turns out to be 1. But what does this mean is that let's say I have $100. Okay, now what I do, I want to make an investment where the weight of market portfolio is 150% and I have borrowed money. So the extra 50% is borrowed from the market. And then all this 150, whatever I have, I invest it in the market portfolio. Okay, so that's how we do it. Okay, so if you want to go beyond point M, that is possible if and only if borrowing is allowed at the risk-free rate. So you can borrow money at the risk-free rate, you can combine it with your own capital and then invest all of it in the market portfolio. That will enable you to move on the right of the market portfolio, or right of the market portfolio point. Okay, now here the same thing has been explained basically. So on the for any point between RF and M, the weights are positive for both of them and less than 1 for both of them, but greater than 0. Okay, greater than equal to 0. So for example, this point, it's just hypothetically assumed that, okay, the weight in RFA, risk-free asset, is 50% and in market portfolio is 50%. Okay, on this side, if I talk about, that is on the right hand side of point M, their weight of the risk-free asset is less than 0. That means negative weight, which means I'm borrowing money. Okay, and weight of the market portfolio is greater than 1, which means I utilize all my own capital and the borrowed money, and everything is invested in the market portfolio. Okay, that is the I would say qualitative meaning of WM being greater than 1. Okay, now normal distribution, it is really important because a lot of things that we do, especially in finance, we assume that if not over longer horizons, but at least in the short time period, we assume that the distributions of return distributions are assumed to be normal distribution. Okay, it's a convenient choice. Okay, but the thing is, it has its own limitations. You see, normal distribution or bell curve is assumed to be mesokurtic, right? It means it acts as a benchmark for measuring the fatness of the tails, or in other words, how extreme outcomes are possible, how many extreme outcomes are possible. Okay, so here we have a table which shows that if I'm expecting a movement of greater than 1 standard deviation, so, and this is based on the S&P 500 index data, okay, daily returns data, okay, over last many years. So a movement greater than 1%, 1 standard deviation, actually it happened on 21.79% of the occasions, or you can say the probability that I'll have a return which is greater than 1 standard deviation. Okay, return which is greater than 1 standard deviation is 21.79, but as per normal distribution, it should be 31.73. Okay, now the Till this point, there is no problem. In fact, a movement of 1 standard deviation is not assumed to be too risky. But the moment it is 2 standard deviation, okay, things change. Normal distribution would say that only on 4.5% of the occasions, roughly, I would see a return or a value which is greater than 2 standard deviations. But in reality, it happened on more than 5% of the occasions. That is 0.5% more times it happened. Okay, and that's a bad news. And for three standard deviations, it happened on 1.65% of the occasions. But as per normal distribution, it should have happened only 0.27 per times of the occasions. Okay, and that's the problem here. Why? Because if I, let's say, build risk measures basing our assumption that the distribution is normally distributed, I may up making doing something disastrous. You see, be it value at risk that we'll see in the upcoming slides, or expected shortfall, these are calculated at certain confidence level. Let's say 95% or 99%. Let's say 99%. Okay, so that's roughly transpires into 2 standard deviation. Okay, now even a 1% probability change can lead to different values. Okay, so what is happening is that if I'm using normal distribution, then I am actually underestimating what possibly will happen. Okay, I am actually underestimating what possibly will happen. Okay, so that's the problem. And if you're underestimating the risk, it's a problem. Overestimating it is also a problem, because you are left with less money to use it in other activities. Okay, because a lot of money is fixed in the form of capital. Okay, but keeping less money is also very risky. Less than what should actually be kept. Okay, it is also very risky, because at the time of crisis, that is the thing that will save you. Okay, it's really important. If you want to do anything, you have to survive first. Okay, you have to survive the crisis. So if you're not able to survive, the whole purpose is lost for doing the business. Okay, so survival is important, and that's why risk managers look always on the downside. Okay, not on the plus side. So downside is that they will underestimate. And this is always something that you should keep in your mind when you are assuming normal distribution. Normal distributions can sometimes give us better approximations. And in fact, we'll see initial calculations being done based on statistical distributions only, but then we'll move towards more analytical methods, or I would say more qualitative methods, where estimation of these risk measures are considered more precise. Okay. So here a comparison has been shown that actual distribution of the S&P 500 index is the solid line that you see. Okay, and just look at the tails. Tail is slightly fatter than the normal distribution, actual normal distribution. That means it tells us extreme events are more plausible than what is being predicted by the normal distribution. In other words, you're underestimating. So be very cautious when you're using a normal distribution. Okay. Now, let's understand value at risk. So value at risk is an important measure and focus on adverse events and their probability. It has 2 parameters basically, time horizon and the confidence interval. That means what is the risk that I'm talking about? Over how many days I am going to lose certain money, be it 1 year, 1 month, 1 day. Usually VaR is calculated over 1 day period. Okay. And second is confidence level, that what is the chance that I want that on how many of the occasions I should not want the risk or the loss to go beyond certain level. Okay, to go beyond. Okay, so I want that on 95% of the occasions, my loss, what should be my maximum loss? I want to find that. And if that money is kept as capital, then I would be certain that on 95% of the occasions, I'll be able to meet up my losses. Okay, only on 5% of the occasions, which is rare, I'll require capital which is more than the VAR. Okay, and that's actually a problem with VAR. Okay. Now, what is the loss that is not expected to be exceeded over the time horizon at the specified confidence interval? That's the definition of VAR. It has nothing to do with it. From the examination perspective, if I say you just need to know what VAR is, of course, and then how calculation is done. Calculations are more important. Okay, so here just an example is given that 10 to 99% VAR is 12 million. So what is the meaning of this statement? It simply says that I'm 99% certain that over the next 10 days, my loss will not exceed $12 million. Okay, will not exceed. I'm 99% certain. But still here, if you see, there is 1% chance that the loss can go beyond $12 million. And then I would require additional capital. Okay. Now, regulators have used VaR historically to determine capital at the bank, but they also use internal models. Okay, like we would see what internal models can be used. So we have historical simulation, Monte Carlo simulation, hybrid approach, EWMA, GARCH. All these things are under our agenda. We'll see how things are done. Okay. Now, the normal distributions of losses arising from assets can be a following. The probability distribution, probability distribution. If we are using a statistical distribution, three distributions are commonly used. First is the normal, second is the uniform, and third is the discrete distribution. Okay. Under normal distribution, calculations are very simple. Uniform and discrete. Discrete also is very simple. For uniform distribution, we'll have to exploit the properties of uniform variable that we have studied in QTA 3. Okay, so you see there is a direct application of what you have studied in quantitative analysis. So in order to properly understand this chapter, it is really important that you are aware of what QTA 3 was. Okay, normal distribution. What are the formulas? You'll see it in the chapter also for normal, but for uniform and discrete, you need to have that idea pretty clear in your mind. Okay, what is the CDF formula for uniform distribution? How we can calculate the quantile from it? Okay, all these things. Now, if let's say we find that the probability distribution of losses are not normal. Okay, they are not normal. They are deviating from normality. Then we require more sophisticated tools, and these tools are the most common tool. In fact, the most widely used tool in the banks for finding out the risk, market risk capital, is the historical simulation. Now, let me tell you, in this FRM part 1, the historical simulation that we are studying is just the premise. Okay, it's just the overview, and I would say it's simple historical simulation. Okay, there are other versions of historical simulations as well. Okay, where weights are selected in a different way, and that is something that you will study in part 2. Okay, in market risk module. Now, next is expected shortfall. But before we begin with the expected shortfall, I'd just like to show you one thing. Okay, just give me a minute. Yes, are you guys able to see the Excel file? Please tell me in the chat if the Excel file is visible. Okay, fine. Yeah. So you see, this is the VaR calculation under the normal distribution assumption, and it's really simple. So for example, here I have the portfolio value, which is given to be $1 million or $10 million. Then I have the return, which is annualized return of 0.1%. That's 10% annual return. And I have the standard deviation. Again, it's annual, that is 0.15 or 15%. Okay. Now, let me tell you one thing. Again, this is something that you will study in the higher classes. But in part 1, you might have heard people saying that 5% VAR or 95% VAR, both are the same thing. Okay, both are just one way or another to say the same thing. What's the difference? So these notations like 5% VAR or 95% VAR, these notations come into the picture because of the nature of distribution. So if I talk about the distribution, then there are two types of distribution. One is called the profit distribution, which is considered PL, and another is called the loss distribution, which is called LP distribution. Okay, now in profit distribution, profits are taken to be positive, or returns are positive and losses are negative, in other words. Okay. Then in loss distribution, losses are considered positive and profits are considered negative. Or in other words, ideally a positive return is taken as negative in the case of loss distribution, and a negative return is taken as positive. Okay, so if it's a profit distribution, then your VAR will be on the left hand side, and you would calculate, if it's a profit distribution, you would calculate 5% VAR. Okay, and if it's a loss distribution, you will calculate 95% VAR. Using the same data, just I'm changing the nature of distribution, the way I'm representing the data. All the positive values, I took them negative. Okay, and all the negative, I took them positive. It becomes the loss distribution. And in loss distribution, we talk about 95% VAR. But if it's a profit distribution, as it is data, that means if the number is positive, while plotting, I consider them positive. If the number is negative, while plotting, I consider them negative. Okay, so that means I will talk about the 5% VAR. Okay, so that's the difference. However, it's the same distribution. It's the distribution of the same data set. And you just see here, when I'm calculating percentage VAR and dollar VAR at 95%, if I have the profit distribution, my percentage VAR is negative. So negative VAR means I did calculation using profit distribution. Okay. And if I have the positive VAR, then it means I have calculated the VAR using loss distribution, and there I will talk about 95% VAR or 99% VAR, things like that. Okay, but here we'll talk about, in case of profit distribution, we talk about 5% VAR or 1% VAR. However, I have written here 95% VAR, but that's actually the same thing. Okay, we always say that 95% or 99%, things like that. Okay, so that's the catch here. And if I talk about the formula for calculating these things, so it's really simple. It is the confidence interval formula that we have used. However, you have to remember that it's not a two-tailed confidence interval that we are calculating. It's a one-tailed confidence interval. So it is mu. If it's a loss distribution, so mu is the mean return, mean loss, sorry, not return, mean loss. Mu plus sigma times the critical value. Okay, so you'll have to look for one tailed critical value in the Z table. Okay, or in other words, 95 percentile CDF. Okay, see, simply 95 percentile C, so 95 percentile value. Okay, or the value for which the CDF is 95%. If it's a if let's say if it was a two-tailed distribution, then what we do in order to find the 95% critical values, we take 97.5% as the CDF. Okay, so that's the difference. Always remember. Okay, it's a one-tailed distribution, not two-tailed. Then if we talk about uniform distribution, again, uniform distribution is pretty simple if you talk about it. Okay, why it is pretty simple? Because it says that there is an upper value and a lower value. That means an upper limit and a lower limit, and all the values between these two range values, okay, these two limits are equally likely to occur. Okay, and the CDF formula is really simple. So here also you have the two variations. If you are considering the profit distribution, that means if let's say in the question return is given as 5%, okay, and you are taking it as it is, that 5% as mu, okay, or let's say A and B are given. So let's say maximum return is given as 10% and minimum return is given as -5%, and you're taking that as it is. That means you will have to work with the assumption of profit distribution, and you will use this relationship where the formula will be x minus a by b minus a equals to 0.01. That means if you're calculating 99%, so on the left hand side we are talking about. But if let's say the upper bound is given as, or let's say it is written in the question that the return values is plus 10% and -5%, and you are flipping it, making it -10 and +5. So then you will use this formula. Or alternatively, I would say that if it is mentioned in the question that the percentage loss, okay, the percentage loss on a portfolio is 15% and -10%. So you see the words that you have to catch in the examination, it's really important. So they are saying percentage loss. So that plus 15% is 15% loss. Okay, and that is taken as positive, and -10% is actually 10% profit, because I was talking about percentage loss. So negative loss percent means profit, correct? So if here you are using as it is, then you will go for this assumption where you will use right side of the confidence interval. Okay, you will be on the right side, not on the left side. Okay, so that's the only difference that I want to highlight here. You know, I know that you guys will learn the formula while sitting for the examination, before sitting for the examination. Formula is not a problem. How to interpret that formula, that's the problem, because that will lead you to mistakes in the examination. And trust me, when you're making a mistake, the examiners also know that what candidates can do in a question. So they will give you options in such a way that when you are, let's say the calculation should have been done, let's say they have given the loss. Okay, so they will show you, they will give you the answer based on both the ways. Okay, and they will be slightly different. Okay, so let's say loss data is given, and ideally if you're solving, if you're taking a lower limit as -10 and upper limit as b, then you should consider, and let's say 99% confidence interval, at 99% confidence interval the VAR has to be calculated. So you should take this value 0.99. Okay, what they will do, they will also show you a calculation using 0.01. Okay, so if you're making a mistake, you won't realize even that in the examination you are doing a mistake. Okay, because in the options there is an answer that will fit your description, that will fit your solution. Okay, so always remember that you have to be very, very careful while choosing the way in which you will solve the question. You need to identify the distribution that you are using, whether you are applying a profit distribution or a loss distribution. It has to be crystal clear in your mind. Okay, and that's why I'm showing it, because if it's a profit distribution, you will use the probability as 0.01. If it's a loss distribution, you will use the probability as 0.99 for 99% confidence interval for in this example. If it's 95, here it will be 0.05 for profit distribution, and for loss distribution it will be 0.95. So this difference should be very clear in the exam. Okay, now finally discrete is pretty easy, there is no doubt about it, but there are certain catches here again. Okay, I would tell you what are the catches here. So here I have the loss values, so -10, -4, -1.5 to 4.7, 6.1, 9.2 and 10.3. Okay, so now I'm asking you guys, what is this? Is it a profit distribution or a loss distribution? Quickly tell me in the chat. Am I considering the profit distribution here or the loss distribution? Profit. Okay, so Shanti is saying profit. Loss, Divesh loss. Okay, so we are having conflicts. Come on, quickly, guys. A lot of candidates are there. You guys are not replying. Just tell me. I need to know that you guys are understanding. Loss, loss, loss. Okay, so Sushant, actually you're wrong. It's a loss distribution. You see, at the top it is written losses, correct? At the top it is written losses, and a loss of -10 means profit. So I'm taking profit as negative. So it's actually a loss distribution that I'm considering. Okay, now the probabilities are given. Next, what I have to do, I have to calculate the cumulative probability and cumulative probability range. So starting from the first value, I start. Okay. So 0 to 0.07%. If it was a profit distribution, then where should I have looked for the VAR? Between the initial range, 0 to 0.5%, 0 to 0.05. Okay. There I should have looked for the VAR. Since here I already have the losses only. Okay. So I will look at the 95% VAR will be at 95%, where I have the where in the cumulative range 95% value lies. Okay, so just look at it. The cumulative values have been built. Now here you just need to see, it's really simple. You just need to see that in which cumulative probability range you will find 95%, okay, or 0.95. So you just scroll down, you see, come here, second last line, and here you see it's 0.90 to 0.96. So 0.95 clearly lies between these two values. Okay, so in this case my VAR will be the value corresponding to this cumulative probability range. Yes, Shushant, minus 10% loss is 10% profit. Now the question is, in which distribution we will consider profit as negative numbers, in profit distribution or in loss distribution?
No, but my point is then the column should have been named profit, right? Profit of -10 is equal to loss of 10.
It's not the loss of 10, it's a profit of 10. Na? That's why it is written -10.
Then the column should have been named as profit, right?
No, if it was +10, it would have been named as profit only.
No, no, my point is loss
Mhm.
is equal to -10. That
Hmm.
means profit of 10, right?
Yeah,
The column name itself is losses.
yeah,
That is why.
yeah.
So
So
you are
column
saying
name is
losses of
losses.
-10
Yeah, losses
equal
of
to, that
-10.
means profit of,
Yeah,
that means
that
profit
transforms
of
into
10.
a profit. But how will you say a profit in the terms of loss? So I say 10% profit. Now I want to express the same thing in terms of loss. How would I say it?
That's okay. My point is then it should have been mentioned as profit of -10. That means loss of -10.
No, no, no. Profit of
You are,
-10 is minus
we are
10.
contradicting our statement, right? My point
No,
is
no, there is
profit
no
of,
contradiction actually. Sushant, there is no contradiction here. If I'm saying that I have a loss of -10, okay, it is equal to profit of 10. That's all. But when I say the profit of -10, it becomes loss of 10. Okay, so that's the difference here. Is it clear, Sushant?
still not clear. Probably I'll get in touch with you separately.
Yeah, yeah, of course. After the meeting, we can. Yeah, so let's move forward. So here it will be 95% falls in this range. So it will be 6.1. My VAR will be 6.1. Now, the problem is in the calculation of 99% VAR. So if you look here, 99% comes in two cumulative probability range. It is in 0.96 to 0.99 also, and 0.99 to 0.1 as well. So which of these two loss values should be taken as the VAR level? Okay, so the best thing to do here is to take the average of these two. So whenever you see a scenario where you're seeing that, okay, I have to calculate the loss at a certain confidence level, and the probability is actually lying in the two cumulative probability ranges. Okay, that is, in this case, 0.99 is lying in two probability ranges. So here, the best approach is to take the average of the two losses of both the two intervals. So I'll take the average of 9.2 as well as 10.3, and that average is 9.75. So my 99.99% VAR becomes 9.75. Okay, so that's the catch here. Okay, now that was all about this Excel file and understanding how we do the calculations. Now let's get back to our slides and let's complete things quickly about the expected shortfall. So expected shortfall is simply the expected loss beyond the VAR level. Okay, so I'll just try to show you roughly what it means. So let's say this is my loss distribution. Okay, and this is let's say it is the mean return is 0. Okay, so on the right hand side I have the losses, on the left hand side I have the profits, which are represented by the negative numbers, and let's say this is my VAR level. Okay, so expected shortfall is nothing but the average of this tail beyond the VAR level. Okay, average of this tail, which will be this value. Okay, this will become my expected shortfall. If it's a normal distribution assumption, then something like this appears. Okay, that's the expected shortfall, or in other words, you can say the probability weighted average of the tail losses beyond the VAR level. So if let's say after the VAR level, I have 5 losses and all are equally likely. So what will be my expected shortfall? I'll take the average of all these 5 values. Simple average, end of the story. Usually this is done in the case of discrete distributions. So if let's say you have discrete loss values and you're assuming most of the time it is assumed that all are equally likely. All the losses have same weights, 1 by n, 1 by n, 1 by n. Okay, so in that case, you will find the first VAR, what is the VAR threshold, and after that, VAR value is not included. Always remember, when you are doing the calculation in the exam, never include the VAR. VAR is excluded, and then count how many values are there. Okay, after the VAR, take the average, that will be your expected shortfall. It's the most basic form. Of course, when we talk about the advanced forms where the probabilities are different, then certainly different approaches are used. So I'll come to that, but first of all, let's understand it. Okay, now let's get back. So when the losses are normally distributed, and let's say the mean return is mu and the standard deviation is sigma, then expected shortfall is given as mu plus sigma e raised to the power of minus mu square by 2. So this is a really complex formula. And from the examination perspective, I would say keep this in mind. Although it's complex, but still keep this in mind. They sometimes ask, okay, it's just about the formula. If you know the formula, you can easily calculate what the VAR and all are. Okay, VAR and expected shortfall are. The thing is, you need to remember the formula. And it is e raised to the power of minus u square by 2 times 1 minus x under root of 2 pi, where x is the confidence interval and u is the point on the standard level distribution for which x% of being exceeded. That means this is your critical value. So for example, you are talking about 95% expected shortfall. So 95% critical value is taken as u. Okay. So 95% critical value, which will be, I think, 1.65. Okay, that will be taken as u here. Now, coherent risk measures. So a risk measure is considered coherent or a better risk measure if it satisfies the following 4 conditions. First is monotonicity, which says that if y is more risky than x, then the risk the risk measure of y, whatever risk measure we are calculating, be it VAR, expected shortfall, or standard deviation, the risk measure of y should be greater than the risk measure of x. Okay, and that's understandable. If some asset is more risky, I need more capital. I need to keep more capital for that. Correct. That's monotonicity, and both expected shortfall as well as VAR satisfy this condition. Okay. Next is translation invariance, which says that if I keeps an amount of cash in my portfolio, okay, then my risk measure decreases by the amount equal to the cash. It decreases by the amount equal to the cash. So let's say initially my risk was $10 million and I keep $2 million as cash. Now my risk becomes $8 million. That's what we call translation invariance. Again, both expected shortfall and VAR satisfy this condition. Okay. Then finally, the third, we have homogeneity. Homogeneity says that if my if my portfolio increases by a factor of lambda, then my risk measure should also increase by a factor of lambda. So that means if let's say initially I had $100 and my risk was 10. Okay, risk was 10. Market risk capital was 10. Now, if I double my portfolio, let's say I do it $200. So my risk measure should also double. It should become 20. And again, this condition is satisfied by both expected shortfall as well as value at risk. Then finally, we have subadditivity, which is the only property which is not satisfied by the value at risk. It is satisfied by expected shortfall. It tells us that if I have 2 assets with certain risk, then the risk of the 2 assets combined, or in other words, the risk of the portfolio can never be greater than, another way to represent this thing is, can never be greater than the individual risk, the sum of the individual risks of the asset. So it means that let's say I have asset A, which has a risk of $10. I have asset B, which has a risk of $15. So when I create a portfolio by combining these two, okay, let's say $10 was the risk for investment of 100 and 15 was risk for the investment of 100 again. Now I combine them together. Portfolio becomes $200. So what will be the risk? It should, at max, the risk can be 10 plus 15. That is 25. That's the maximum limit. It cannot go beyond 25. But in VAR, you would see that sometimes it can go above 25. Okay, that is not necessary. In fact, diversification benefit tells us that it should be, the maximum limit should be the sum. It can be less, maybe 21, 20, 15, something like that, but it cannot be beyond 25. Okay, it cannot exceed the individual sum of the individual risks. That is the subadditivity property, and this is not satisfied by the VAR, but it is satisfied by I would say this expected shortfall. Okay, so with this we have completed this chapter. Just give me a minute. I will share my screen once again with the new chapter. Okay, so now we are going to start with the next chapter, that is VRM2, Valuation Risk Models, chapter 2, calculating and applying VAR. Here in this chapter, our agenda is first to understand what are the different ways. So if we talk about the VAR estimation measures, there are two ways: linear valuation method and full revaluation method. In linear valuation, we assume that the assets are linear in nature, and this is useful. Linear valuation method is useful. One way is delta normal method that we'll discuss in this chapter is useful when we know that the assets in the portfolio are linear. Okay, so if there is the risk, if there is a chance that something will change in the portfolio, it will change in a linear manner. Okay, and we know that it has its own limitation, because in practice we have a lot of assets which are not linear in nature, non-linear in nature, you can say. So in that case, we'll have to move towards the full revaluation method. And what are these? If we talk about the linear, most common one is delta normal method. And if we talk about full revaluation, we have historical simulation, where we fully re-evaluate the portfolio. Okay, we evaluate the portfolio completely. Each and every factors, the change is estimated, what will be the change, and the portfolio value is calculated again using those changes. Okay, and then it is found that what is the change from the initial value. Okay, the today's value, in other words, you can say, and that is used as a thing. It can be positive also, it can be negative also, but full revaluation has to be done. Okay, second is Monte Carlo simulation. It is similar to historical simulation, but the thing is Monte Carlo simulation is considered I would say it has its own benefit, because you can make an assumption about the distribution type. However, it's not necessary to make any assumption, but it's like you can create any number of scenarios. In historical simulation, you're restricted by the number of historical data, number of historical observations that you have. But in Monte Carlo simulation, you're not restricted by anything. You can generate n number of scenarios. In fact, you can generate it till infinite time. You can keep on generating it. There is no restriction. So estimates of Monte Carlo simulation are considered a little bit better than historical simulation, but there are again drawbacks also. Monte Carlo simulation is highly time consuming, is highly calculation intensive. Okay, so but historical simulation is comparatively easy to implement. Okay, and that's one of the reasons, because the improvement in the estimation that you get by using Monte Carlo instead of historical simulation is not too much. So you see that when we are taking any finance decision, we need to take into consider, we have that cost benefit trade-off, right? So for implementing MCS, if let's say the cost is high, but the benefit is not that much what is expected, so people will switch to a little because of that trade-off, people will use a method which is a little less precise, but at the same time highly effective, highly cost effective. Okay, so that's historical simulation. Now that's a discussion for upcoming slides. So let's move forward. Let's see each one of them one by one. Okay. So if we have a linear derivative, for example, like forward contract or something, then VAR estimation can become quite easy for us. Okay. So what we have to do in order to calculate the value at risk of linear derivatives is that we just need to know the delta of the derivative. Okay. So for example, if I talk about forward futures contract. So for the time being, I can say, let's say both of them, let's consider both of them equal, although they are not, but for the time being, let's say both of them are the same. So both of them have a delta of 1. Okay, now if the delta, I know the delta, what I only need to know is the value at risk of the underlying asset. So whatever my underlying asset is, I just need to calculate what is its VAR. The moment I know its VAR, I'll multiply it with the value of delta. That will give me the delta value at risk of the derivative. Okay, so the formula is pretty simple. Here, this method is basically called delta normal method, because we assume that the distribution of underlying asset return is normally distributed, and I'm using delta to find out the value at risk. So that's why the name delta normal method. Okay, and this, as I said, this normal assumes that the variables are normally distributed. Now the formula is VAR is given as simply the delta of the derivative times the VAR of the underlying risk factor, which is in this case the stock price, or it can be bond price, or it can be yield, whatever is exchange rate. It can be anything. You just calculate the VAR of that and then multiply it with the delta of the derivative. That will be our answer. Let's take an example to better understand it. So let's say I know that the 5% VAR, or you can say 95% VAR, daily VAR for Nikkei index, it's an index, okay, is $0.8 million. Now I want to calculate the annual VAR at 95% confidence for a portfolio which has 100 lots of Nikkei contracts, assuming 250 days in a year. Okay, so you see the difference. Again, this is something that you will find in the examination. They will give the data in one format, but they will ask you the answer in a different format. Okay, so here what they're doing, they gave the data in daily format and they're asking us to find the answer in annual. And the opposite can also be true. So for example, let's say they give you that assuming the returns are normally distributed, the annual return is 15%, the volatility is 30%, calculate daily VAR at 95% VAR. You have to catch the words there. Okay, so they have given data in annual terms, but they are asking me to calculate it in daily. Okay, so in that case, you have to convert these annual returns or annual volatility to daily returns and daily volatility, and then do the calculations. Okay, so that's the catch that you need to really understand. Now here also the same thing is happening, and 250 days is usually taken, but sometimes it's 252 also. In fact, in the examination, let me tell you clearly, you will find most of the time it is 252 days in a year. Okay, so here 5% VAR is basically the same as 95% VAR. So VAR for T day is given as VAR, 1 day VAR times the square root of time. This is the square root rule, which is applicable to VAR also. It is applicable to standard deviation as well. Standard deviation also follows the square root rule, or square root of time rule. VAR also follows the square root of time rule. However, this rule is very problematic, and this rule works if and only if we have a portfolio, or we have an asset which is with whose return is normally distributed, and second, the correlation is assumed to be zero. Okay, between if there are multiple assets, the correlation is assumed to be zero. If the correlation is either positive or negative, this rule gets violated. However, in the exam, if they're asking you to do it, they will clearly specify that, okay, assumptions are satisfied. So you're not worried. You should not be worried about that. Now, annual VAR, if I want to calculate, it will be daily VAR times the square root of time, which is a square root of 250. And I am calculating the annual VAR of the underlying derivative of the Nikkei index, not the Nikkei futures contract. I'm not doing that right now. Okay. So it will be 0.8 times 250, which is $12.6491 million. This is my annual. So I can say that I'm 95% certain that over the period of 1 year, I will in the next 1 year, I will not lose anything more than $12.6491. And how much certain I'm about it? I am 95% certain. Okay, now delta will be 100. Now you might be wondering, I said in the last slide that the delta of a forward contract is 1, but here I'm taking it as 100. So you need to understand that in the question, they are saying that it's not one futures contract or forward contract. Instead, it's a lot. And in practice, we know that these are traded in lots. So one contract is for 100 Nikkei futures. Okay, one lot. You have taken 100 lots. That means you have taken position in 100 futures contract. So one futures contract has a delta of 1. 100 futures contract naturally will have a delta of 100. That's why here delta is taken as 100. Okay. Now calculation is really simple. I just multiply 100 with the VAR of the underlying. I get the VAR. That is 1.264 billion. Okay. Or you can say roughly 1.265 billion. Over the next 1 year it is. Okay. Over the next 1 year, not 1 day. Now, let's talk about nonlinear derivatives. If we have nonlinear derivatives, then delta normal method cannot be applied because it assumes that the payoff is linear in nature, delta normal method. And that's why applying delta normal method for finding out the VAR for options or other derivatives which are nonlinear in nature, like swaps or etc., is actually faulty in nature. Okay, it should not be done, not at all. So whenever we have nonlinear assets, we should go for full revaluation of the portfolio. Okay, and there are two methods to do it: Monte Carlo simulation method and historical simulation method. And that's why most of the time you will see that banks are using either of these two methods. More sophisticated banks which have more capital at their expense, they might use MCS. Others, a lot, in fact, I would say a lot of banks use historical simulation method. Okay. Now, but the thing is, if you want to calculate the approximate VAR, it's not the exact. You cannot use it for actual purposes, but just to have some reference about, okay, like to talk in theory. Okay, like the discussion that we are having right now. we can calculate the delta normal vol just to have a rough idea that, okay, this is the risk roughly, or somewhere around this much value will the risk be. Okay, so for that we can use delta normal method, but in practical applications, delta normal is not at all advised. Okay. Now let's see the method first, historical simulation. It's the most common method used in the banks to calculate the market risk capital. Historical simulation first involves that we need to identify the market variables on which the portfolio value depends. Okay, so for example, I'll give you a very simple scenario. Let's say you have a portfolio, a bank has a portfolio which comprises of stocks, which comprises of derivatives, which comprises of bonds. Okay, so what are the factors that can have an effect? Okay, stock price can have an effect. Definitely, it will have an effect on the stocks as well as on the price of options, on the value of options. Then you have the volatility of underlying assets that will have an effect on the risk measure of this what is it, derivatives. Then you have the interest rate because you have bonds also, so that will also have an effect. If let's say you have foreign bonds, then currency rates, or let's say foreign equity, then exchange rates will also have an effect on the bonds. So these are the risk factors that is affecting the return on your portfolio. Okay, so all these risk factors has to be identified first under consideration. Okay, and these market variables are called risk factors. Okay, simply. Now, data is collected on the behavior of risk factors over a period in the past. They are sorted in order and the VAR is calculated accordingly. I'll tell you how this is done step by step, so don't worry. Now, when it comes to the risk factors, there are two types of risk factors. For some, we take the change in percentage terms. Okay, and for some, we take the change in absolute terms. Like, and why this is done, I'll tell you. There is a clear reason. So if let's say things are in the terms of monetary value, if something is given in the terms of monetary value, like the stock prices, okay, so there you will take the percentage change. Okay, or you can say exchange rates. These are in the terms of monetary value. These are not percentage terms. Okay, original terms are in monetary value. Okay, they are in monetary terms. So for exchange rates, example, for stock prices, for asset prices, be it any, percentage changes are considered in the case of historical simulation day over day. If the market variable under consideration or the risk factor itself is a percentage, then absolute change is taken. For example, change in interest rate. Okay, so yesterday interest rate was 4%, now today it is 4.05%. So here it will not be calculated in percentage terms, it will be taken in absolute terms, 0.05. Okay, so that's how we take it. Then credit spreads, these are in basis points, again absolute terms they are taken. Okay, so you need to take that into consideration also. Okay, so the same thing has been written here. So there are certain variables for which we take the percentage change, stock prices, exchange rates, and of obvious reason is they are in all the original variables are in monetary terms, so we take the percentage change. Okay, and why we take it, there is a reason. You see, if let's say you are using last 500 days of data, so maybe 200 days ago the stock price was very high. Okay, so there the change was happening like $50, $60 in the range of that. Okay, now today the stock price is very less, so $50 change is not expected, not at all. Okay, so how do you replicate that scenario here? Will you add $50? No, that's impractical to say. Rather, you would say that corresponding to that day's stock price, what was the percentage change in it? Okay, and the same percentage change I'll expect on the next day, on the next scenario. Okay, so that's more reasonable to say. But when it comes to interest rates, we know that it's percentage term and it will always stay within certain range. It's already in percentage, so it has to be taken in the absolute terms only. Okay, so that's the catch here. Now, before I move forward, let me just show you the Excel file where I have the historical simulation in order to just explain how historical simulation is actually done. Okay, so here I have a fictitious historical simulation done. So I have created a portfolio which comprises of a stock and a 5-year zero coupon bond. Okay, so there is a reason that why I took 5-year zero coupon bond. It will otherwise it would have made my historical simulation much more difficult because if it's a coupon paying bond, then there are multiple interest rates on which the value will depend. But if it's a zero coupon bond, there is only one rate on which will have an effect on my bond price. That's the 5-year rate. Okay, so here what I have done, I have recorded the historical data from this is my day 0 to day 1 on stock price, whatever stock I have, and on the 5-year rate. Okay, now portfolio value today based on the quantities that I have is 4.5 million roughly. Okay, 4.5 million roughly. Okay, now stock price is also given. Today the stock price is 143 and the 5-year rate is 4.4%. Okay, now I have to estimate the 95% VAR. So first thing first, I'll identify the risk factors. Clearly, the risk factors are the stock price and the 5-year rate. So I collected the historical data. Usually historical simulation is done on at least 500 observations. You can have more, there is no problem. So I collected the data on the last 500 days observation. So this is the day 0. Okay, from where I am starting. This is day 0. And I gave all the way up to the current date. Okay, all the way up to the current date on which I created the model actually. Okay. Now, the same is done for the 5-year rate. Then I calculated the percentage change in the risk factors, that how they are changing. This is scenario 1. So scenario 1 is basically change from day 0 to day 1. So that is 173.79. That is from 15th of September to 16th of September. That is taken here. This is my scenario 1. Percentage change in stock or delta stock and or change in rate. Okay. Now for stock, what I have done, I have taken the percentage change. If you look at the formula, in the formula bar, it is D16 minus D15 divided by D15. That's nothing but percentage change. Okay. And for rate, I have taken simply the difference because rate is already in percentage. So I'll take the difference here, 0.03. Then what I do from today the stock price value is 143.1. I create first scenario. I assume that my stock price will change by this amount, 0.03035. Okay. I find that the new stock price will be 143.61. And my rate will increase by 0.03. That is, it is 4.4 today. It will be 4.43. So what will be my portfolio value? I calculated it. And then I took the difference between the portfolio value today and the first simulated portfolio value. Okay. Loss turns out to 173,481. Okay. Similarly, I do from day 2 to day 3. That from day 2 to day 3, what was the change? This was the change. I calculated, I did the calculation, I found the loss. Okay. And then I simulated all the 500 scenarios. Okay. Finally, what I did, I sorted the losses. Okay. These are the 500 losses that I have sorted here. Okay. These are all sorted loss. Then I sorted the loss in descending order. So you see what I have written here, these are the losses. So the loss of this much, loss of this much. So the moment you see a positive, negative number, that would mean that on that day I had a profit. Okay. Now, I sorted all the losses in descending order from highest to lowest. Okay. Then I calculated the 95% VAR. So 95% VAR, if here I had 500 simulations. Okay. 500 scenarios have been created. So I will simply find what is the 5% of 500. 5% of 500 is 25. So from the top, I will count the 25th observation. Okay. Whatever my 25th observation is here, you can see I have the 25th observation. And then expected shortfall is basically the average beyond these values. So the top 24 observation, the average of top 24 observation has been done here. Expected shortfall 99% VR, it is 1% of 500. That is 5th worst loss from the top. So from the top, I just count 5. 1, 2, 3, 4, and 5. So it is 441,756. Okay, so here the same thing, 441,756. And expected shortfall, average of the first 4 losses. Okay, average of the first 4 losses. That becomes my expected shortfall. So this is how historical simulation is done in practice. Okay, now let's get back to our discussion on the slides. Now, let's talk about portfolio valuation. So full revaluation of portfolio for each of the scenarios can be computationally time consuming. Okay, so one way that these practitioners actually speed up this process is using the Greek letters that we have already studied, delta, gamma, etc. Okay, so if it's a linear portfolio, then instead of doing everything, we just take the delta. Okay, and we just find that, okay, what will be the change? So delta P is simply delta S if it is single asset. If it is multiple asset, so delta P will be delta I, delta SI. Okay. Okay, delta summation of all the delta i's and delta change in the stock prices. Delta of the what can I say? Delta of the asset and delta of the underlying risk factor. Change in the underlying risk factor, that is taken into consideration. Okay. Now, if we have a non-linear portfolio, then along with delta, we also take into consideration the gamma. If we have bonds, then we will do like duration and convexity. Okay, so the similar logic here, delta and gamma are taken into consideration. Well, delta and gamma are the Greeks for the asset, and delta S is the change in the underlying risk factor. Okay, delta S is the change in the underlying risk factor. Okay, now if this is the scenario when we have a single asset in the portfolio, when we have multiple assets, it's simply the summation, and it's really simple. So first risk factor, delta 1, delta S1, delta plus delta times delta S1 plus 1 by 2 gamma times delta S1 square plus delta 2, delta S2, delta 2, delta S2 plus 1 by 2 gamma 2 delta S2 square. Okay, if you had 3 assets, you will just add one more expression, which is like this for the third asset. Okay, that's the thing that this summation is trying to say. Okay, so that is the way to speed up the portfolio valuation process, especially when you have non-linear derivatives in your portfolio or non-linear portfolios. Okay, however, if you can see in the Excel, I was taking the bond, and I said that if I had taken a coupon bond, it would have led to a lot more complexity in my portfolio, because there will be much more risk factors to consider. Okay, there will be all the risk, all the spot rates that I need to consider, how they are changing that I need to consider. Okay, and maybe in order to shorten the process, I would have implemented PCA. But yet again, the issue is not solved. I'll still have many. It increases my computation time. Right, I'll have to then implement PCA to find the relevant components which will be considered as the risk factors. So that's not the thing that I want to do here. So instead, what could I have done to speed up the process? I would have simply calculated the duration and convexity of the bond, and using that, I would have estimated the change in the price. Okay, because I would always know what is my delta S, that is delta risk factor. That is, will they give specific risk factors in the exam, or they can give redundant data as well, and we have to identify the risk factor? No, Sushant, in fact, I would tell you very clearly, they will give you the simulated scenarios altogether. Even they will not ask you to simulate the scenarios. Okay, it's computationally time consuming. It's just that you need to understand that how things are happening. That's why I explained all these things. Okay, but in exam, they will give you the simulated scenarios. They will simply ask you to find out what the VAR is, what the expected shortfall is, or maybe the theoretical aspects, the basics that I've explained, the theoretical aspects they will ask. Okay, now let's get back. More complicated expression involves cross gammas. In fact, this was not the discussion in our FRM agenda also. We discussed 5 risk measures, 5 Greek letters, right? Delta, gamma, vega, theta, rho. There are other cross risk measures. Okay, some are like VOMA, VANA. Okay, then there are a lot actually. There are many cross risk factors also which are not considered actually, and they are not that much important. However, people can use them. Okay, people can use them in more advanced models. They are used. So now let's move forward. So now delta normal model revisited again. Common assumption is mean zero. So if you have a delta normal method, you want to estimate the VAR. Let's say you assume that the asset is normally distributed. Then how you're going to calculate the VAR or expected shortfall? So if I assume that the mean return, daily mean return is 0, then it is simply sigma p times u, where u is the critical value that is for the given confidence level. Okay, if you have a specified non-zero mean return, then in that case, what you will do? In the case of non-zero mean return, you will simply add mu plus. Okay, always remember to ensure that convention. Okay, I said no profit and loss distribution, that issue. Okay, always remember that. So if it is written that the return on an asset is 5% and you're calculating expected shortfall, so let's say you're calculating VAR. So while calculating VAR, if you're using let's say 95% critical value, that is 1.65. Okay, so you will take minus 5% or minus of mu there. Okay, you will just turn the mean return to a negative number. If let's say it is given that the percentage loss is 5%, then there is no need. Okay, or else what you can do, if let's say it is given that mean return is 5%, okay, and find out the 95% VAR. So you are taking 5% critical value, that is minus 1.65. So in that case, mu will be taken as it is, that is 5%. There is no need to change. That's the thing that happens because of the distribution assumption, that what distribution you are assuming. If mu is taken as positive, you are assuming a profit distribution. If mu is taken as negative, you are assuming a loss distribution. Okay, or you can say the return is negative, taken as negative. Okay, loss. I would not say in place of return they will write loss. Okay, there can be a lot of confusion in this case. First confusion is that they have written the mean return is minus 1%. So then it can become difficult to understand it. Okay, what is this? Mean return is minus 1%. So always look for the words. If it is return minus 1%, so that's return. Okay, that is not loss. For loss, they will clearly write that, okay, percentage loss is this. Okay, or loss is this much percent. So that's how things are given. Okay. Now for expected shortfall, again, if mean is 0, then the first part, we saw it in the last chapter, first part of the formula is simply replaced, is removed, and we are left only with the second part. U is the critical value at the given confidence level. X is the confidence level, 95%, that means 0.95 or things like that. Okay, you can use the calculator all the time to carry out this calculation. Now from the exam perspective, I would recommend that keep in mind these formulas. In fact, if you can just remember mu plus that sigma pu and mu plus this term, that's sufficient. Because in the exam, if it is mentioned that the mean return is 0, it's easy. You will simply replace it with 0. Okay. So no need to remember both of all these formulas separately. Just find those glitches, okay, that you can exploit to remember quickly. Next, what we have is the Monte Carlo simulation. So in Monte Carlo simulation, what we have is basically another way. And here also we create scenarios, and Monte Carlo simulation works well for both linear as well as non-linear portfolios. It can work for any of them. Okay. Now, for the sake of simplicity, just to explain things that easily, here it is assumed that risk factors are multivariate normal. That means all the risk factors are normally distributed, and they have certain correlation, but they are normally distributed. Okay, as in delta normal. Now, what is the procedure here? So procedure is pretty simple. First, you value the portfolio today. That means the current values of risk factor. Just look into the market, find what the value of the portfolio is. It's really easy. Then you will sample once from the multivariate, because you have assumed that all the risk factors are normally distributed. Okay, so you will go to the probability distribution, you will take a certain percentile, and then you will find the you will randomly select a random values just taken sample once from multivariate normal probability distribution for delta xi, means that you are randomly selecting a value of delta xi corresponding to a probability, okay, corresponding to a CDF, randomly selecting it. Okay, so when you do this, when you sample once, you will get certain change values for all the risk factors, that over the next one day what will be the risk factors. Okay, then use the sampled values of delta xi to determine the value of risk factors. Once you get the xi's, you find what the risk factors are at the end of the period under consideration, which is usually the 1 day. Okay, then revalue the portfolio. You have the delta xi values, find what will be the portfolio value if delta xi's, the risk factor values are this and this, the change in risk factors are this and that. Okay, and the difference here between historical simulation and Monte Carlo simulation is that to find the change in risk factors, in case of historical simulation, we were looking into the historical data. Okay, but here we are randomly producing it from some assumed distribution for the risk factors. For the sake of simplicity, here we have assumed normal, but it could be anything. You can have binomial for some, Poisson for some, maybe students t, some other distribution, exponential, beta, whatever you can have. Okay, it totally depends on you. But just to make, because normal distribution is the most simplest one. So just to make you explain things, we are taking normal distribution. Now, once you have revalued the portfolio, let's say today the portfolio value is 150. You revalue it and you find that the portfolio value will be 145. Then you take the difference, 150 and 145. Okay, so final minus initial. So this will be the final 145 and initial was 150. You take the difference, $5. Okay, that is your loss. Okay, difference here. Difference is actually negative. 145 minus 150. That is minus 5. Change is, so portfolio value is decreasing. That means I have a loss of 5. So I report the loss. Okay, so this is the thing. Subtract this portfolio value from the current value to determine the loss. And then we'll keep on repeating step 2, 3, 4, and 5. 2, 3, 4, and 5. Keep on repeating it. Keep on repeating it. Okay, as many number of times. Now here the thing is, when you are repeating the process using in historical simulation also we are repeating the process, right? But the repetition is limited up to a limit of the size of historical data. So if I have 501 data points of historical data, I can create 500 scenarios, not more than that. But in historical simulation, even if I don't have historical data, I can calculate any scenario I want. I randomly generate the numbers, and then find the corresponding change in the risk factors and find what the value will be. This is more robust method. Okay, but at the same time, it's more time consuming. Okay, so I'll just get back to the Excel sheet and I'll just try to show you once again what this will look like. Okay, so Monte Carlo simulation, here we have it. Now here again, the same portfolio, Amazon stock, and I have this 5-year rate and portfolio value. So basically it's same as the last question. Now here, historical data. Okay, so here, although we have the historical data, Okay, yeah, that had to be done actually. Yeah. So I have the historical data. I just you see what the thing is for this stock price and 5-year rate. These are my risk factors, correct? These are my risk factors. Now the important thing here is that in order to assume a distribution, I need to know, especially I'm here also working with the normal distribution assumption that returns and change in rates are normally distributed. Okay, I have assumed that. So once I assume that it's normally distributed, I do need to know what is the mean return and the volatility. So for that, I have used the historical data to find the mean return of both stock price and the 5-year rate, and the standard deviation of both stock price and the 5-year rate. Okay, what is this? Daily stock price and daily change in the 5-year rate. I have found the standard deviation of all of them. Now the thing is, once I have them, what I have to do, I have to simulate the scenarios. I'm not using the historical data. I'll just show you the formula bar for stock return. So for stock return, what I have done, I have selected a probability. So in case of norm.inv, I have to provide a probability, the mean and the standard deviation or variance, you can say. Okay. So sorry, standard deviation in this case. So the probability is randomized. For probability, I have used the function RAND. Okay, and double bracket. That means randomly a probability will be chosen, a probability will be value will be chosen, and corresponding to that, the return value will be calculated. Okay, so the same thing has been done here. And here also, randomly probability has been selected along with the mean and standard deviation that was required, and corresponding change in the rate is determined. Once I know that, then I use these two numbers. Once I have it, I use these two numbers to generate the value of the portfolios. Okay, now here I have no restriction. Although I have done it only for the 500 observations, I think it's 100 only. Let me check. Oh no, it's 500. Although I've done it for 500 observations, I could do it for 10,000 observations also with ease. There is no problem for me in doing it. Okay, implementation is pretty easy. Then I calculate the losses, and then I sort the losses, and then I find what my VAR is. Okay, finding VAR is really simple. Again, if it is 95% and I have 500 observations, so 25th worst loss. So from top, I count the 25th loss. This is the similarity between historical simulation and VAR. Okay. And another thing that I have assumed here is that stock return and rate, change in rate, are independent of one another. You see, Monte Carlo simulation, assuming risk factors are independent of each other. Because the moment I take into consideration the dependence of stock return and change in rate, then it can become difficult for me to do it on Excel. Okay, in fact, I would have to use advanced softwares like it can be done easily on Python, there is no doubt, but on Excel, it will be very difficult for me to incorporate that correlation. Okay, even for two variable system, if it is more than two, then it's like not possible. Okay, I can't do that. But yeah, we have assumed that stock return and change in rate are independent of one another. Okay, if there is dependence, then I would have to take that into consideration as well. Now, let's get back to our slides and let's complete these. Okay, so yeah, that's the end of the chapter for second chapter. Now just give me a minute. I'll just share the chapter 3 and then we'll start our discussion. Okay, so now we're going to start with the third chapter of our discussion, that is measuring and monitoring volatility. Okay, so the basic premise of this chapter, I'll tell you first, that there are advanced models that are actually used to estimate the volatility that is being used here. Okay, so the basic premise here is that when we are calculating value at risk using parametric models, okay, using parametric methods. Parametric means where I am using stats, okay, econometrics. I'm applying mathematics in a way. So things are easy. Like there are certain formulas that you can use, and things will work pretty well. Okay, when are we going to finish today? You see, there are 8 chapters in our today's discussion, and we are already at 3rd chapter. Okay, right now. So it's 12:27. 1.5 hour. So I think it will be till 4:30. It will go. The class will go on till 4:30. Okay. So now let's get back to the discussion. Yeah. So I was saying that when we are using parametric methods, then the whole idea is that I need to know volatility precisely. Okay, because the moment I know it, I can calculate things. Okay. And another thing is that when we are calculating VAR or expected shortfall, it is not done for long period horizons, like 1 year or something like that. It is usually done for short periods, like 1 day at max 10 days. Okay. Now for this short time period, it can be shown actually, and I'll not be discussing that aspect in this chapter, although it's a part of it, but I'll just give you a brief premise. So uh, it can be shown actually that we have seen in the last chapter that there are deviations from normality. Okay, like normal, we can't say that returns are normally distributed. Okay, in the long term, unconditional distribution or is not normal. But the thing is that data set that we had, it included some periods of high volatility, some periods of low volatility. Everything was combined all together. We completely disregarded what the uh, exact scenario was in the history. Okay, we just took the unconditional distribution. Okay, the average. I just took the average volatility across the period. We didn't consider the fact that the volatility itself is changing over time on a daily basis. So it is argued, and it can be shown also that analytically that if I know that on a given day the volatility is known, if for me the volatility for a certain variable is known, then I can say that for that day the probability distribution is normally distributed, given that I know the volatility, with the volatility of that percent. Over the next day, again, it will be normal, but the volatility will be different because on a daily basis, the volatility keeps on changing. Okay. So in order to utilize the normal distribution in a more efficient way, once it was established that conditional distribution can be normal, and conditional on what? Conditional on volatility being known, daily volatility being known. I can say that daily probability distribution will be normally distributed. So now the challenge becomes, okay, I'll come to the challenge, but there is one aspect more that I would like to explain. So, and once I'm able to establish that the distribution is normal, okay, once I am able to establish that the distribution is normal, I can easily calculate the VAR now by using the formula mu plus sigma times the critical value. Okay, so the only challenge that I have here is that how to estimate this daily volatility precisely. Okay, how can I do it? I know the limitations of standard deviation. Are there any other ways to calculate the volatility? So yes, there are. And two of these ways we are going to discuss in this chapter. First one is EWMA, that is exponential weighted moving average, which is also called exponential smoothing. Now let me tell you, exponential smoothing is done for a lot of other variables also. And not only volatility, it's done for a lot of other variables. Okay. And then we have GARCH, that is generalized autoregressive heteroscedastic, conditionally heteroscedastic models. Okay. These are the two models that are used to estimate the daily volatility. Yeah, I'm not changing the slides actually. I'm just giving you the premise. Okay. Kamrul, I'm just giving you the premise. I have not dived into the chapter right now. So I'll change the slides when the time comes. Okay. I just giving you the premise. So these are the two models that is under our consideration. Okay. Not a problem. Not at all. Yeah. So let's start our discussion for the day. Now, VAR, we know that, okay, mean zero return distribution is assumed to be normal. Then percentage VAR is simply the critical value times the standard deviation. Dollar VAR is percentage VAR times the portfolio value. Once you have the percentage VAR, you can just multiply it with the portfolio value. You get the answer. Okay. And and a VAR, we know that it is simply 1 day VAR times the square root of n. Okay. So square root rule, we have studied it. And for two asset portfolio, VAR, percentage VAR is given similar, the formula is similar to what we had for the standard deviation, okay, where we do take into consideration what the correlation is between the assets. And then finally, if we have dollar terms, then weights are ignored. Okay, always remember, now again, this is something that is important from, I think you might have understood this in quantitative analysis chapters also when you studied standard deviation, that standard deviation in percentage terms, which is usually done. Okay, when we are calculating that, we always take into consideration the weights in which the assets are proportionated in the portfolio. But if I have the standard deviation given in dollar terms, then I need not take into consideration the weights. Okay, and the same goes for VAR also, that weights are not at all considered. Only you can say VAR of A plus VAR of B times, of course, they are squared, times 2 plus 2 times the VAR of A times the VAR of B times the correlation. But if the VAR I'm calculating, portfolio VAR that I'm calculating is in percentage terms, and the individual asset VAR is also in percentage terms, then weights need to be considered. Okay. So in the exam also, do look for these things. Sometimes people don't realize that, okay, how silly these mistakes are, and they overlook such things. Okay, but in the exam, you will end up making silly mistakes. I'm not doubting your intelligence. You guys all are intelligent. Okay, you know what you are doing. Okay, you are at well established positions. You guys are doing really well. But the thing is, minor mistakes. You need to pick up those in the exam. That will enhance, like, even if in 5 questions you are making a minor mistake, it may lead to a scenario where you are not able to qualify the exam. Okay, so that makes the difference. Now, methods of estimating: historical based and implied volatility based. Implied volatility, that's the option pricing BSM model. We calculate the implied volatility, and we simply use it to find the VAR. Pretty simple. Okay. Now, when you're using historical data, okay, I'll tell you. In case of history based, we utilize historical data to estimate the volatility, and we assume that history will repeat itself. Like, it's the basic principle in finance, right? History repeats itself, not exactly, not in the exact manner, but yeah, there will be repetition. Okay, implied volatility, and that's why historically based parameters are called backward looking. Okay, they are backward looking, and sometimes they are not considered more precise because they do not reflect the current or the future expectations, that what possibly will happen in the future, what the market is expecting in the future. Historical parameters will never tell you that. So what we do, we calculate implied parameters. Implied parameters are basically, you can say, the future expectations, that in future they're expecting that this will happen, so that will have some effect on the current parameter value. Okay, and that's more realistic in nature, implied ones. So one way is that you calculate the implied volatility. We know implied daily volatility. We know that, okay, um, uh, 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 conditional on daily volatility being known, the distribution, the probability distribution is normal. So I can use the normal distribution assumption. I can calculate the VaR. Okay. Another is, if you're using historical based data, I have one way to calculate it. That's a standard deviation. Okay, we have studied it in the in the chapters previous, in the quantitative analysis chapter. But the thing is, they are primitive methods. Okay, that method has a lot of limitations. That estimation method of standard deviation has a lot of limitations. So what do we do? How do we cover those limitations? How do we remove those errors that are happening? Okay, so there are multiple ways to do it: parametric and non-parametric ways. In parametric, we have exponential smoothing, GARCH, and delta normal. And in these cases, in all these three, the knowledge of volatility becomes important. So that's why I said that the most efficient way of estimating volatility should be used. So standard deviation is the least efficient way. Okay. And then if it is non-parametric, then for estimating VAR, we have historical simulation, MDE, multivariate density estimation, and hybrid approach. Hybrid approach basically, and hybrid approach is basically a combination of historical simulation and exponential smoothing. Okay, I'll tell you briefly at the end that what these things are. Now, let's move forward. Estimating the current volatility. Okay, so when we're estimating and we are giving equal weights to the historical observations, which we do in the case of standard deviation that we calculate. Okay, it's very dangerous. We are making a huge mistake. First, if the sample is too large, let's say you're using a large sample. Okay, so the chances of making an error is less, but this becomes less reliable because you're using data from so much far away in the past, which may not be relevant in today's context. Okay, so today, if let's say you are using last 5 years of data, for example. Okay, so in the last 5 years we saw COVID. Okay, 2019, 2020, all these years were very rough for the people. Okay, then we had some periods of high volatility in the global market when Russia-Ukraine war broke out, and then when this happened, Israel, that crisis, Israel and Palestine issues that going on, that happened. It created turmoil. So we have some periods of high volatility. Okay, so what happens is that if you're using something from too far away, like something that happened during the COVID, these are the recent ones. Of course, it can be taken into consideration, but let's say too far away, COVID. Okay, so at that point of time, we had high volatility in the market, but that is not relevant in today's context. And I'm giving the weight to the volatility on that period is same as the weight that I'm giving to the volatility of yesterday. So that's not reasonable to say. Okay, that means my estimate is becoming more reasonable. And in other words, I can say that I am reducing the noise so much that it is of no use at all. Okay, so why we average it out? Why we average things out? To reduce the noise. If I'm reducing the noise completely by taking the long-term average, then it's of very little use for us. Okay. So one might argue that, okay, we'll not take the data which is too far away. Okay, that also has its own problem. But first, let's discuss the second problem, which is cyclical problem. Okay, so you see, there are certain assets whose volatility is so cyclicality that for certain period of time, you will have a period of high volatility, then you'll have a period of low volatility, then again high, then again low. Okay, so this does not reflect. So when you calculate the average, it's simply the average. Okay, so today, if let's say, uh, let's take an example, very simple one. So let's say today, let's say in a year, we have 6 months when the volatility is high. First 6 months, the volatility is high, and the last 6 months, the volatility is low. Okay, and let's say it's what, June 30th. So the last day of the first 6 month period. Okay, so on June 30th, uh, the volatility is comparatively higher, and you're using the average volatility. That is, you have calculated the volatility by assuming equal weights, by giving equal weights to all observation. So that is actually underestimating your risk factor. Correct? Your risk is today, the risk is slightly high, but since you're using the average which has given equal weights to all of them, you are using your risk is actually underestimated on that day. Okay, then on the next day, you enter the period of low volatility, and let's say it happens abruptly. Okay, you abruptly enter into the period of low volatility. So in this case, what will happen on the next day? Your average is greater than what the actual risk is today. Okay, on July 1st, your average risk is greater than what your risk was, what your actual risk is. So here you are overestimating the risk. Okay, by considering the average volatility. So that's the problem. When you have cyclicality, it creates problem. Okay, next and final problem is, we said that, okay, if I am taking too long data set, then why not take a small data set? Okay, so again, yeah, when you're taking a small data set, the most relevant ones like the last 30 days, it works, but it may not capture all the dynamics. Okay, so you have to, the data set should have to be significantly large, but at the same time, I need to find a way by which I ensure that recent events have more impact than the more distant events. Okay, so the one way to do it, and then there are problems of outliers and extreme values which lead to sudden changes. You will see this in part 2. In the initial chapters only, you will study a phenomena called ghosting. Okay, what is it actually? It happens because of the outliers only, and that's why these weighting schemes, providing equal weights, is not a good solution. Okay, so what is the way out? How can I ensure that things are happening? So one would say that, okay, I'll give reducing weights. Okay, I'll give reducing weights. So highest weight will be given to yesterday's observation, and lowest weight will be given to the last observation. But what is the function to decide the weight? Okay, there has to be a function that I'll use to decide what will be the weight of each asset. Okay, so for that, to solve that problem, exponential smoothing was given. Okay, in fact, exponential smoothing is applicable for all the variables, be it financial variables or any other, for all the variables which show such properties of standard deviation, because exponential smoothing actually smoothens the way in which the weights are given. Okay, so model is named actually EWMA, that means exponentially weighted moving average. Okay, and here the takeaway from the whole discussion, in fact, if you'll read the book, and if let's say I was taking the actual class, not the crash course class, so I would have actually explained how this is derived. But for the time being, in fact, from the examination perspective also, the derivation is not at all important. You should by heart this formula. Okay, that EWMA, when solved, of course it can be proved, there is no doubt about it, but when solved, you will end up with this result, that current volatility estimate is actually a function of last day's return and last day's volatility estimate. Okay, if I have these things, done. And then the lambda value. Now, value of lambda is actually, I would say, subjective in nature. It varies. Okay, the only problem with EWMA is that it does not define lambda. You have to identify by trial and error that what is the optimal value for lambda. Now, in lambda, as it is said here, it's called a persistent factor or decay factor. Okay, now higher value of lambda, if lambda is higher, it gives more weight to the last day's volatility, which is actually in effect a combination of the volatility over all the periods in the past, and less weight to the recent event, that is the return. Okay, if you give in other words, it becomes less responsive towards the recent outcomes if lambda is large. If lambda is less, let's say instead of 0.99, you take 0.7, then what happens? Your R square, it becomes more responsive towards the most recent events, more responsive. That means now your volatility estimate, daily volatility estimate will fluctuate more rapidly. It becomes more noisy. So you would want to reduce the noise also, but not too much. Okay, you want to keep it to an extent. So by trial and error and under risk matrix that was issued in 1990s, and it was given by JP Morgan only. Okay, so that company I'm talking about, not this. Okay, the person. So lambda was found in the 1990s that it was 0.94 is considered appropriate value of lambda, and in the examination you should be using this. If they are not, if they have not given the value of lambda, then you will be using this value 0.94. But if they have specifically mentioned some value, then use that. Okay. However, why I'm saying it, because in today's context, like it was the value derived in the 1990s, it's almost 30 years ago. So in today's context, how reliable this value is still to be tested. Nobody has tested it, but when doing advanced analytics, people do trial and error. Okay, to find that, okay, which is best possibly giving me the results, best possible results. So it can vary, but from the examination perspective, I would say this number, remembering this value of lambda, will be sufficient enough. Okay. Now let's take an example and let's understand the exponential smoothing, how calculations are done. So on Tuesday, return on stock was 4%. So I know that on Tuesday, return R is 4%. Volatility estimate for the same day was 1%. So now I need to find out the volatility estimate of Wednesday. That means today, I would assume that sigma n, that means today is Wednesday, Rn minus 1 is known to me, and sigma n minus 1 is known to me. I have the lambda value given as 0.94. I have to calculate it. It's pretty simple, direct application of the formula. And in the examination, this is something that you can expect. Direct application of the formula. There is no doubt that you guys can't answer it. Okay, just give me a minute. Yes, so let's start solving this question. Now, Rn minus 1, 4%, sigma n minus 1, 1%. I have the formula, EWMA model, the model to estimate the current volatility estimate, variance estimate. I get the variance clearly and quite easily, that it is 0.000190, and then I take the square root. I get 0.01374. So there is a mistake here, I think. It's 1374 and it is written 9784. So just ignore it. There is a mistake, clear mistake. So whatever it is, you can calculate. The objective is to explain what is happening here. Okay, the objective is to explain the process, not the answer. It is a typing error actually. So just ignore that typing error. Now let's move forward and let's see the GARCH model. The GARCH model is basically an extension of EWMA. So in EWMA, what we are doing, we are saying that there are two parameters on which the value of current volatility depends. It's the last day's volatility estimate and the last day's return. But it was found that there are certain, there is a long run average variance also. Okay. And in other words, you can say that GARCH so cyclicality, or volatility so cyclicality. Okay. So there is an average value and sometimes volatilities are above this value. So it is natural that they will be pulled towards the average, and sometimes the volatility will be lower than the average value. So it is natural that it will be pulled towards again, but in this case, pulled upwards towards the average value. So it was established that one more factor is there on which the value of current volatility estimate should depend, and that is the long run average variance. Okay, which is called VL. And there are three terms now, three parameters, alpha, beta, and gamma, that has to be estimated. Sum of all of them should always be equal to 1. Alpha, beta, and gamma, when we sum them, it should be always be equal to 1. And if you look at it, this model carefully, this model is basically, you can say that EWMA model is basically a specific case of GARCH model, GARCH 1,1 model, when gamma or weight of average variance rate is 0. Okay, when weight of average variance rate is 0, I can say that GARCH model will transform into EWMA. Okay, so you can say EWMA model is a special case of GARCH models. Okay, now again here also the formula is important, and here the weights gamma is equal to 1 minus alpha minus beta. So the important thing is this one, omega. Okay, now in the examination you might find two versions of this model. In fact, in many literatures also, you will see that it is written sigma square n equals to alpha r square n minus 1 beta sigma square n minus 1 plus omega, or plus this that you're seeing in front of you. Okay, so the thing is, omega is basically equal to gamma times VL. Okay, and here you have an analytical way to find the VL also if you know omega, alpha, and beta. So from the examination perspective, there are two ways in which they can ask the question. First, in which they will first is the one where you will have to utilize this model. That means you'll have Rn, sigma n, long run variance rate, alpha and beta will be given, and of course, if alpha and beta is known, you can calculate gamma, and you'll have to find the current volatility estimate. Second is using this relationship where omega, alpha, beta, things like this will be given, and you will be asked to find the average variance rate, long run average variance rate. Okay, so these are the things that you need to remember. Two ways in which the questions will be asked. Now let's take an example and let's see how things are done. So here we have sigma square t plus 1 is basically sigma square t plus 1 should be this 0 point some or you can say 5 times 10 to the power of minus 5 minus 6 precisely. Then you have 0.12 times RT square and 0.85 times sigma t square. Okay, this is my GARCH model given. Okay, now here 0.12 is my alpha, 0.85 is my beta, and this 0.4 times 0, 5 times 0 and 5 is my omega. Okay, it is not gamma L, it is omega. It is not gamma or VL. They are not separate. It's the product given here. Omega times gamma L, the complete product. Sorry, gamma times VL, the complete product is given here. Okay, and this product is called omega. We know that. Okay, now I have to find. I know what the values are. I have to find sigma t plus 1 and VL. Okay, so basically both the types of question that you will see in the examination have been, the calculation have been done here. So sigma t plus 1, pretty easy. I have the RT minus 1 value. I have the sigma t. I have the sigma t value. I'll just put in there. I'll calculate sigma square t plus 1 and take the square root. Okay. So omega calculation has been shown first. Then sigma square t has been calculated. You see, just the values have been put in, and I get the sigma square t plus 1. I take the square root. I get the answer. Okay, 1.71%. Now my task is to find VL. I have already found gamma. Gamma is nothing but 1 minus alpha minus beta. I have alpha as 0.12, beta as 0.85. I just subtract it, I get gamma as 0.03. Then VL is, we know that omega by gamma. That is the number that I had divided by 0.03. I get the answer. Okay. So that's how things are done. And in the examination also, you will see either of these two types. The questions from this will be either of these two types. Now, long horizon volatility. Long horizon means that, okay, I found out what the volatility is today. Now I want to make an estimate that what will be the volatility at 10 days from now, not today, at 10 days from now. That means n plus 10, sigma n plus 10. I want to find that. So for that also, GARCH model actually gives an analytical way to solve. Okay, and this is the formula that you can utilize. So sigma square n plus t is simply given as the long run average variance rate plus the sum of the weights of return and volatility raised to the power of t. T is the period for which you're estimating, like 10-day ahead forecast I want to make. So t will become 10. And then sigma square n minus VL. You can use this formula to estimate what will be the volatility at 10 days from now. Okay. Now, hybrid approach. Hybrid approach basically is actually a mixture of historical simulation and EWMA. You see, I said exponential smoothing is used at many places. Okay. Historical simulation is one of them. The problem in historical simulation was that when we were creating the scenarios, we were giving again equal weights to all the scenarios. So the scenario 500 days ago, okay, scenario created from the data, sorry, not scenario 500 days ago, scenario created from the 500 days old data was given the weight of 1 by n, that is 1 by 500, and the scenario created from yesterday's data is also given the weight of 1 by n, that is 1 by 500, if my historical data size is 500 observations. Okay, so again, that's a problem. Okay, it's not reliable. So what we do, we change the weighting scheme, only the weighting scheme. That weights of these observations, most recent observation will be given the highest weight, and the most distant observation will be given the lowest weight. Okay, and accordingly we'll do the calculations. So just for weighting the observations, we use EWMA, and everything else stays the same. Okay, so here what we do, let's say you're using last k days of data, let's say 500 or 100, whatever. Okay, so if it was HS, each observation has a weight of 1 by k. But in the case of hybrid, the weight changes to 1 minus lambda by 1 minus lambda raised to the power of k, times lambda raised to the power of m minus 1. Now again, the challenge here is the value of lambda, what this lambda should be. So usually from the examination perspective, if I say this lambda value will be defined to you for mth observation. So for yesterday's observation, what will be the lambda value? It will be 1 minus lambda by 1 minus lambda raised to the power of k times lambda raised to the power of m minus 1. That is, I would say 1 minus 1. It is yesterday, day 1. Okay. Then you're going back to day 500. Okay. So it is 1 minus 1. Okay. Lambda k is simply the total number of days that you have in your data set. That is maybe 500, 250, 100, whatever. Okay. And that's it. Okay. So, okay, before correlation, I just want to show you the historical simulation. Okay. So just give me a minute. I'll share the this Excel sheet once again. I just want to show you the hybrid approach. Okay. So that's hybrid. Okay. Now in hybrid, what happens? It's the same one. The example that we used in the last chapter. Okay. So what I have done, I have taken the lambda as 0.98. Okay. I've defined that. Okay. Lambda will be 0.98. K is given to me as 500. Now here I have date, stock price, return. Then what I do, I calculate the weight. Okay. This is the 500th observation. So I have calculated the weight using the formula that we saw, 1 minus lambda by 1 minus lambda raised to the power of k times lambda raised to the power of k minus 1. So it has the lowest possible weight because it's the last observation, right? Then if I go to the most recent ones, you see, if I go to the most recent one, yesterday's data, the weight is 0.02, that is 2% weight. Highest weight is given to the most recent one and lowest weight is given to the most distant observation. It is like it, if I transform it, it will be 0.6 zeros. 0. I would just write it here for you guys. Just a minute. Okay, it is simply 0.000000837. This is the weight given to the 500th observation. That means the most distant observation. So that solves the problem. Okay, now what we have to do, now the catch is that I calculate the losses. Okay, so I have just taken the sorted loss here directly. There is no need to do that. And then I have the corresponding weights. Once they are sorted, I have the corresponding weights. And then I calculate the cumulative hybrid weight. Now, in order to find the 95% VAR, I look for the cumulative hybrid weight. So if I have to find 95%, I look for where I have 0.05. Okay, because these are the losses sorted in descending order. So I look for 0.05 here. Okay, so I'll keep on scrolling. Here you see I have 0. I'll just increase the size so that it's more clearly visible. Here you see this box, I have 0.0506, okay, which is close to 5%. So I can say roughly that this value is my VAR, percentage VAR, that is minus 0.0275 or 2.753%. Okay, is my value at risk, percentage value at risk. Rahul, for that you'll have to talk to the team. I can't share it right away. Okay. I'm extremely sorry. I did not meant to do it, but yeah, you can talk over Telegram. You just message us. They will tell you. Okay. Yeah. Now, let's get back to the slides and let's see the final thing of this chapter, that is correlation. So you see, if you are calculating the standard deviation using this one, is it by any means possible for us to calculate the correlation? So yeah, it is actually. And the calculation of correlation actually depends on one thing, on one assumption, that average daily return is 0. Okay, so if I assume that average daily return is equal to 0, then covariance can actually be calculated using EWMA model by using this form, where covariance today's covariance is given as lambda times yesterday's covariance estimate plus 1 minus lambda times yesterday's return on asset X and multiplied by the yesterday's return on asset Y. Okay, so this is the formula that you can use. Again, lambda has to be estimated. Now, the best approach here is that if you are estimating volatility using a lambda of, let's say, 0.94, so the best approach would be to use 0.94 while estimating covariance also. Okay, do not use different values. And once you have the covariance, we can easily calculate the correlation. It's covariance divided by the standard deviation of X times the standard deviation of Y. Okay, So that's how the covariance is calculated. Now from this chapter, if I talk about the takeaways, so the important takeaways are, first, EWMA model, that formula. Okay, then you have the GARCH model formula, and the VL formula, long run average variance rate formula, which is which was omega by gamma. Okay, then you have the long run variance. Okay, like H forecasting. Like what will be the 10-day ahead forecast, T-day ahead forecast, that formula, and this one. Okay, these are the important ones. And one more formula is there, which we have seen sometimes questions have been asked, that was related to the weights, hybrid weights, right? 1 minus lambda by 1 minus lambda raised to the power of k times lambda raised to the power of m minus 1. Okay, this formula, sometimes what they do, they ask that, okay, if an observation is this many days old, then what will be the weight of this asset while calculating the historical simulation, while conducting a historical simulation. Okay, so kind of this can be asked. So remember this. So from this chapter, there are a lot of formulas to remember. Okay, and of course they're not difficult ones. If you look carefully, you will find patterns. Okay, so they're not difficult ones. Like for example, EWMA and GARCH, there is a clear pattern. Okay, then just keep in mind that, okay, EWMA, special case of GARCH, end of the story. Okay, then again, here also, if you look at the covariance, what is happening is just we are replacing variance with covariance. Okay, and we are replacing return square with the product of return on the two assets. Okay, so it's kind of on a similar ground only. Okay, now, so that's the end of the lecture. Now I'll open the fourth chapter, that is external and internal credit ratings. So just give me a minute. I'll open that chapter. Yes, so now we'll start with VRM 4, that is internal and external credit ratings. Now in this chapter, you see there are a lot of things that are qualitative in nature. Okay, so you'll have to keep them in mind, that, okay, like for example, ratings, what is point in time, what is outlook, watch lists. Okay, because they will frame qualitative questions, like subjective questions based on these concepts. Okay, and then there is slight application of probability theory. Slight application of probability theory, where you will find that, okay, certain probability tables are prepared. Okay, probability matrices are prepared, default probability matrices we call them. How they are prepared, you will understand the basic mathematics, not the total mathematics, I would say, because when we are doing the complete maths, you will have to take into consideration a lot of things. And the most biggest assumption that we work with when we are dealing with these things is that we assume that, okay, defaults are not correlated, but in practice we know that they do are correlated. Okay, they are actually correlated. So it's a faulty assumption, but because of the restriction we have, that we can't use softwares in order to show them. Okay, I can explain the theory, there is no problem, but if you don't have the softwares, if you can't implement it, you'll forget. Okay, so that's the reason that, and all, in order to keep things simple also, these things are done, that usually we assume that, okay, independence is assumed. Okay, but in practice, that's not always the case. Defaults are not independent. Probability of defaults can't be independent. Okay, so if certain sectors are finding problems, okay, then not only one company will default. If one company defaults, probability of default for other companies actually increases. Okay, so that's the thing that needs to be considered, but we will ignore that. And with this understanding, let's understand this. Let's understand this chapter, that is external and internal credit ratings. Okay, now credit ratings are used uh, to assess the credit risk associated with any party. So as investors, like bank make investments. Okay, bank give out loans. So we'll not talk about loans, but let's talk about making investments. Let's say there is a company who wants to borrow money. So possibly investment bank will organize a bond issue for them, and bonds are issued. Okay, so one needs to understand, investors need to understand that how worthy is this bond credit worthy. If I invest in this bond, if I, let's say, lend money, in other words, if I lend money to this company, by purchasing bonds, we are actually lending money to the company. Okay, to the issuer. So if I lend money to this issuer, is my money safe? Is it guaranteed that I'll keep on receiving the money, like in the future, all the promised payments will I receive, and there will be no defaults? Okay, and because the problem is, if there is a default, there is a loss of income. Okay, so how do we assess it? So there are two ways to do it. In fact, if we talk from the institutional view, not from retail investors perspective, from institutional point of view, there are external credit ratings which are given by some credible institutions which are into this business, okay, in this a specific domain. And then we have internal credit ratings, like for example banks, if they have a strong internal culture and they have this structure within them, so they can internally find how credible, how credit worthy this other party is, and is it worth investing or not, or if I invest in it, what will be my risk, okay, how much money is at risk of loss. Okay, so that is something that we'll understand, and how these ratings are built, we'll understand that. In fact, when we talk about internal ratings, it is discussed in more detail in, I would say, part 2, not in part 1. In part 1, in this chapter, there is only one chapter actually. In part 2, you have multiple chapters dedicated to ratings and scoring. Okay, so especially in part 1, I would say we are just having an overview of what these things are, just an overview. Okay. So for example, there are rating agencies, established external agencies like S&Ps, Moody's, and Fitch. Okay, and they're vital in assessing credit risk. They provide, and they have been doing it for the last century. However, there has been a glitch, 2007 and 9 crisis, but it was only for a specific product domain. It's not for the bonds or money market instruments for which they are producing the rating estimates. Okay, it's only for one product domain, that was structured credit. Okay, which these companies were also not able to understand properly, that what these products are at the first place. They were not able to understand um, or clearly investigate. They were not able to properly investigate the methodologies that were used to create these products, okay, to make them more worthy. So structured credit was like you're taking up scrap and making it as valuable as gold. Okay, so you're using a scrap and making it a gold. There should have been a proper structure, that how is it possible, how you're doing it, what you're doing to ensure that something like this happens. Okay, so that was not very clear to the credit rating agencies, and they simply relied on the data given by um, the the issuers who issued these products. Okay, so things went haywire, and that was the only time when these institutions faced issues, and it had its problems. Okay, so there were consequences for them because they misjudged the risk. So Dodd-Frank Act came immediately after this crisis, and in USA especially, I'm talking about. So they required more transparency in what, like, they wanted them to disclose what are your assumptions or what are your methodologies when you are giving ratings to a certain product. Okay, when you're rating a certain product, what are your assumptions and methodologies? You have to be very transparent about it, that how you arrived at a certain rating. Then they have tried to increase the legal liability also for rating agencies. So if, let's say, it is found that rating agencies are doing something, let's say some kind of fraud is detected. Okay, it's not sure, but in 2007 and 9 crisis. Okay, is it happening for all? Is the connection not good for all? Am I audible now? Okay, fine. I think it was just a fluke. Don't worry, it can happen. Okay, so yeah. Okay, fine. So they have increased the liability. If something bad happens, there should be some responsibility taken by the credit rating agencies also. Then on the SEC, Security Exchange Commission, that is a part of US finance system, okay, federal finance system, they have created a special office of credit ratings, office of credit ratings, which monitor these credit rating agencies. Okay, now Basel Committee still uses credit rating to determine credit risk capital for banks. However, alternative methods are also there, okay, and who are not relying on external ratings to assess the credit profile. Then there are some other methods, other calculations also suggested by the Basel Committee, or for the countries who have not implemented Basel norms completely. Okay, in fact, in India, I would say we are way beyond Basel norms. Basel 3 have been implemented and we are beyond it now. Okay, if we'll talk about all the risk measures, that what should be this much criteria, that criteria, this and that, everything, it is well beyond Basel 3 norms in India right now. Okay, for the Indian banks, I would say, and it has been done on a very severe scale, on a very serious note over the last few years. And that's the reason we see that especially the financial system, I would not talk about any other industries. Okay, the financial system is still robust in India compared to other countries, if you'll see. Okay, now if we talk about rating scales that are issued by these institutions, there are long-term ratings and at the same time short-term ratings. So long-term ratings are basically provided for a longer period of time. So for years, over a year, what they are expecting, what these banks are actually expecting. And long-term ratings are done usually for the bonds. Now, one confusion that a candidate always has is that ratings are given to companies. Ratings are not given to companies. Okay, ratings are given to bonds. For a single company, two different bonds, they might have two different ratings. Okay, rating totally depends on how this bond will perform, this security will perform. But of course, explicitly, if you see, because they are valuing the bond. Now, who has issued the bond? Bond is issued by a company. So if something bad happens to the company, something bad happens to the bond. So implicitly, you can say that it's the company who is being valued, but these companies, these rating agencies, they always rate the bonds, not the companies. Okay. Now, S&P and Fitch, these are the rating scales that they use. AAA is used for the most top rated bonds, which have the least probability of default. And there are no modifiers. Modifiers means subcategories, you can say, kind of. Then you have double A. Double A has three modifiers, double A plus, double A and double A minus. Okay. Then you have A, again it has three modifiers. Then you have triple B, then you have double B, then B, then you have triple C, C, and then you have double C, sorry. Then you have only C, and then you have default. Okay. Now anything beyond triple B is considered junk bond, or you can say speculative bond or high risk bonds. Okay, high yield bonds. There are multiple names to it. And all the bonds who have rating, which have rating greater than double B, or you can say from triple B to triple A, are considered investment grade bonds. So if there is a bond which has any of these credit ratings, starting from triple A up to triple B minus, okay, can be considered investment grade bonds. In other words, they are considered good quality bonds. Okay, but from double B onwards, downwards up to D are considered bad bonds. In fact, D basically means default. They have defaulted. Okay, and these are the ratings used by both S&P and Fitch. Okay, S&P rating is also like S&P gives AAA. Then Fitch also has the rating AAA. So they have the same rating criteria, rating scale. Okay, the difference is for the Moody's. Moody's use a different modifier, like AAA is here also, but the thing is, they said, okay, you keep AAA with all caps, I'll keep AAA with two small cap A's. Okay, so that's the difference. Again, if you look at the criteria for modifiers, it's the same for all the three rating agencies. AAA has no modifiers. AA has three modifiers, but here again, they have just taken that, okay, you're using plus, minus, and neutral. I'll use 1, 2, and 3. 1 is the best of AA. Okay, and 3 is the worst of AA. Worst of AA, not the worst bond. Okay, within AA category, A3 is the worst category. Okay, or you can say A3 is the lowest. Here also, till BAA, all the bonds are considered investment grade bonds, and after BAA, all the bonds are considered non-investment grades. D means simply default. That means these bonds have defaulted. Okay. Now short-term ratings. You see, long-term ratings are usually done for the bonds, but there are short-term ratings also, because we need to understand that what is it? We need to understand that there are money market instruments also. Short-term treasury bills are there, which are issued by the government, or you can have um, these treasury the bills issued by the corporations as well. Okay, like commercial papers. Okay, CPs. So how these are rated? For them, short-term ratings are created, and these are for money market instruments. And for S&P, the ratings are like A1, A2, A3, B, C, and D. Here, till B, it is considered investment worth investing, and CD, it's like very high risk. Okay. However, there is no clear criteria defined by S&P for this in this regard. Let me tell you clearly. Okay. Then you have Fitch. Fitch uses F1, F2, F3, B, C, and D. Quite similar. Okay. Then you have Moody's. It has only 4 ratings: P1, P2, P3, and then you have no rating. Okay, NP, or no rating, or you can say this. You can consider it as default. NP is default. Now, historical rating performance. Historically, so if let's say I am talking about the rating matrices, how they're built. So they are done using historical rating performance. Historically, how they have performed, and using that information, today's estimate is presented. So first thing that we need to consider is the cumulative average default rate, and this I would say cumulative average default rate gives us information that what is the probability that it will default in a given time period, that a certain bond will default in a given time period. So for example, this time period can be 1 year, can be 2 years. So that's why cumulative. So if let's say I say 2-year cumulative average default rate is 5%. So it means there is a 5% chance that the bond will default over the next 2 years, not one, over the next 2 years. That's why cumulative. 5-year cumulative average default rate can also be given. Okay. So probability of an issuer with certain rating defaulting within a given time period. It can be 1 year, it can be 2 year, 5 years, 6 years, whatever. Unconditional default probability. It gives us the probability that the bond will default in a future year. That means what is the probability that this bond, AAA rated bond, will default over the next 1 year? Okay, let's say it's 2%. So 2% chance that in the next 1 year, this bond will default. Okay, only the next 1 year we are talking about in the case of unconditional default probability. Then you have conditional default probability, which talks about that given that this bond has survived for certain period of time, what is the probability now that the bond will default? Again, you see, it's a new information. We now know that over the last 3 years, the bond has survived. Now, today I want to talk about what is the probability that it will default in the next 1 year. That's what we call conditional default probability. And all these three matrices, cumulative average default probability matrix, unconditional default probability matrix, and conditional default probability matrix, all these matrices are produced by these credit rating agencies. Okay, so here again, given that it has survived for a certain period. Now, here what we have is the cumulative average default rates. So when I say, for example, bond rated B, it is for third year. These are the years and these are the ratings actually. On the top row, we have the years and the first column is the rating. Okay. So for B and for year 3, it is 12.66. So it means that there is a 12.66% chance that a bond rated B will default in the next 1 year. Oh, sorry, in the next 3 years. I'm extremely sorry. In the next 3 years. Okay, there is a 12.33, 12.66% chance. Similarly, Divesh, I said that if I have a bond rated B and I'm talking about a period, I want to know what is the default, what is the chance that it will default over the next 3 years, then it is 12.66%. Another way to say it is that there is a 12.66% chance that this bond will default in the next 3 years. Okay. Now, unconditional probability of default actually can be calculated using the cumulative default probabilities. So for example, I want to find out the unconditional probability of default in year 3. Okay, so what I will do, I will use the cumulative probability of default in year 2 and year 3 to find it. Okay, so for example, and this is the formula that you can keep in your mind if they are giving it in the examination. So unconditional probability at year, let's say n+1, is simply cumulative probability year n+1 minus the cumulative probability of year prior to that. So it means if I want to find out unconditional probability of default in year 5, okay, so I would say I can calculate it using the cumulative probability of year in year 5 minus the cumulative probability of default in the year 4. Okay. And again, there is a difference when I say unconditional probability of default in year n+1. So they have a different meaning. So for example, cumulative probability of default in year 5 is 18.32%. It means there is an 18.32% chance that the bond rated B will default in the next 5 years. Okay, just listen to the words that I'm saying. Statements are really important. Okay, and unconditional default probability of year 5 means that let's say let's see the calculation first. Okay, so for B rated bond it is being done, and let's say the default probability for a B rated bond is 5 years, unconditional probability of default. So what does it mean is that there is a 2.45% chance that the bond rated B will default in year 5. Okay, in the next 5 years it can default anytime. It may default in year 1, year 2, year 3, year 2, year 5. But when I say unconditional probability of default in year 5, I am saying that what is the probability that this bond will default only in year 5? Okay, only in year 5. So there is a 2.45% chance. Now, next, what we have the table is the unconditional probabilities of default. So what it tells us, for example, for a B rated bond, let's say for a C rated bond, 26.78% means that in the next 1 year, there is a 26% chance that the bond will default. Year 2, it is 9.10. So what does it mean? That is that a bond rated C will that there is a 9.1% chance that a bond rated C will default in year 2. I would not say in 2 years. I would say in year 2. There is a clear distinction between these things. Okay, these two statements. When I say in year 2, it means only in year 2. When I say 2 years, over the next 2 years, it can happen any time in the next 2-year period. It can happen in 1 month, 1 year, 1.5 year, 2 year, every time. Okay. Now, conditional probability of default can actually be calculated using the unconditional probability of default and survival probability of default. Okay. Now, survival probability of default is easy to calculate. Okay. What you have to do, default in year n-1. So let's take an example. So in the previous example, we were considering the B-rated bond. Okay. So I want to find out probability that the bond default in year 5, given that it has survived for 4 years. That means survival till year 4 and then default in year 5. What is the probability of this happening? Okay. So it can be calculated as unconditional probability of default in year 5. That is 2.45%. And I need to divide it with the survival probability of year 4. Now, this is a catch that how you are going to do it. So I'll just go back here and I'll just show you. For year 4, the cumulative probability of default is 15.87%. What does it mean? Is that over the next 4 years, there is a 15.87% chance that the bond will default. Now, I am interested in finding out that what is the chance that the bond will not default over the next 4 years. So it's simply 1 minus 15.87%. And the same has been done actually here. 1 minus 15.87%. That's the survival probability year 4. And when I do the calculation, I find the answer to be 2.91% as the probability. Okay, so what does it mean? Is that given that a bond rated B has survived for 4 years, there is a 2.91% chance that the bond will default in year 5. Okay. Now, next is the hazard rate. Hazard rate is basically measures the rate at which defaults are happening at time t. Okay, and is commonly used by analysts. It's a function of time and it is stochastic also. Okay, so what does it mean? Is that hazard rate, you can say, is the average default rate. Average default rate. Okay, not the default rate for current period, average default rate. And if it is given that 1 year average default rate is given to me, then I can find out what is the unconditional default probability for that 1 year period. Okay, average 1 year default rate, which will take into consideration all the past observations. So in the history also, what was the average yearly default rate for this rated bond? I take the average of all those probabilities. That's my hazard rate. Okay, but in practice, when you will do the calculations, when you do this, like, okay, I have the hazard rate for period 0 to 1. Now I want to find out the unconditional default probability for the same period, that is 0 to 1. Okay, so it will turn out to be the same as hazard rate only. There will be minute differences, maybe at 3rd or 4th decimal place. Okay. But this formula becomes really helpful when you have the hazard rate, which is usually the annual default probability, and you want to find out what is the probability that the bond will default in the next 6 months or next 3 months. Then this formula becomes helpful. So you have the annual default rate. Your T is known to you that I want to find out what is the probability of default in the next 6 months. So your T becomes 0.5. You apply this formula, you find that, okay, what is the probability that it will default in the next 6 months? Okay, so that's how you do it. And when this becomes useful, I'll give you an application. Let's say you have invested in bond. Okay, now you have a bond which is triple B rated, but only 6 months is left to maturity now. Okay, you had invested, let's say 15 years ago or 14.5 years ago, but now only 6 months is left to maturity. You would still be interested in finding out what is the risk. Okay, what is the risk? Because you need to keep the capital, risk capital with you until the time you have that asset in your portfolio, or till the time that asset ceases to exist. You will have to keep it. If you own it, then yeah, it has to cease. Basically, it has to until unless it goes out of the portfolio, I'll have to make an allocation of risk capital. So since 6 months is left, I have the yearly default probability. In order to find the risk, I only am exposed to risk for the 6 month period only, not for 1 year. So I can't use 1 year default probability to do any calculations there. So in this case, what I'll do, I will use the 1 year default probability to find the 6 month default probability using this formula. And if you want to find out the survival probability, We know that survival probability is nothing but 1 minus default probability. And when you do the math, you will see that this is your answer. That is e raised to the power of minus of h bar times t. And then finally, it also helps you to find the default probability between two time periods. Let's say what is the probability that this bond will default between the period 8 months and 14 months. That can be done. Okay, your T1 is 8 month, your T2 is 14 month. You have to just find the average default probability rate, that is annual default probability. Let's say it's 2%. You can apply this formula. You will get what is the chance that it will default between the period 8 month and 14 month, between this time period. What is the chance that it will default? Now, credit spreads and premiums. So we know that credit spreads are basically the extra interest earned over the risk-free rate. Okay, for corporate bonds, credit spreads are large, not very large, 4-5% it can be. And this 4-5% excess is called the credit spread. So the higher the credit spread is, so credit spread actually is also a way to perceive risk. Okay, so the higher the credit spread, the more risky the asset is assumed to be. The lower the credit spread, the less risky the asset is assumed risky. The less risky the asset is assumed to be. Okay. Now, the reason they need risk premium, in fact, if the credit spread is high, so it's obvious, right? Because if you're taking high risk, you would want more premium. Okay, you would want more return. If the asset is more risky, you would require more return. And that's why these corporate bonds have higher coupon rates, higher yields. If you yield to maturity, YTM, if you compare it with the treasury bonds. Why they need it? First is systemic risk, because the bonds defaults are not independent of one another. So that has to be incorporated. Second, less liquidity. Bonds are relatively illiquid instruments. They're not traded frequently. In fact, if you take into consideration some treasury bonds, then most of the corporate bonds are traded intermittently. They are not traded on a regular basis like stocks. Okay, and who are the investors in these corporate bonds? These are like pension funds, mutual funds, hedge funds. Okay, big financial institutions for their own portfolio, they do these kind of investments. So they have lesser liquidity. Now, the trading process, outlooks and watch lists. Now, again, as I said, from this part, you can expect certain qualitative questions, subjective based questions. So you need to understand what outlooks and watch lists are. So if we talk about outlooks, there are 4 types of outlooks that rating agencies provide. First one is positive outlook, that which tells us that in the medium term, okay, outlook word means in the medium term, the rating agency is planning to enhance the credit rating. So its credit risk is going to decrease. That means its default probability is going to decrease. So outlook is positive means in the medium term, not in short term, not in immediate. Okay, maybe in the next 1 year, 1.5 years, 2 years, they are going to increase the credit rating of certain asset. Okay, that means positive. If it is negative, that means in the medium term, they are going to reduce the credit rating. If it is stable, they will do nothing. Okay, in the medium term, nothing is going to happen. And if it is developing, it means that in the medium term, they are planning to change the credit ratings. But as of now, they are not sure whether it will be a positive change or a negative change. Okay, so that's the thing that can happen. Now, why these things are important to you? Because as a risk manager, you would want that your the bonds that you have invested in, okay, let's say you have invested in certain bond categories, so you would want that the risk capital is more or less stable. Okay, if the probabilities of default are changing on a regular basis, so risk capital will fluctuate a lot. Okay, so that's why people, these investors look into these things, and also it increases their investment avenues. So for example, let's say they had a stock they had a bond in their portfolio which previously had a BBB+ rating. Okay, now the rating agency have an outlook on that specific bond. That outlook is positive, so they're expecting that okay, in the near future the rating might increase. Maybe it will go to um, AA plus or AA minus, for example. Okay, something like that. So in that case, what the bank can do now, right now, first of all, there will be a benefit that after some time, my risk capital requirement will be reduced because the default probability will be reduced after 2 years or maybe after a year. Second is they can right now the bond is cheaper because it has a higher risk premium, so they can make a decision to buy it or something like that. So that's why outlooks are also important, okay, to make such decisions, qualitative. And that's why I said that these are qualitative parameters and they have to be understood qualitatively only. Next, you have watch lists. Watch lists are something that is if let's say a rating agency puts some assets on watch list, it means they are going to do something in the immediate future, maybe in the next 2-3 months, something is going to happen. So if the watch list is positive, okay, if some asset is in a positive watch list, it would mean that, and then there can be a negative. Okay, so in positive out watch list, it means that there is a possible upgrade expected in the short term. And if the asset is in the negative watch list, it means there is a possible downgrade in the short term. In the short term, there is possibility that the ratings will be downgraded. Maybe in the next 2-3 months, the rating will be downgraded. And if it's positive, maybe in the next 2-3 months, rating will be upgraded. Okay, so these are the things that are important, the rating process. Okay, next, the rating process is also considers two more things, that is through the cycle and point in time. Now you see, sometimes what happens when you are doing any kind of calculation, you need to understand that ratings can be of two types. First is through the cycle. That means they're talking about the long period. Okay, over the period, what will be its rating over, let's say, 5 years, 6 years, something like that. And then you have point in time. That means immediately, like at this point, what is its relative rating? Okay, and why this becomes important, because you see, future is unpredictable. Like anything can happen, and there will be scenarios where I would say all of a sudden a crisis comes in. Okay, so at that point of time, the risk perception all of a sudden can change. Okay, so these things can actually have an effect, and that's why you need to understand the difference between through the cycle and point in time, and why we need to take that into consideration. So through the cycle is the average credit worthiness over long term. Okay, average, on an average, it disregards what will happen in the short term. Okay, then it understate during the crisis, because during the crisis the probabilities are heightened, but since through the cycle is average credit worthiness, so it will understate. And during stable periods, it actually overstates through the cycle estimates, because stable periods, there the probability of default will be way too less than what is actually being shown in the market. Okay, so it overstates the probability of default. Okay, now through the cycle estimates are generally produced by rating agencies like S&P, Fitch, and this Moody's. Okay, then you have point in time estimates. Point in time estimates are current estimates. Okay, like based on current future, what is happen, what is happening currently. Based on that, what is the future default probability? They are talking about that. So point in time, today, what is its probability of default? That is something that I'm interested in. That's point in time. Okay, then they react quickly to changing circumstances. So if let's say all of a sudden the market switches to crisis mode, okay, so there is a crisis all of a sudden. So these point in time estimates also get adjusted accordingly and immediately. Okay, very swiftly. So they react immediately. So whatever the risk is perceived at its real value. Okay. Now, some rating users adjust ratings produced by rating agencies, and they basically convert. So what some users do, they try to convert through the cycle estimates to point in time estimates. Okay, one way to do is using hazard rates that we have discussed, but there are multiple ways. In fact, hazard rate is a very crude way, I would say. Okay, and in practice, rarely it is used. There are more advanced ways to do it. Okay. Now, what are the alternative to ratings? Alternative to ratings are like organizations such as Kamakura or KMV, which is KMV, which is now a part of Moody's, and Kamakura are there. They use models to estimate default probabilities, and then they offer these results to the clients for a fee. They charge a fee that, okay, you give me a fee, I'll assess it, I'll tell you what the default probability is. Okay, they do a lot of research. Now, the models provide point in time estimates. Okay, why will anybody consult these companies? Because they provide point in time estimate. That's really important. Okay, so if it is a stable period of time, why would anybody want to keep more capital with them? Okay, if it is a crisis time, why should I keep less capital with me? That's also a concern. So I always want to have point in time estimates, although each one of them has their own pros and cons. But yeah, that's one of the argument that can be given for point in time estimates. Okay, and they are not stable. They are highly fluctuating over time, because the moment market conditions change, the ratings will change. But this is not true for credit ratings like issued by the rating agencies. They are more like slow movers. Okay, they react slowly to the things that are happening. Now here, a simplest model, if we consider, the default occurs when the value of assets falls below the face value of the debt. So here I'm taking a scenario. It's very simple to understand. So let's say there is a company. Okay, now company keeps on running till the time it has equity. Okay, now just look at the balance sheet. So balance sheet means assets, and then on the liability side, liabilities and equity, that is liability plus equity. Okay, now what happens is that let's say your assets decrease. Okay, so liabilities can't decrease, so your equity decreases accordingly. So let's say your equity is $10 million. Now your value asset goes below $10 million. Now what happens? Your equity is wiped out. Okay. Now let's say asset is also 10 million, debt is also 10 million. So now you have no equity. Okay. So now if the asset value falls, you won't be able to pay out your debt. That means as of now, when debt and asset are both equal to 10 millions, one-to-one payment can be made, shareholders will get nothing. Okay. The moment it goes below $10 million, asset goes below $10 million, you don't have sufficient money to cover your liabilities. That's the condition of default. So what this statement says is that if value of assets fall below debt value or the liabilities of the company defaults. Okay. From the case of bond, if let's say there is a bond which is backed by a security, if the value of security falls below the value of debt, then there is a default. Okay. So that's the thing that we're trying to say. So it can be shown that equity at any future time is basically an option. And this option has a value of V minus D or 0. V minus D means if asset value is greater than the debt value, definitely whatever is the difference is taken as the equity. We know that, right? Debt is 10 million, asset is 15 million. My equity naturally becomes $5 million. Okay. And if let's say asset is 8 million and debt is 10 million, my equity is 0. Okay. I would not say equity is -2. Okay. Equity becomes 0. So equity is considered as a call option. Okay. Is considered as a call option on the firm's asset. And the strike price is actually equal to the debt value, ST minus K. Okay. ST minus K. K debt. Debt is the strike price and value of asset is the, and ST, or you can say the underlying is the firm's asset. So max of V minus D or 0 is the call option. So you can say equity is a call option. Now, what these companies do, they value this call option. Okay. They value this call option using a standard pricing theory and they estimate that, okay, what is the probability of default? Because in option pricing theory, we have seen that we can calculate what is the probability of zero, I would say, probability of zero payoff and positive payoff, right? So they only consider that what are the scenarios in which I have zero payoff, and accordingly they can find the default probabilities. However, it's a very crude model. Again, just to give you an idea, there are more analytical advanced models to find out the point in time default probabilities. Okay. Now, rating transitions. Okay, so rating transitions means what is the chance that the rating will change over a 1 year period? Okay, and this is usually done for a 1 year period only. And this transition matrix looks something like this. Okay, so here you see on the left hand, on the first column, you have the ratings, and on the top row also you have the ratings. But what does it tell us? So let's just select a value. Okay, let's say AAA. Okay, this number 87.05. So what does this mean is that there is a 87.05% chance that the rating of a AAA rated bond will not change at all. So it means that if today the rating is AAA, 1 year after also the rating will be AAA. What is its probability? 87.5%. That is being said. Okay. If I talk about, let's say, this number, 3.79%. So it means that the probability that a BBB rated bond will be downgraded to BB. What is its probability? There is a 3.79% chance that this will happen. If I talk about this number, 0.1, it means there is a 0.1% chance that a BBB rated bond will be upgraded to a AA rated bond. Okay, so this is the rating transition matrix. And based on this also you can have certain questions. Now, what is the rating transition matrix are basically reported by the rating agencies, and they are not calculated using they are not calculated assuming independence of yearly default. Okay, now practically what happens, one would say that, okay, you have to calculate rating transition. We usually assume independence between the defaults. Okay, whatever questions you might have solved, no matter what was the source of the question, there was always this underlying assumption that defaults are independent. But in practice, defaults are not. Okay, there are two reasons. First, if a firm has been downgraded in year one, then there is a high chance that it will be downgraded in the next year also, and the opposite is also true. Yeah, disturbance in connectivity. Is it happening with all others, or is it like, can you please check? Can you please guys tell me, is my voice audible to you clearly? Okay. Now is it okay? Okay, fine. Okay. So I was saying that throughout the curriculum that you have studied, you might have seen that we are using the assumption of independence. Okay. Whatever question, no matter what was the source of your question, whatever you are solving, you might have seen that defaults are independent, everywhere. Okay. But in practice, defaults are not independent, and rating agencies also do not assume that default are independent. Okay. They assume that there is some dependence in the default. Why? Because if a firm has been downgraded in 1 year, let's say in year 1, then it is more likely that it will be downgraded further in the next year also. On the other hand, if the firm has been upgraded in the first year, then it is more likely to be upgraded in the next year also. So there is a clear correlation, and that's why rating transition matrices, when creating them, we do need to take into consideration the dependence structure, that what is the chance of this happening. Okay, there has to be a correlation. Yeah. So yeah, rating transition matrices are calculated for internal as well as external ratings also. Like internally, we companies do that okay, if today I estimate that the rating is, let's say they have their own rating criteria. Let's say today the rating is E. E is considered the best rating, for example, for them. So what is the chance that the rating will move from E to D over the next 1 year? They create internally also. Okay. So that's the end of the 4th lecture. So now we are exactly at the halfway of our today's discussion. So let's have a break of I would say half an hour, and then we'll resume our session with the remaining 4 chapters, that is VRM 5, 6, 7, and 8. Okay. So don't leave the meeting, just stay in the meeting. Okay. Yes. So now we're going to start with VRM 5, that is the 5th chapter of today's discussion, and this is country risk, determinants, measures, and applications. Okay, so you see in the last chapter, what we discussed was mostly related to assessing the credit risk associated with companies like institutions, corporations. Okay, but the thing is, we also invest in government securities. Okay, in fact, if we talk about we, when I say we, it means financial institutions. Okay, companies also invest in uh, government bonds. Now, although in theory, what happens is that we assume that this uh, uh, treasury securities are virtually risk-free, but in reality, they are not. Okay, every country has their own credit rating, and this credit rating is defined by a different criteria. For companies, we have different criteria. For companies, when we are trying to identify the credit rating, we consider the criteria like their uh, profits, their equity, their debt, existing debt, okay, their operational efficiency, their business model. A lot of things are taken into consideration. Then macroeconomic factors like the state of economy, the state of industry, the how the company is performing in that. Okay, all these things are taken into consideration. Okay, but when it comes to countries are not businesses, right? And so the parameters that we use to find the credit ratings for companies cannot be applied on countries. Okay, in fact, countries, the purpose of loan also, the purpose of bond issue is also slightly different. Governments generally issue bonds to, let's say, to finance some capital expenditure or to do some kind of construction work. Okay, which will in the future which is in the future going to provide some kind of return to the bondholders. Okay, so that's why these country risk also needs to be assessed, and the factors that are generally considered are mostly the macroeconomic factors like the GDP, for instance. Okay, their social security commitments, their existing debt, of course, which is measured in the terms of debt to GDP ratio. Then the political risk. Okay, then there are risk related to the laws and regulations, rules and regulations existing in the country. So the factors become different, and these are the factors that we assess when we try to understand what the country risk is. Okay, so let's start our discussion on the country risk. So evaluation of risk, first thing and the foremost thing that anybody looks for while investing in a country is their GDP growth rate. Okay, and it is the most important one. It tells us how the country's economy will react to economic cycles. Okay, So for example, if you talk about developing countries, so yeah, developing countries do show strong GDP growth rates when during stable time periods. Okay, but when there is a crisis, some kind of crisis, we see large declines in the growth rate of GDP for developing countries, especially. However, if I talk about certain examples, like we saw most recent crisis we had was the COVID crisis. Okay, the COVID-19 crisis. So at that point of time, a lot of developing countries struggled actually. Okay, in fact, for some period, if you look at the GDP growth rates of India, also it went to the quarterly growth rates. I would say it went to as low as 27%, minus 27%. I would say not 27, minus 27%. But yeah, it recovered. And not only the nature of the nation, like whether it is developing or developed, there are other factors also that needs to be considered. That's the reason. But first thing that anybody sees is the GDP growth rate. Okay, and that's the reason that whenever we are making an investment in developing countries, we should be worried about this thing, that at the time of crisis, will this country be able to survive or not? Okay, and in other words, you can say that generally developing countries are perceived to be more risky when compared to a developed country. Developed countries show smaller growth rates. Maybe if you talk about US economy or some European economies, they show a growth rate of 1%, and maybe in sometimes in numbers which are just greater than zero. Okay, but that does not mean that they are not growing. Like their economy is like huge. Okay, so even a small increase is translates percentage increase. GDP growth rates are percentage increase. So even a small increase translates into trillions of dollars actually. Okay, so I'll give you an example. So if I talk about the US economy, or right now, although China is developing, but their economy is like very large. Okay, or GDP is very large. So when you see those things, even in the case of US economy, let's take the example of developed nation only. So even an increase of 1% can give rise to a capital addition, or GDP addition of somewhere around $500 billion or $1 trillion in this range. But for India, 1% is nothing. Even for India, if let's say the GDP growth rate is 10% or something like that, it will contribute to not more than 300 or $400 billion. Okay, so that's the difference. So it's very important to understand the GDP growth rates. Next, what we have is the political risk. Now, the next thing, once you see the GDP, okay, the GDP is doing good or doing bad, whatever. Okay, once you have decided that, okay, GDP is good, then the next thing that you will see is the political risk. What is the political environment within the country? And there are multiple facets of political risk. First is the government type, the most important one. There are two types of government: authoritarian government, and you have the democratic government. Now, each have their own pros and cons. And trust me when I say that there is no empirical evidence to prove which type of government is better. Okay, there is no empirical evidence. There are mixed results. Some say democratic governments are better. Some say authoritarian governments are better. But nobody can say precisely that, okay, this is better than this one. Okay, there is a still debate going on. But but there are certain features of each of the government types. So let's understand that for authoritarian governments, the thing is, like, if there is a policy related to business, we are talking about business, so we'll focus on business. Let's say there are certain business policies of the government, authoritarian government. So we know that since it is an authoritarian government, the same policy will last for a longer period of time because the leader is not going to change. But when there is a coup, let's say in the country, or when there is a, let's say, a transition of power from one party to another, then you will see a drastic change in the policy. So the thing is, over a very long period of time, you have a similar policy. So you can, like, for example, let's say it's an expansionary policy and it's doing good for the economy. So over a long period of time, things are going good. People are investing, all are like, okay, yeah, it's good, it's good, it's good. But then all of a sudden, government changes and all hell breaks loose, kind of thing happens. Okay, now all of a sudden you'll have to take out your money of it. Panic will be there in the market. So there is a sharp discontinuity, and that's real problem. Okay, but in the case of democracy, if you see, the governments do change often. Like in India, if I talk about, the government change every 4 years, 5 years, something like that, and but they have less impact on the policy. Okay, so like the policies are made, and maybe one government feels like, okay, this is not something that we would want, so we would replace it with something else. Okay, so policy fluctuation can happen. Now, it's which is better, it's still out there for debate, that which government style is better. So I'm not going to comment on that. It's just that I'm showing you what are the pros and cons of each government type. Next, you have corruption. So corruption is a big issue. You see why it's a big issue? Because let's say there is a US company, okay, and it is operating in some African country. We know that in African countries, there are some African countries, I would say, for example, let's say Syria or something like that. Okay, there is huge corruption. So what will happen? In fact, I should not name any country specifically because it's not good to say that. But let's say country B is there, which has very high corruption. Okay, so what happens that in order to operate in that country, the US company actually bribes the officials in that country B. Okay, now what happens? Let's say there is an inquiry is done, and in the US, the country is found in this corruption charges, so they will be fined. It will lead to a loss of reputation for the company. Okay, and ultimately, it's problem for the business. It's kind of losses, right? If the companies are fined like in millions of dollars, billions of dollars, that's a loss for the company. All of a sudden, you have to pay so much amount of money to a government just because you paid $1 million to some corrupt official. Okay, now you are ending up paying like billions of dollars in fines. So that's again a problem. So corruption needs to be understood, and bribery, and then is kind of an implicit tax that is paid. So one way in which corruption affects is the implicit way, direct way. You can say that if I am paying bribes in order to set up a factory or in order to get some kind of permits, so that's a cost for the company, right? And this reduces the profitability. It's a direct. Then you have it can lead to losses if prosecuted. If there is a prosecution, let's say the company is found guilty, then they will be fined. So for this, what happens? Companies do take into consideration. There are some institutions, some organizations, some NPOs, which produce these list of countries that how corrupt they are. They produce certain kind of index. Okay, like Transparency International is an institution which provides corruption index. It rates the countries based on the corruption level in them. Okay. So more corrupt countries, if the country is corrupt, if let's say you read the corruption index and the score means that if the score is low, it means more corruption. So if let's say you see a country which has low score, that means there the corruption is higher. If you see a higher score, there the corruption is low. Okay. Next, you have the violence. Again, this is another concern that you should be worried about. Let's say there is a country in which there are frequent violent things happening, maybe some kind of terrorist attacks, maybe some internal conflict going on within the country, maybe some kind of insurgency, okay, things like that. So this leads to high insurance costs. Now, if you're operating in a highly violent environment, so there is a chance that, okay, there will be too much violence on the streets. Maybe your office buildings gets destroyed, maybe your inventory gets destroyed, things like that. So companies usually what they do, they take insurance on these things. Now, since insurance companies are also very well aware that they are asking for insurance where the chances that there will be a loss is very high. So they will charge a high cost insurance premium. We have studied it in insurance chapters. Okay. So these are the things that can happen. And also another thing is that it can make the working environment difficult. Let's say there is a country in which there are a lot of strikes happening. Okay. So the company offices are not operating at its full potential, thereby reducing the profitability from that factory or from that branch. Okay. And for this, we have another index, which is the Global Peace Index, which measures the level of violence in any country. And low score here means low violence. Now, from the examination perspective, if you'll ask me, you see in this chapter, we are going to see a lot of indexes. Okay, indices that are used to refer about the relative riskiness. Okay, based on different parameters, be it corruption or violence or anything. Okay, so each of these indices have their own way of saying things. So for example, in the case of corruption index, the thing that was happening was low score means more corruption. Okay, high score means low corruption. But in the case of violence index, global peace index, low score means low violence. Okay, so you need to understand these tricks here. Okay, these things, these differences across the indices, how good and bad is measured. Okay, and in the examination, you will be tested on these things. Okay. Next, you have nationalization. Again, nationalization is an issue. For example, let's say there is a bank operating in a country. You know, all of a sudden there is a government change, and that government decides that no, I want to nationalize all the banks. So what is the loss for the company? They lose those branches. They lose all the assets in that country. Everything is lost to the government. Okay, so that's again an issue, and nationalization can create problems for the companies to operate. Next, we have the legal risk. Legal risk includes that if you're a company, you might get involved into legal disputes. And mostly these disputes are related to financial issues, finance issues. So maybe somebody stole your intellectual property rights. Maybe somebody stole some kind of physical property. So how easily the things can get the other party, the actual culprit can get prosecuted, and how easily you can get things back, your compensation is you are given. These things are taken into consideration when we are talking about legal risk. So in the case of legal risk, there are three things that need to be considered. Legal and political index is there, which tells us about three things: rule of law, political stability, and control of corruption. Okay, the legal and political index talks about three things: rule of law, political stability, and control of corruption. They rate countries based on three parameters. Then you have physical property index. Okay, this talks about property rights, how easy it is for you to register for property, how easy you can get loans. Okay, ease of access to loans. These things are considered in physical property index. Then finally, you have intellectual property index. There are certain intellectual properties. Let's say you have some patent rights, something like that. Or let's say you have a technology, and all of a sudden, if somebody does a piracy things on that. Okay, intellectual property protection, patent protection, copyright protection, how strong these measures are. If let's say my copyright has been breached, let's say somebody else copies something that I have been doing, so I can make a copyright claim. For example, in this case, let's say this presentation that I'm using, it's a copyright of Midhaven, right? So if somebody else uses the same PPT, so I have like my copyright issues, right? So do I get the copyright protection when I go to the court of law? Then will I be able to sue that person and bring that person to justice who um, unauthorized, who in an illicit way, or you can say in an illegal way, used my properties without my permission? If there is my permission, there is no doubt that's not a copyright breach. Okay, but if they use it without my permission because it's an intellectual property of Midhaven, so is this right protected for me in this country or not? So these are the things that is assessed. And for all these indices that are there, large score means the better system. Okay, so large score for the rule of law, for the property rights, physical rights index, or intellectual property index signifies that there's a better legal system in the country. Okay, if it is a low score, it means a poor legal system is existent in the country. Next, we have the economic risks. So economy is also something that needs to be assessed properly. And when we talk about economy, first thing comes to our mind is the GDP per capita. Okay. However, it's not the complete picture. From businesses point of view, GDP per capita is of use, but is of very little use, I would say. Okay. Then the most important thing is to understand the competitive advantages. Okay, so what are the competitive advantages? Like the factor conditions. What are the factors? When we assess in equity analysis, there is a thing which we call fundamental analysis. There competitive advantage is assessed, and there are multiple methods to do it. Like SWOT analysis is there, five forces analysis is there. So factor conditions, what are the factors? What are the different factors that can have an effect on the company or on the economy overall? Those are assessed. Then demand conditions. How is the demand? Like what kind of products are demanded there? If let's say there is a country, okay, and that country is asking for an infrastructure loan to build some kind of road project. Okay, now we know that that country is developing infrastructure, and if the infrastructure is developed, then they will be able to the transportation of goods and services will become very easy. So you need to see that what is the demand of it, okay, in the country. Finally, related and supporting industries. What are the industries that are there existent, and how they are related and how they are supporting it? So for example, let's say you are assessing a single industry, a specific industry. So what all other industries are related to it and how they are supporting it? Okay, these are also the things that we need to assess. And finally, firm strategy, structure, and rivalry. You need to see that what is the firm's strategy within that economy, what is their structure, who are their competitors. All these things need to be considered. Finally, economic diversification. You see, economic diversification is something that is very strongly looked upon, and in fact, any country wants that their economy should be diversified. If your economy is dependent on only few products and services, then it's a problem, because if there is a crisis, you will be badly hit. Okay, so you should keep, and especially for developing countries, it's a real problem. For developed countries, they can build up economies, they can build up, they can diversify their economy very quickly. But for developing countries, it can be difficult. Like for India, if I talk about, here we are still struggling to fully develop, or you can say to bring our manufacturing potential to its highest level. Okay, and we are struggling because we are not a developed country. Okay, we have to take out our resources and put it to different places as well at the same time. So that's where we are struggling. But still, I would say India is still by far the large economy. Okay, it's to an extent greatly diversified, I would say. Okay, Now, large economy pose less risk than smaller economies. Smaller economies, again, if I talk about countries like small economies which are dependent on only few sectors, like Middle East countries are there, which are mostly dependent on oil. Okay. Or let's say economy of in the Indian subcontinent, if I say, like, there is Bangladesh, who is mostly dependent on freelancing. Nowadays it has emerged as a prime sector, prime industry. Then there is textile. Okay, so there are only few industries on which it depends. In India, if I say, there are multiple economies. We have IT. Okay, we have technology, we have fintech. Okay, we have now defense industry is also developing to an extent. We have manufacturing, although it's not too large, 17-18% contribution, but yeah, it's huge. Then we have agriculture. So we are to an extent diversified. Okay. Next, large economies can broaden their base easily compared to small ones. Now, if you talk about India, when I compare it with other smaller countries, then for India, it will be comparatively easy. Like if you talk about in the technology sector, like we are in the phase of, like, bringing in the chip manufacturing in India. So for India, it is comparatively easy than we compare it to, let's say, Bangladesh. Why? Because they are small. Okay, they don't have that much capital to infuse in. Like, governments can in India, governments have announced, like, incentive link programs. Okay, incentive link production, incentive link, there are incentives if you do produce in India and do sales. Okay, so these are the things that they can do to attract consumers. They can ease out the taxation. But for small economies, it can be difficult, because taxation is a main source of income for the government. If they are taxing less, then their income will be less. So these things pose problem. Now, the total risk. So the services that are there, they basically, there are certain services that formulate a reliable composite risk measure. Okay, that is actually equivalent of VAR, or expected shortfall, for the countries actually. Okay, so basically they try to build a composite picture. Okay, taking everything into consideration, they are saying that, okay, you see, this is the country, this is the default risk. Okay, that's really difficult to say, but there are certain entities, certain institutions, services that they do it. Okay, for example, you have PRS, political risk services. They use 22 measures, which include political, financial, and economic risk measures, and they calculate an index. Okay, now individual firms can then just customize the PRS forecasting according to their own requirements. Okay, they can manipulate some of the variables. Maybe they can remove some of the variables if they are not concerned about it. Okay, for example, if it's a finance company, so maybe they're not concerned about, let's say, happiness index, and let's say hypothetically that it is included as one of the measures in the PRS. Okay, so they might customize it according to their needs. That's what I'm trying to say, the whole crux. Next, you have media outlets. There are certain media outlets like Euromoney, The Economist. They also present a measure of country risk, that what is the risk in this by investing in this country. Okay, and then finally, ultimately, you have the World Bank, which provides an outlook about which country is better, which country is not better. Okay, now for total risk, we have their limitations also. The first and foremost limitation is that scoring methods. You see, services use different scoring methods. Different services will use different scoring methods. There is no standardization. So we saw also in the previous indexes that in some scoring methods, a low score meant better performance, but in some, high score means better performance. Okay, so scoring methods in the same way here also is not standardized enough. Okay, then standardization, like scoring countries is not standardized. There are certain conventions which are not standard across all the countries. Okay, or across all the risk factors. So that's again another problem. It becomes very subjective. So if there is a bias, okay, so that can lead to problems for the company. So there will be a biased estimate about the risk that is being perceived for a country, and that can lead to problems for the country itself. And again, it's a missed opportunity for let's say the investors also. No, so if, let's say, in a biased way, the services, since they are not standardized, okay, so they have no set criteria. That means that they have no set criteria as to how they are saying that political risk is high, or let's say intellectual property right risk is low. They have no set criteria that how they're deciding it. So that's create problem. That is another thing that creates problem. Next, misleading scores. Misleading score means that if, let's say, there is a country, there are two countries, one has a score of 60, another has a score of 30. So that does not mean that the country with score 60 is twice as risky as the country with score 30, just because the numbers are double. Okay, again, this is misleading. So you can't say that, okay, if the score is double, the risk is double. So that's another problem. Okay, so these are the limitations because of which what can companies do, that they take into consideration everything. They look into the all the indices that are there, they do take services from these service providers. They also take their inputs, and then they try to build a holistic overview about a country, that how worth is it to invest there. Okay, next, sovereign credit risk. Sovereign credit risk means that if you are investing in government securities, what is the chance that the governments will default? Okay, that's what we call sovereign credit risk, government default risk. Okay, there are two types of government defaults. One is the foreign currency default and another one is the domestic currency default. Okay, now although it seems unlikely that how a country can default in its own currency debt, but yeah, it is possible and it has happened in the past. Okay, so, and if they do not default, we have severe scenarios also happening. Like if you go back to the Germany in the early 1930s or something like that, just because to pay off the debt, they produced more and more currency. The inflation went went out of the world, I would say. Okay, and that was one of the reasons that created so much resentment in the German people. And I'm not going to talk about that, but yeah, there is a possibility that you can actually default on domestic currency also. Now, foreign currency default means you have issued bonds, let's say securities in foreign currency. So Indian government issues bonds in dollars. Okay, so what will happen here is that when these bonds are sold, government of India will receive dollars in return, not rupees. Okay, here example has been given for default is that Greece during the period of 2010 and 2016, there was a huge crisis going on in the Greece. Okay, the government had defaulted. Now, what is the risk? Risk is that the debt cannot be repaid by printing money. Here, the biggest problem is that the government cannot print money because it's a foreign currency. Indian government cannot print dollars, or let's say Japanese yen, or let's say euros or pounds. India cannot print that. India can print Indian rupees. Okay. Now, most defaults involved exchange of old for new bonds with some NPV loss to the lenders. Now, in this case, since money cannot be printed and since it's a foreign money, okay, foreign currency, so investors are not left with many options there. Okay, so what they do, they sit with the government, try to renegotiate the terms. Old bonds are retired, new bonds are issued with higher coupon premium because they have defaulted, right? So there is some net present value loss. The value of the loan is deducted to an extent. Interest income is increased, and then the bonds are reissued. So basically, it's called restructuring. Okay, the bonds are restructured and it stays there in the market. Okay, they are not called back. That's not possible because if they have defaulted in foreign currency, it simply means that they don't have foreign currency. Then only they defaulted, right? They don't have foreign currency in their reserves. That's the problem. Now, what are the factors that can have an effect that can lead to foreign currency default? There are multiple: political, economic, financial. A lot of factors are there. Okay. Next, what is the effect? So in long term, not so much effect, not because it has been seen historically, empirical evidence are there that the world is forgiving in the long term. Okay, they forget about these things. They feel like, okay, now it's the time. Okay, let's go ahead with it. What happened has happened. What has happened, it was the thing of the past. Now let's move forward. But in the short term, it creates problems. Okay, we'll see what are the problems created, but first let's talk about domestic defaults. Domestic defaults are like you have issued bonds. For example, if Indian government issued bonds in Indian rupees and they default on that bond, so that's a domestic currency default. And it has happened in the past. For example, in 1998, Russia defaulted on their own debt obligations that was issued in Russian rubles, and Brazil defaulted in 1990 on their own debt. Okay, now difficulty is it is difficult to identify the reasons for default. It can be anything. Okay, maybe some policy going bad, maybe the state of the economy, maybe some war going on. It can be anything. It's very difficult that why this happened. It's difficult. And here one would argue that printing money is one of the solutions. So why not print money? In fact, reckless printing is not at all advisable. It can lead to very high inflation, exponential inflation. We have seen a classic example of Germany during the Great Depression that happened in the 1920s. Okay, we are aware of it. What happened? In fact, in Germany, the scenario was to buy one loaf of bread, you had to bring money in a 50 kg bag, in a bag with a capacity of 50 kg, full with money. You have to bring that to just buy one loaf of bread. So that was the scenario. That was the state of inflation in the state of in Germany at that time during the Great Depression. Okay, so printing money is not the solution. Not the only is not always the solution. So why is that? Because backing currency, there are gold bullion standards. So usually what happened in the past, if you had to issue more currency, you had to put in more gold reserves. Okay, so that limits the ability to print currency. And if let's say you don't increase the gold reserve and keep on printing money, that will reduce the value of your money. Okay, then countries don't have the right to print shared currency. Sometimes there are shared currency, like for example, if I talk about euros cannot be printed by all the countries. It is a shared currency. So in that case, it becomes difficult. And printing more money in very short term, exponentially, like in indefinite printing, can actually lead to high inflation. However, in short term, just to navigate slightly, printing money can be one of the solutions, but not the only solution. Okay, it's not the only solution, it's one of the solution, and it's a double-sided sword. So while printing money, governments are usually very careful as to why they are doing it. Okay, now sovereign currency risk, impact of default. So what happens when the currency defaults? Okay, so generally restructuring is done, principal is lowered, interest payments are lowered, or the life of bond is extended. So let's say the bond was about to retire in the next 5 years, so they extend the life to next 10 years. Okay, so that company gets a breathing space, country gets a breathing space, they can develop their economy. And there are restrictions also, there is no doubt, but they can develop their economy so that they're in a better position to pay off the debt in the next 10 years. Okay, so what are the consequences? In the past, usually the consequences were military action. Okay, in the past, but these are the things of the past. Now it does not happen. It never happens. Now loss of reputation is the first thing. Investors lose confidence in the country, so it becomes very difficult for such countries to raise new loans. Okay, then we have weak banking system. Actually, the spelling of weak is wrong here. Ignore that. Okay, weak banking system. That is, oh no, it's correct. Sorry, it's correct. No, it's wrong. It's wrong. Week is it's the week, that means the week, Monday to Sunday. Okay, the weak banking system. You see, banking system becomes fragile. Their financial system, basically financial ecosystem, becomes very fragile. Then you have decrease in exports. Now, since they are in default, so people don't want to do businesses. The local businesses do suffer. Their exports, because of this, will definitely suffer. Then you have credit rating downgrade, which actually increases the credit risk. Again, loss of investors' interest. Political instability. If the country defaults, it's a loss of reputation. So people do feel it in their home also. Like inflation is rising, it's difficult to buy products, their standard of living decreases. So there is a lot of resentment in the people, and which can lead to ultimately the change of government. Usually it is seen that whenever like Russian example, for example, Russia 1998 crisis. So the moment this default happened in 1999, we know that the Russian USSR disintegrated, and the world that we see right now with Russia and all the satellite states that is there. Okay, it came into existence. So political instability comes into the picture. Then economic downturn, the company's GDP and all the other things, parameters like unemployment rate, literacy rate, all these things start to decline. They take a downward swirl. Okay, and then investors' unwillingness. Now, if you have so many bad things happening in your economy, finally you will see investor unwillingness to invest in your country, right? So that's the thing. Now, what are the factors that affect sovereign default risk? Okay, so when let's say a company is assessing the sovereign default risk, so what are the factors they should consider? In the case of companies, it was like profitability, sales, business model, things like that. But what is it in the case of countries? So first thing is total indebtedness. So they see that what is the existing debt, current debt of the country. If it is too high, it means high default risk. If it is too low, it means low default risk. Then next is social security commitment. Social security commitment means government spending in welfare schemes, like compensations of some kind, or let's say a subsidy of some kind. These things come under the social security commitment. Pensions that are being paid. So high social commitments, the higher these social security commitments are, the higher the default risk, because a lot of money is going into current expenses. You see, these are the expenses that are not coming back, that will not give you return. If investment is being done more on, if let's say, although the debt is high, but let's say the investment is being done, a lot of investment is being done in capital, in the form of capital. Okay, let's say roads are built, shipyards are being built, ports are being built. So these are airports are being built. So these are the things, railway tracks, these are the things that will produce revenue in the future. So that's not bad, because there is a potential of earning revenue out of them. But when you are into social security commitments, let's say you're giving freebies a lot, that's a bad news. Once money is gone, it's gone. Okay, you're not going to get anything in the future out of it, except for the votes, few votes. Okay, so higher these commitments are, higher the default risk is there. Okay, next you have the tax base. They also see the tax base, how stable it is, how reliable the tax base is. If the taxes are fluctuating regularly, if the government fluctuates the tax base regularly, then that's not a good sign. That's not taken as a good sign in the international market, and it may lead to scenarios where people are unwilling to invest. Okay, finally, political environment, important to see how the central bank is performing in context to the government. What is the independence level? If, of course, no country gives complete independence to central bank, there is some influence of the government, but to an extent, they should be allowed to do it at their own way. Okay, for example, in India, I can take a very recent example that has happened. Measures to control inflation. Yeah, government can give orders directly to the central government. So it was it was said that we need to ensure that the inflation rate in India is somewhere around 3 to 6%. Okay, and they were given free hand. So that's a kind of independence. Like, what decisions can the central banks directly make during the time of crisis? That is something really important. Or is it all the time that the government will have to intervene in order to manage the crisis and all? These are the things that are assessed there. Then there are certain implicit guarantees. Now, these are not direct backing. So, for example, let's say UK. Okay, let's say UK. Although UK is a very good is in a very good position itself, but I'm just taking an example because I need to explain the implicit guarantee. Okay, so let's say UK is there, and then you have the US. Let's say UK wants to issue a bond. Okay, so there is, in one way or another, there is an implicit guarantee by UK that, okay, some UK is behind this country. So if anything bad happens, these are very close allies, UK will come to its rescue. Okay, so these are called implicit guarantee, but it is not said publicly. Okay, nobody is saying, neither UK is saying, neither US is saying that, okay, I am vouching that if UK does not pay, I'll pay. These are not happening. But we know that when the crisis will come, these guys are there. This country has some buddies which will help them, okay, out, and maybe I'll not lose all my money. So implicit guarantees actually build confidence. Okay, next we have credit spread. So till now, what we were doing, we're talking about the different indices and all. So all these things take into consideration historical data. Okay, but credit spreads are more real time. Okay, so credit spread for a sovereign debt in a specific currency is the excess interest paid over the risk-free rate in that currency. What does it mean is that, let's say India plans to issue government in US dollars. Now US risk-free rate, let's say for a 10-year US bond, the coupon rate, I'm just taking a very layman example. In fact, it's a risk spread. That means I have to take into consideration the yield to maturity. So let's say a US treasury bond has a yield to maturity of 4% per annum. Now, when the Indian government issues a bond, let's say it issues at 5% per annum. So this 1% extra interest that is being paid, and of course this interest will be paid in dollars only, okay, because the bond is denominated in dollar. So this 1% extra interest that is paid is called the credit spread. Okay, now credit spreads are very responsive to current market scenarios. They can change, and the source of credit data is CDS market, credit default swap market, okay, which are traded on countries as well as on corporations also. So CDS, in fact, very recently something happened. If you remember Credit Suisse, okay, there was a crisis. Its CDS spread went skyrocketed. Things like that happened because of certain crisis going on, cocoa bonds. Okay, so CDS credit spreads are taken from there, CDS market. Okay, now the problem with CDS is that they are speculative in nature. People can speculate also, and in fact, during the Greek default that happened in 2010, speculators were blamed partly because they speculated that, okay, Greece is going to default. So let's buy CDS, or that it will default by CDS. So that spread skyrocketed there. Okay, so that drove the credit spread for the bonds, and it became very difficult for the Greek government to meet out those obligations, and finally defaulted. Okay, now what are the advantages of credit spread? First advantage, they are more granular. They respond quickly to the recent events, ability to adjust more quickly to new information. Okay, and what are the disadvantages? More volatile than ratings. Ratings are stable, more or less stable. At least in the medium term, they are stable. But credit spreads, it can change within months. Okay, it can skyrocket. Then irrelevant factors such as liquidity, investor demand, speculation, these can have a serious effect on the spreads. Okay, so yes, one should rely on a spread, but again, there are other factors that need to be considered. So with this, we have completed this chapter. Now, just give me a minute. I'll open the next chapter and then we'll start. Yes, so now we are going to start with measuring credit risk, that is VRM 6. Now in this chapter, so you see in the last two chapters, what we did was we tried to understand the credit risk ratings for both corporations as well as countries. Okay, now in this chapter, we will see how this credit risk is actually measured. Okay, I'll just keep it rough. Precisely, there are a lot of things that need to be considered. So just for the time being, giving you a basic idea. So let's say that you looked into the probability of defaults given by the rating agencies for corporations. Okay, let's talk about corporations. Now you are a financial institution who has given loans to many corporations, big financial institution. So now you want to find out what is your credit risk capital or what is the credit risk for this loan portfolio, which comprises of 3-4 loans from two big parties. Okay, so what you will do, you will look into their default probabilities at its crude way. In the very initial phases, what you will do, you will go to the rating agency's website, you will find their default probabilities, then you will use it to identify what is my credit risk. So here our objective is that we now have the default probability or the loss distribution that we call it, and then now we will understand how we are going to I would say find out the credit risk capital. Okay, so that's the whole agenda of this chapter. Now let's start. So first, whatever risk a bank is taking, actually they are required to keep a capital provision. Okay, in fact, be it any kind of loan they are giving, they have to maintain a capital. Okay, so that in the event of losses, these capital can be used to cover up the loss. Okay, so what happens, bank actually, the capital of bank actually comprises of two things. This is a part of capital structure. So what happens is that one might say that why take loan. In fact, it has been found, and it is true in fact in reality, that if you want to reduce the cost of capital, okay, so you need to form a capital structure, formulate a capital structure which is a mix of equity as well as debt. Because on equity, if it's the company is doing good, you will have to pay a lot of interest in the form of dividends and returns, that all. But for debt it is fixed. Okay, if you're paying 10%, it will be 10%, no matter how good your earnings are. Okay, so that's why companies want that their capital structure should be an optimal combination of debt and equity. And always remember, debt capital is subordinate to deposits when we are talking from the perspective of banks. So for banks, when there is a crisis, the first people to be saved are the depositors. Okay, that means deposits should not be affected at all. Then debt comes into the picture, and then finally equity. So equity is basically, that's why we call it residual claim. Equity is basically the residual claim. What is left is for the shareholders. So that's why we require risk capitals in order to say that if the bank is doing their day-to-day operations, okay, let's say they are lending out money, so they have, even no bank can say that I'll have zero defaults. Okay, there will be few people who will default. Okay, so they need to have that capital to sustain these defaults. That means they are able to meet up, because when depositors will ask for their money, and if let's say loans have defaulted, so where they will get that money? So they need to have certain capital with them. Okay, now credit risk has traditionally been more important, the most important risk taken by the banks. Credit risk is the most important. Credit and market, these are the two most important risks assumed by a bank, because these are related to their main business activities. Market risk, because they are into acting as dealers for different kind of securities, and also they are exposed to market risk. They also trade for themselves, they're exposed to market risk. Credit risk, because their main business activity states that they are asking for deposits, they are taking in deposits to lend out money. When they are lending out money, there is a chance that the borrower will default on their obligations, thereby giving rise to credit risk. Okay, so now let's understand the model for determining capital. So the credit risk capital, once you have the loss distribution, so you see what this distribution here is basically loss, and precisely loss over 1 year. So once you have estimated the loss distribution, you need to find what is the expected loss, and then you need to find at a very high confidence level that what is the loss at that percentile, okay, or that high confidence level, loss at a higher confidence level. And then the difference of these two is called the unexpected loss, which is actually your capital, risk capital. Unexpected loss is your risk capital. Now one might say why we are not considering the expected loss. In other words, why we are not saying that the amount that I see here is my loss, is my capital. Why the difference between these two? The reason is banks usually charge the expected loss on their interest rates. Okay, usually charge expected loss on the loans interest rate precisely. Okay, so if let's say bank is giving out loans and it is charging 15%, so this 15% actually includes expected loss. Okay, and we will see how this is done. But first, let's see that usually this X percentile of the distribution is very high, and X is usually set at 99.9%. So what they do, they calculate the expected loss and they calculate the loss at 99.9% confidence level, and they take the difference of these two numbers. This difference acts as the credit risk capital. Okay, and it is for the internal ratings based approach if the bank is using their internal model. Okay, now let's see how this expected loss. I said that expected loss is actually incorporated in the interest rate. So how it is done? So we know that expected loss is simply if we are talking about expected loss in percentage terms, not in dollar terms. In dollar terms, it is exposure at default that is multiplied. Okay, so it's simply probability of default times the loss given default. Okay. Now, if suppose the probability of default is 1.25%, recovery rate is 60%, and exposure at default is $5 billion. Okay, what will be my expected loss? In dollar terms, it will be 0.025 billion or $25 million. Okay, next, in percentage terms, it is 0.5%. Okay, in percentage terms, it is 0.5%. Now, let's say there are costs when when a loan is being issued. So usually what happens that they have first they estimate that what is the probability that the borrower will default before even giving out the loan. Okay, and then they calculate what is the expected loss if I give out this loan. They find that this expected loss is 0.5%. Now they have made up their mind that okay, I want to give the loan. Okay, so this expected loss is there. This is the money that I can on an average lose. Okay, so now they need to raise the capital. So let's say they take in deposits. On the deposits, they are paying 2% interest. So this 2% will be added to 0.5. Okay, and let's say throughout the process, there will be a lot of costs, operating expenses that has to be covered. And let's say that turns out to be 2.5% of the loan amount. Okay, or 2.5% in general. So in this case, and here the bank is not making any kind of profit. So in this case, the bank will charge the interest rate, break-even interest rate, I would say. This interest rate is break-even interest rate will be 0.5% plus 2% plus 2.5%. That is 5% interest rate. Okay, now on this interest rate, bank will usually add some credit spread, which is usually done. And then they will add their profit margin, which is again done, which can make it to as high as 8 to 9%. Okay, depending on the nature of the loan. If the loan is secured, yeah, 8 to 9%. But if the loan is unsecured, it can go to like 20%, 25% also, depending on the credit worthiness of the borrower. Okay. Now, as you can see, when I'm charging the interest, let's say the bank charges the interest of 7% on the loan. Okay, so this 7% actually includes the expected loss of 5%, right? So I have already covered the expected loss on the loan itself by charging a higher interest rate. Now I'm only worried that what if even after charging the expected loss, what if the loan defaults? So what is the what is the more capital that I need? So I have estimated that with 99.9% confidence that my loss will be, let's say, my expected loss is hypothetically, let's say, $1 million. And I estimate that my worst case loss will be, let's say, $10 million. So the difference is 9. Okay. So from where will I get this $9 million? So if let's say I have no credit risk capital, this $9 million loss is a problem, right? So that's why we require a capital. And in this case, the capital will be worth $9 million. Okay, that will be charged. Now, mean and standard deviation of credit losses. Okay, so suppose that we have a bank which has N loans and following other terms that are defined. So LI is the amount borrowed for the ith loan, which is assumed constant throughout the year. However, this is not true because we know that EMIs will be paid and the principal, the amount borrowed at the start of the year will be different than the amount borrowed at the end of the year, the final amount. Okay, there will be a difference because EMIs are paid. So some principal is paid over the period of 1 year. However, for the sake of convenience, here we are assuming that the loan amount is constant. Okay, and LI is the value of one loan. And let's say we have N loans. So L1, L2, L3, L4, all are different loans and all have their value. Let's say for the time being $1 million. Okay, all are $1 million. Now PI is the probability default on the ith loan. So let's say probability of default of loan 1 is 2%, loan 2 is 2%, loan 3 is 2%, and so on. Again, here we are making an assumption that PI is same for all the loans. That means the loan portfolio that I have comprises of similar types of loan given to similar people. They have same maturity, everything, same loan amount. RI is the recovery rate. Now, since the probability risk is same, so recovery rate is also same, and it is known with certainty. So because this is something that again create problems in practice. Things are not that easy. That is that it looks when we are reading the theory. The thing is, recovery rates vary. When let's say there is one default, so we can say that okay, recovery rate is 65%, but all of a sudden 3-4 default happens. Recovery rate can go to as low as 30-40%. Okay, loss rate can increase. So recovery rate can vary, and that's why here it is written clearly that it is known with certainty. Then you have the correlation between the loans. So we know that loans are related. If one loan default, the probability of default for other loans will get changed because it's a homogeneous portfolio. I said that all the loans are similar in nature. Okay, or in other words, exactly the same. So there is a correlation, and rho ij is the correlation. Then you have sigma I, that is the standard deviation of loss from a single loan. What is the standard deviation of loss from one loan? That is sigma I. You have sigma P, that is the standard deviation of loss from the portfolio. What is the volatility of loss from the portfolio? Portfolio of, let's say, 1000 loan or whatever. Okay. And then finally you have alpha. Alpha is the standard deviation of portfolio loss as a fraction of size of the portfolio. Alpha is a more reliable measure. So you can say that, okay, if the standard deviation is 2%. Okay. So that means it's simply the standard deviation, the volatility. So the loss is the volatility of loss is 2%. But alpha, it tells us compared to the size of the portfolio, what fraction of money is lost. Okay, that is measured in the terms of alpha. That is the standard deviation of portfolio loss as a fraction of the size of the portfolio, and that is more reliable, or 2.5% of the principal that we call it. Now let's say how we calculate the expected loss. It is simply PI times LI plus 1 minus RI. Okay, then you have the volatility, which is volatility of loss from one loan. This is the formula, PI times PI square times LI square, and this whole thing is multiplied with 1 minus RI squared. Okay, this is your volatility. Then you have the single volatility, which is this formula. Again, it's just the square root of this number. If you just apply it, you'll find the result. Okay, and then finally you have the variance of the portfolio formula based on these let's say if there are n loans and each of the loan has a volatility of sigma square or sigma, and the correlation between the loan is constant at rho. Okay, so this is the formula that can be used to find out the volatility of losses from the loan portfolio. Now the biggest assumption here is that the loan portfolio is homogeneous. All have the same value, all have the same volatility, all have the same default to probability, all have the same correlation, same recovery rate, everything. Okay, so it's a homogeneous portfolio. And the standard deviation of the loss on loan portfolio as the percentage of size, which is alpha, actually is given as the standard deviation divided by the size of the portfolio. When simplified, it becomes this. Okay, now from the examination perspective, if you'll ask me, I would say all these formulas are important. Okay, so they can ask you to find out alpha. They will give you the relevant parameters. They will ask you to find the portfolio volatility, sigma P. They may ask you to find out sigma I, that means loan on one loan, or the expected loss. Okay, so these are the things that you need to take into consideration. Now, let's take an example. Let's say my N is equal to 100,000. That means I have a loan portfolio which comprises of 100,000 loans. Each loan has a outstanding amount of $1 million. It has a probability of default of 1%. Recovery rate is 40%, and the correlation among the loan defaults is 10%. Now I will calculate each of these things. First, sigma. I applied the formula. I find the sigma to be 5.97%, you can say. Okay. Then alpha. It is 1.89% of the loan principal of the portfolio value, 1.89% of the portfolio value. Okay, that's your alpha. Next is Vasicek model. Vasicek model is actually used by regulators to determine the capital for loan portfolios. Now here I have omitted certain things like the Gaussian copula, which is used to build the probability distributions. I have directly switched to VSA because Gaussian copula is, from the examination perspective, not that much important. In part 2, you will study a lot more about Gaussian copulas. In fact, a lot of copula models. Okay, and Vasisek model is also explored in great detail. Here, what I'm going to do is I'm just going to show you that when we apply the Vasisek model, what we get? We get the worst case default rate. Okay, worst case default rate is really important when we are trying to estimate the unexpected losses. You see, if you remember that distribution that I showed in the previous slide, one of the previous slide, there was unexpected loss at a very high confidence level and expected loss. The difference between these two was considered the loss at a very high confidence interval and the expected loss. The difference between these two is the unexpected loss, which is your risk capital. Now, risk capital, you need to find out what is the, I would say, worst case default probability. Then only you will be able to identify what is the worst case loss. Worst case loss. Okay, not the unexpected, not the unexpected loss. Worst case loss. The moment you know the worst case loss, or in other words, a high percentile loss value, 99.9 percentile loss value, you can easily calculate the credit risk capital as the unexpected loss. And the worst case loss is calculated through the worst case default rate, and WCDR is given using this formula, where N inverse PD is the probability of default, that is expected default. Rho is the correlation. N inverse 0.0001 signifies that I am calculating the worst case loss at, or worst case default rate at 99.9% confidence interval. Okay, if in the exam you see a question where you have a different confidence interval, let's say 99%. So this number here will be different. It will be 0.001. Okay, and corresponding to this value, you will look for the you will look in the Z table for the quantile. Okay, so this is the formula, and the unexpected loss is then given as WCDR minus PD times LGD times EAD. Okay, now a catch here that I'm going to tell you is that if, let's say, the correlation is 0, okay, if the correlation is 0, then WCDR actually becomes equal to the probability of default, and your unexpected loss will be equal to 0. Okay, so unexpected loss or credit risk capital makes sense if and only if we have certain correlation, and that's true. There is a correlation between defaults. Okay, so that's how unexpected loss is calculated. Now, from the exam perspective, again, I would say these two formulas are important. So once again, from this chapter, you have a lot of formulas to remember. So there are two chapters in today's agenda that we saw that we have a lot of formulas. First one was the VRM 3, where we discussed EWMA, GARCH model, etc. And second one is this chapter. Okay, so that's the end of this lecture. Now I'll start the next chapter, that is VRM 7. So just give me a minute. Yes. So now we are going to start with VRM 7, that is operational risk. And in this chapter, we will see what is operational risk briefly. Okay. And there are multiple factors that give rise to operational risk. And of course, in part 2, we are all aware that you have a separate module dedicated to operational risk. But in this chapter, we'll have a basic premise of, basically, it's like in part 1, you guys are actually introduced to these things. Okay. Just introduced that, okay, these are the things that you should know. And of course, in the next part, when you prepare for it, we will discuss it in great detail. Okay. So in operational risk, what we actually have is losses. We are actually assessing losses arising because of day-to-day operational activities of the bank or of any institution, any company. Okay. There is typing error, maybe. Or for example, in this case, I was using the slide. If you remember, in the one of the previous PPTs, there was a typing error. Okay, the calculation was something else and it was shown something else. I think it was in VRM 3. Okay, for EWMA calculation example. So that's an operational risk for me. It's a loss of reputation for me. Okay, so that is something that we are going to assess here. Okay, and also we'll see methods of quantifying operational risk. You see, in part 2, when you will discuss operational risk chapters, you will find that initially, in fact, in today's scenario also, it's really hard to quantify operational risk. But still, there are certain measures that we apply there are certain tools that we apply and find out what the operational risk is. Because at the end of the day, you have to have certain tools, although inefficient. Maybe with time, as the time will progress, we'll find more discrepancies, science will advance, we'll have more tools at our disposal, which can then be used to estimate operational risk with greater efficiency. But for now, something has to be done. We say something is better than nothing, right? So that's the thing that is happening. And that's why operational risk domain, I would say, is currently in its evolving phase. Okay, it's comparatively new kind of risk and it's still evolving. It's not as mature as market risk or credit risk, because there we have very strong empirical evidence, we have very strong research papers, journals, models, everything that can be used directly. But for operational risk, things are being tested. They have just started being tested on these things, these existing theories on operational risk. Okay, now let's understand first the operational risk types. So there are multiple categories. First is internal fraud. Let's say there is some internally there is some misappropriation of resources by the manager or by the line head or something like that. That comes under the purview of internal fraud, which can lead to losses. Okay, some accounting fraud is done, and that can lead to losses at the time, because once it is found out, once it blows out, that fraud blows out, then what will happen? Company will lose business. People will lose trust. That's the most important thing for a company to keep running. The trust of the consumers, the trust of the government, the trust of the people, the investors, everybody. Next is external fraud. External fraud means it's not be in external fraud. It becomes dicey, because sometimes it is found that in the external fraud also some internal members were involved, but sometimes they're not involved. They're just deceived by the external party. Okay. So for example, let's say a bank mistakenly ends up making a bad loan. That's an external fraud. Okay. And the borrower takes the money and runs away. That's external fraud. Then employment practices and workplace safety. What are the employment practices? How employees are treated? How safe the working environment is? All these things are considered. Again, this is something which is not easily quantifiable. Okay, employment practices and workplace safety. And these are the reasons why we say that operational risk and quantification of operational risks become difficult. Internal, external frauds, to an extent, it can be done. But there are other risks, other measures, other factors which lead to operational risk that are difficult to quantify. Okay, so I'll give you a simple example. Let's say an employment practice. So we talk about fair treatment of all people. Okay, companies do promote, if you'll open the websites, they are very specific about these things. They're very careful about these things when they are talking about people and all their personal information. Okay, a lot of things, they are very careful on these things. So what is the consequence if, let's say, there is something there is some employment practice which hurts sentiments of certain group of people? So they might go after this company, and maybe some litigation is there that will lead to costs. Nobody know what the cost will be in the first place. It is possible that maybe the company is fined. Again, nobody knows what the amount of fine will be. Okay, so that's why it's difficult to quantify these things. Okay, then client, product, and business practices. Maybe due to some client issue, client handling issue, some product issue, some business practices that the company is into, they lead to losses. Okay, these are business practices, means the way they are doing things. Okay, not the product they are selling, not the sales. Okay, the way they are doing business. Okay, that can lead to losses sometimes. Now, damage to physical assets. Again, this is something which can be quantified to an extent, but again, there is problem. Okay, business disruption and system failures. Now, again, this is something which is difficult to quantify as to what amount of risk will be. So, for example, let's say these banks, big banks, have a strong, robust IT infrastructure. Now, if let's say there is a problem and they start to receive, let's say they are receiving the market data. Okay, so they start to receive it at a delay of maybe 0.1, 0.2, 0.3 seconds. That's a big failure for the company. Okay, even such a small disruption, small delay can lead to losses in millions of dollars for the company over prolonged period, maybe over few hours only. Okay, because they're into active trading. If they are getting quotes on a delayed basis, other companies are there who are watching, they are just like to catch a prey. Okay, so they will get the best prices and the bank will end up getting not the best prices, suboptimal prices, thereby reducing the profitability. Okay, next, execution, delivery, and process management. So how the things are being executed if there is a mistake, if during the delivery some mistake is done. Let's say some services, some product has to be delivered, for example, and let's say it gets lost. So let's say I applied for a credit card and the credit card was sent through courier and the credit card is lost. So that's a cost for the company. cost for the bank, right? They'll have to, because these costs are paid by the bank, right? To issue the credit card, then there are processing costs, things like that. Okay, everything has to be considered. So these are the things that has to be managed. Process management, everything has to be efficient. And all these things give rise to operational risk. Now, some of these factors are easy to quantify. For example, internal fraud, external fraud, and damage to physical assets. But majority of them, like employment practices, workplace safety, client product business practices, business disruption, system failures, execution, delivery, and process management, these are not easy to quantify. And that's why overall quantification of operational risk becomes very difficult, which ultimately leads to difficulty in estimating the risk capital. Okay. Now, what are the risks that come under the purview? Large risks that come under the purview of operational risk. First is cyber risk. Cyber risk because of cyber crimes. So what are the cyber crimes? Example, it is given here, like the theft of money, intellectual property, personal and financial information. Okay, I'll give you an example of Yahoo Finance. It happened, Yahoo, I would say. A few years ago, there was a data breach in Yahoo. Crores of personal data was stolen. Okay, it was not the fault of the company, Yahoo. There were some miscreants who did this, but ultimately who suffered? The company suffered, right? What they can do, other things that they can do is they can destroy the data, they can embezzle the data, they can do a fraud. For example, there was some kind of fraud for Bangladesh. Swift, there was some glitch in the Swift payment system. So hackers, what they did, they were about to do a huge transaction, like in billions of dollars, from the Reserve Bank of Bangladesh to some other country. Okay, so it was detected on time just because of the sheer size of the transaction. Bangladesh economy was relatively small at that point of time, and such a huge transaction being done through RBI, Reserve Bank of Bangladesh, it immediately came under suspicion, and it was caught that, okay, no, it's not something that was done, it was a fraud, it was prevented. Okay, so these kind of things can happen, and it can have serious consequences. Just imagine if, let's say, such huge amount, maybe let's say $2-3 billion was transferred through in the name of Reserve Bank of Bangladesh. So how it would have impacted its economy? It would have crashed completely, the Bangladesh economy. Okay. Now, again, we have cyber threats. Who are the causes of these crimes? So these are the individual hackers. Maybe it can be nation states. State-sponsored hacking also happens. Organized crimes. Insiders also sometimes do this. Okay, they have a lot of information, so they can bypass the system. They feel like, okay, so they do it. Or maybe they only get involved in breaching the data. Then there has to be a defense plan. So once we know that, okay, there are cyber crimes, there are people who do these are the people who do these crimes. So we need to put in place defense plan to avoid them. First, account controls, cryptography, intruder detection, softwares, firewalls, encryption. Okay, cryptography and encryption, actually. You see 256-bit encryption, which says that it will take billions of years even to computers to crack that code. Okay, then you have blockchain. All these things are development, defense plan against the cyber threats. Okay. Now, sometimes what happens, no matter how good your controls are, the hackers are in search of loopholes. Wherever they find the loopholes, they will enter into your system and they will do what they want to do. Okay, they will cause the damage. So once the damage is done, irrespective of your defense plan, you should also have a damage control plan. So if, let's say, you find an intrusion, how swiftly you can block that intrusion, you can prevent extra damage. This is what we call damage control. So these are the structures that they should have in place. It's not only about preparing defense plan, it's also about going beyond defense plan. What if even after everything, there is a breach? Okay, there is a cyber threat. Okay, there is something that happens with me. So I need to have a proper damage control strategy in place. Okay. Next, compliance risk. Compliance is basically the risk that would lead to fines on the organizations, big financial institutions, just because they failed to adhere to the rules and regulations, or you can say the policies or best practices prevalent in that country. And this can be either knowingly or unknowingly. Maybe they are not aware of it, they did it, but they didn't know that, okay, we are breaking any kind of law. It happens quite a lot of times. And that's why each company, each big bank has, in fact, all the banks have their own compliance desk. Okay, compliance department, whose only job is to ensure that the company is in compliance for all the transactions that the company is doing. Okay, because nobody knows where the loophole is, and all of a sudden the government will come on to you, cracking down, and you'll be fined. And again, that's a loss of reputation, right? Next, again, there are certain activities like money laundering, terror financing, assisting clients with tax evasion, etc., which also fall into the category, this compliance risk category, and they can lead to severe penalties. Okay, there is no limit to the penalty that can happen. So people, these banks do take into consideration compliance seriously. For example, in order to avoid money laundering, terror financing, things like that, they have proper KYC in place, know your consumer. Okay, you have to tell you everything about what you are, what you do, what is this, what is that, everything. All the papers and documents have to be submitted. It will be verified, so that they can ensure at least at their office level that, okay, this person with whom I am now going to do transactions is a genuine man. He is not, as to their knowledge, that person or she is not into money laundering or terror financing in any way. However, again, there are always possibilities of breaches, so it's an ongoing process, compliance. Okay, and also they need to have a system in place that ensure that the application rules and regulations are being followed. And in this regard, technology is of great help. You can take help with the technology. You can train AI in such a way that AI system is aware of all the compliances and all. So every time a transaction happens, he's looking for the red flags that can lead to some issues for the bank. Okay, so this is something that can be done, and at the same time, it's cost effective. It's only the cost of implementation. After that, it's just monitoring and improvement. Okay, implementation takes a lot of time, and once this is done, it can help you reduce a lot of cost in the form of salaries that you have been paying. Because to verify a transaction, so many transactions, you would require a lot of I would say um, a lot of employees. Okay, next is rogue trader risk. Rogue trader means, let's say there is each bank has their own trading desk. Okay, and Barings bank, Nick Lesson is, and then Jerome Kerwell for Societe Generale. Okay, all these are classic examples, notable examples. In fact, Nick Lesson is a part of case study in FRM module, also Foundations of Risk Management module. So rogue trader means the trader violates the company's internal policies regarding the trade limits and all. It goes beyond that. He or she goes beyond that and do certain trades, and which leads to losses. Okay, now the thing is here, unauthorized actions, which you can call. Okay, the thing is, the best way to ensure that these things not happen is to keep off front desk and back office, which we call trading and record keeping and verification. Okay, should be separate, completely separate. Okay, in the case of Nick Lesson, I can tell you that Nick Lesson was basically the head of front office as well as the back office in the Singapore division. So it was very easy to manipulate the things accordingly. Okay, another problem with rogue trader is that, let's say for the first time something comes into the picture. Let's say because of that rogue trading activity, unauthorized action, instead of loss, the bank gains a lot of money. So how the bank treat that gain and how the bank treat that employee is really important. Because at the end of the day, it was unauthorized activity. It could have led to losses. Here, it led to gain. Okay, but it could have led to losses. And if the losses would have been there, for example, in the case of Barings Bank, it led to the bankruptcy of the Barings Bank, right? So how to protect against that? So how do banks react to that? Even in that case, even if there are profits, since the profits were because of unauthorized actions, there should be immediate action against the trader also. Okay, who did it? Otherwise, it will boost their confidence and they will do it again. And yeah, you know the rest of the story. Okay, then we'll understand the Basel II regulations. In 1999, Basel II was formed, which formally included the ways to determine operational risk capital. So you see, for market risk and credit risk, we are talking about since 1970s, 80s. In fact, beyond that also, banks were doing it internally. Okay, but it was the first time in Basel II that operational risk was talked about in a proper way. So it's relatively new. Okay, and even if they understood, they recognized that it could not be quantified precisely. But Basel committee still considered that banks need to devote some resources towards managing their operational risk. And they provided certain models. First one was the basic indicator approach, then the standardized approach, and then finally they gave the advanced measurement approach. Okay, now in basic indicator and standardized approach, what they did, they said that in basic indicator, what they say, that you have to take the gross income over the last 3 years. Okay, and certain percentage of that gross income should be kept as capital. The percentage is defined. I think I don't remember it exactly. I think it's 18% or 10%. But in the book or in the study material, if you like, you will be revising the chapter, right? So when you read the chapter, you will find the formula there. Then a standardized approach, what they did, it's basically an extension of basic indicator where they said that, okay, for every department, you should have different criteria. Okay, for calculating the operational risk capital. So for some departments are more risky, where operational risk is more of a concern. Other departments are there where operational risk is a little less concerned. So it's like for the risky departments, the operational risk should be let's say 20% of the gross profit from that department. And for departments which are less risky, it should be, let's say, 12% of the gross profit for that department. Okay, that's how they said. And then all the profits should be all the calculations should be aggregated. That will be the net operating risk capital for the bank. Okay, then finally they gave advanced measurement approach, which now has been abandoned. However, banks are still using it extensively. Let me tell you, internal models. Okay, AMA. So let's talk about AMA. In AMA, the calculation is very similar to what we did for the credit risk in the last chapter. Here, you have the expected loss, you have the high percentile value of the distribution, and then you take the difference, that becomes your operational risk capital. Now, the only challenge here is to build the loss distribution. Okay, for credit losses, we have historical data to take into consideration. But for operational loss, it's not that easy. And that's what we are going to study next, and we'll see how this is done. So in order to build the loss distribution, we consider two factors. First is the loss frequency, and second is the loss severity. So loss frequency basically measures that on an average, how many loss events will occur over the given time period. Let's say I take the time period to be 1 year. So I'm saying how many, on an average, how many losses will happen or how many loss events will happen. I'm not talking about the amount of loss, how much money I will lose. I'm saying that how many times I will lose money. No matter what amount, how many times I can lose money. Okay, so that's what is measured in the form of loss frequency. And loss frequency is measured using Poisson distribution, is modeled using Poisson distribution. Okay, we know that we have a Poisson distribution, and this is the CDF formula for Poisson distribution. Sorry, PDF formula. Okay, so lambda is basically average number of losses in each period. If let's say I am able to identify that over the last 20 years, over the last 4 years, the bank has seen 20 operational losses, then average number of losses per year, or in the words lambda, will be equal to 5. And now if let's say I want to find out what is the probability that there will be exactly 3 loss events. Okay, that means only 3 times in a year I'll lose the money. I want to find that probability. I can use this formula and find the probability. It will turn out to 14.4%. So there is a 14.4% chance that the bank will lose money on 3 occasions. Now, till this point, we have not talked about how much. Okay, if there are 3 losses, what is the severity of this loss? How much money did I lose? So severity is modeled using log normal distribution. Okay, how much? It's the money quantity. Now, loss in case of losing money, especially when we are talking about operational distribution, operational losses. So it's like either you lose money or you don't. You don't make any profit in operational scenario, right? Either you are losing money or you don't. That's the only thing. That means either your loss is 0 or you have a loss. Okay, now due to this reason, log normal assumption works very well. Okay, and here what is said is that mu is the mean loss size, or in other words, mean loss, actual loss amount, and sigma is the standard deviation of loss. Then under the log normal assumption, I can say that mu1, that is, you see, I'll tell you. So if I define x as loss, x, variable x as loss, okay, size of loss, that is amount, okay, loss size. So, and x is a log normal variable. So it means ln of x will be normally distributed, correct? So this is mu1 is basically the expected value of the logarithm of losses, not the losses. This is the expected value of loss, mu. And this mu1 is the expected value of logarithm of loss, mu of ln of loss. Okay. So, and in the same way, sigma 1 square is the standard deviation of logarithm of loss. Okay. And these are the formulas that are used to calculate mu1 and sigma 1. Now I know that ln of loss is normally distributed. So what is the mean of this distribution? Mu1. And what is the standard deviation or variance? Sigma 1 square. Okay. Now what happens because of this, just see the simplicity. When you model the loss distribution, you can actually employ the normal. Okay. You can calculate the loss size, not by looking at the log normal distribution, but by using this normal distribution with a mean of mu1 and sigma 1 square. Okay, W is defined as sigma by mu whole square. Okay, here we have taken the example also. Let's say the loss size is 70, average loss, and the standard deviation is 28 million. So W is basically 28 by 70 square, which is 0.17. And what is the mean of logarithm of loss? Mean of logarithm of loss is 4.17 and variance of logarithm of loss is 0.18. So I can say that logarithm of loss, ln of loss, not loss. Okay, loss is log normal. Ln of loss is normal with the mean of 4.17 and a variance of 0.148. Okay, that's the catch from here. Now, once you have these things, then we combine these two distributions to build the loss distribution. That means the severity and frequency. Actually, here it is wrong. It is written severity. It should be loss frequency and loss severity. Okay, so let's see how it is done. There are 3 steps basically. In step 1, you sample from the Poisson distribution. You randomly select a percentile. Let's say 0.23, for example. Then corresponding to that percentile, you find the number of losses. Okay, so for example, let's say 0.23, you find that probability of 3 losses is 0.2 and probability of 4 losses is 0.3. So here, of course, 0.23 lies between these two, but we'll take the greater one, that is 4 losses. Now, then what you will do, you will sample 4 times from the loss severity distribution. You will find 4 losses randomly. Okay, because from Poisson I got the number 4. I'll find 4 losses from loss severity distribution. Then I'll add them. That becomes my first loss. And I'll repeat this process n number of times. I'll keep on repeating it indefinitely. I can keep it, but let's say I repeat it 1000 times. Okay, then I'll build the probability distribution table. Okay, probability distribution for the loss. This becomes my probability distribution. Okay. Now, let's take an example. So suppose that the average loss frequency, it's the previous 2 examples only, we are combining them. Okay, let's say I sampled a random number from the Poisson to be 0.39. Okay, now this will correspond to 4 loss event. How we are able to decide it? I found 2 values: probability of 3 losses, probability of 3 or less losses, probability of 4 or less losses. Now I see that probability of 3 or less losses is 0.265. Probability of 4 or less losses is 0.44. 0.39 lies between these two numbers. The probability is greater than 3, so I can't take 3 as the number of losses. It should correspond to 0.4. It should correspond to 4 losses only. Okay. Now what I will do, I know that my logarithm of loss size had a distribution of 4.17 and 0.18. Now from here, I will sample 4 numbers, because here I had 4 loss events, right? So I will sample 4 numbers. Let's say randomly sampled 4 numbers are 3.9, 4.7, 5.3, and 1.17. Okay, then I take the exponent that will give me the loss value, because these are ln of x. So if I want to find x corresponding to these values, I'll just take exponent on the both sides. Okay, so these are the losses. Then what I do, I sum them all the 4 values. Okay, I sum all the 4 values. I get, in the first trial, I get $362.91 million. So this is my first loss trial. Then I will repeat this process. Go back to Poisson, random a sample percentile, find the corresponding number of losses, then randomly sample 4 values from the log normal distribution, convert it to from the logarithm of loss distribution, convert it to loss, add all the losses. That will be your second iteration, second trial, and then repeat this process many number of times. You will end up with a probability distribution. I'll just show you, just give me a minute. Okay, I'll just open the Excel file and I'll show you how this will look like. Okay, I have done a trial. Although in Excel it is really difficult, but still I have tried and I've done it. Okay, so and it's a hypothetical scenario, so don't consider it that the same thing will happen in practice. In practice, it can be slightly different if we are using other models. So I'll just share my screen. Yeah. Now here you see loss distribution simulation. Okay, so what I have here is the average number of losses, mean loss, standard deviation of loss. I have W, I have mean of logarithm of losses, and I have standard deviation of logarithm of losses. First, what I have done, I have sampled random numbers. Of course, here I have done it directly, but the correct way would have been to use the Poisson distribution. Okay, first I use the Poisson distribution. I sample from the Poisson distribution. Okay, so I get, like, in first trial, I find that, okay, the number of losses is 5. Then I randomly sample from the normal distribution with the mean of mu1 and standard deviation of sigma 1. Okay, and then I take their exponent. You can see also the function is log inverse random. Okay, random number is selected, and then the mean is given and the standard deviation is taken. Okay, that becomes my first loss. I did all the 5 and then I sum them all. Then I generate the second scenario and I do it. It's a 100 observation sample. Okay, I do it. I have the 100 observations, and when I plot these losses, you see this is my loss distribution. Okay, now it does not look exactly the same as what we saw in the book, okay, or in the slides. But the thing is, I have only done 100 trials here. Okay, in order to make it more precise, I need to do more trials, maybe 1000 or 1500, 2000 trials. That would give me more precise results, and my loss distribution would have resembled more like what we saw in the slides. Okay, now let's get back to the slides. So here you see the same thing has been explained. We can then, once I have the loss distribution, I can find the X percentile that is required. Okay. So next, biases. So potential bias concerns the size of the loss. So for example, let's say you want to, let's say you are a comparatively new bank and you don't have historical data to support that. Okay, what is the loss that you can have? So what people do generally, they take data from other bank, that okay, you give me the data, I'll use your data to estimate what will be my loss. Okay, but the problem here is, if the bank from which the data was purchased, let's say that bank was a high revenue bank, okay, and another one is a lower revenue bank. Here you see the revenues of two banks has been shown. One has 100 billion, other has 200 billion. Okay, both are different. And let's say the bank with $200 billion makes a loss of $15 billion. So can you say that the bank with $100 billion revenue will make a $7.5 billion loss? Actually, it's incorrect to say that. Okay, and it is because of the bias. You see, we are saying that okay, 200 then 15, so its revenue is half, so operational loss should be half. Okay, but other factors need to be considered. 200 billion more revenue means they are operating in more areas. Okay, they have more employees to handle. They are more concerned about their reputation. So for them, the risk is also very high. So a lot of things come into the picture. So even the losses or fines, whatever happens, they are comparatively large, disproportionately large when compared to smaller companies. Okay, so that's why saying that $7.5 billion will be my loss is not correct. Okay, so how do we estimate the loss for bank X in this case? So for that, we have a formula, and the formula says actual loss of bank Y times the bank X revenue divided by bank Y revenue raised to the power of beta. Now this beta is a factor that is taken into consideration, and usually it is derived by trial and error only. Okay, now suppose in the previous case, if I find that the beta is 0.23, so in that case, the estimated loss for bank A based on the results of bank B, or bank X based on the results of bank Y, will be 12.796 billion. Okay, that's the expected loss, not $7.5 billion. Rather, it is $12.796 billion. Now, how to reduce operational risk? So for that, risk control and self-assessment structure is defined for the financial institutions, which they can advocate within their organizations to reduce the operational risk. At the same time, you see parallelly two things are happening. First, they are planning that if the loss happens, how will I cover it? And second, how can I avoid the losses in the first place? Both things have to go parallelly. Okay, because operational losses are something that can be actually reduced by the conduct of the company. Okay, so what are the risk control and self-assessment approaches? First, take interviews continuously, what they are thinking, risk questionnaires for the line managers and the staff. Continuously take their interviews, how they are doing it, do they have the sufficient knowledge about certain kind of risk, what they are doing, how they are doing, these kind of things. Then risk incident history. Okay, they need to understand that within a specific line, what was the risk event that has happened, what the managers or the staff did to avoid that risk, if it was avoided, for example, if it had happened, then how did they do the damage control? These are the things that can be done. Okay, then third party reports can be used, like what other peoples are saying, that what can be done to reduce operational risk within an organization. Okay, reports of experiences, like within the organization, or let's say outside the organization also, there are people who were in the industry. they share their experiences about certain big events. Okay, so that may be because of operational risk or something. So reading those reports also give us insights that, okay, these are the things also that can give rise to operational risk, and these are the ways that they use to reduce their operational risk. So let's try this out also. Let's put this on the table for discussion. Okay, I'm not saying try this out because it's not trial and error. It has to be very precise. So let's put this also on the table for discussion. Okay, this way also. Then suggestion boxes and intranet reporting portals, like you should have suggestion boxes, like if something is not happening in a good way, so you can give suggestion. Okay, like it should be done this way, it should be done in that way. Okay, so these are the things that are done. Then whistleblowing process. If let's say there is a line department in which something wrong is happening and a lot of people are involved, one person whistle blows. Okay, so there will be a proper structure for it, because the moment whistle is blown, okay, first and foremost, he will become the enemy number one for his department. Okay, then let's say they were indulging in fraud with some external parties. That person will come under the threat from those external parties also. Okay, so there has to be a proper process that the identity of the person who has disclosed this news is not made public, is not known to all. Okay, then second, it needs to be ensured that proper corrective prompt actions are taken on an immediate basis, and at the same time safeguarding the interest of whistleblower is also important. However, these things are not taken politely in the companies. Usually if the whistle is blown, they are most often fired. Okay, next, brainstorming. Like once you have all the ideas, then you need to sit down with the team, with the people who are competent enough, and then discuss what to do. Okay, this is what we call when we say brainstorming. Okay, so that's the end of this lecture. Now we are moving towards the final chapter, that is stress testing. So just give me a minute. I'll share the slide for the stress testing as well. Yes, Tajana, after stress testing, the session will conclude today, and then we'll continue tomorrow with the rest. That is VRM 9 to VRM 13. Okay. Yeah. So that's the last chapter, and it will not take more time. I think maximum half an hour will be more than sufficient to cover this chapter. Okay. So let's start our discussion on the final chapter of today's agenda, that is stress testing. Okay. Now in this chapter, we'll talk about what a stress testing is, what are the measures, policies, and procedures, the government regulations, the company practices, all these things. Okay. And this is mostly a theory chapter. And let me tell you, in the examination, they do test it. Okay. You can expect quite a few questions from this chapter, stress testing. And first, before diving into the chapter, I'll talk about stress testing first. Okay. So the thing is, when uh, the background actually, why this came into existence. Okay. So the thing is, when the crisis happened, the global financial crisis, that GFC 2007 and 9 crisis. So at that point of time, as I said, that there were a lot of banks who were in severe crisis, who went bankrupt also, but they were fulfilling all the regulatory requirements to say solvent. Okay, they were like the government, the regulators said, okay, you should have this much capital as risk capital for this department, this and that. These ratios should be fulfilled. Everything was going was set, but still they went bankrupt. So the issue they realized, first issue was that VAR is not sufficient enough, of course, because VAR only tells us the threshold. But what happens after that threshold? What happens after the VAR is broken? VAR is breached. Nobody can tell that. Okay, that was the first thing. So they moved towards the expected shortfall. Another issue was that if the banks are operating currently, are their structures, are their policies, governance, everything strong enough to survive a stressed period, to survive a crisis? Okay, so how do we check it? These crises don't happen regularly. They are once in a while scenarios. Okay, so they don't happen at regular intervals so that we can test it. And in fact, testing it in reality is more painful, right? The banks will lose actual money, the company, the economy will bleed. Okay, so these are the things. There are costs. So it was decided that we now require the banks to do stress tests. Okay, it's kind of test, not actual thing. It's a test. We will send you a few things. Some are through the regulators. Okay, in fact, most are through regulators. It will send you certain data that will reflect a market scenario for a prolonged period, maybe for a short period also, for a prolonged period also. It depends. And you will have to show me, you'll have to prepare a complete report and show me how you are going to cope up with this. Okay, how you will survive this scenario. If let's say the report is prepared and the report, when the regulator reviews the report and finds that okay, something is not good here, they may ask the bank to improve their internal controls, improve their capital requirements and all. They can make certain restrictions on them. Okay, because now it is pretty clear that on paper they are not able to do good. How the hell they are going to do it in the real life scenarios? Okay, so that's not possible. So they may put restrictions. They may have a, or you can say it's like a preemptive strike. Stress testing is like a preemptive strike on the crisis, not on the banks. Okay, although it's painful for the banks, but it's not for the bank. It's in fact, it's for the good of the bank, because if corrective measures are taken today itself, so during the time of crisis they are well prepared. Okay, so it's not for the bank. It's a preemptive strike on the crisis. So when the crisis comes, banks will survive. And a testimony of that is again the COVID crisis. Of course, things happen, and some US banking system was under crisis for a period of time over the last year. But if you see overall the severity of crisis that we had during the 2007-9 crisis and the severity that we had during the COVID crisis, it's not so much widespread. Okay, if I talk about the Indian financial system, it remained strong during the crisis, after the crisis, and even today. Okay, now the crisis is completely gone. Nobody's talking about COVID. It's out of the picture. It's the thing of the past. Okay, so it was strong enough. It is strong enough today itself. The only reason is that the banks, the regulators in India have done a great job in implementing these Basel norms. Okay, in fact, Basel 3 is completely implemented in India, if you're not aware. Okay, in the banking system, Indian banking system. Okay, so let's start with our discussion. First, since we know what is the reason for stress testing. So stress testing answers key question for a financial institution. First and foremost important, whether it has enough capital and liquid assets to survive various scenarios. Okay, that's the only thing. Do I have the capital to survive serious scenarios or various scenarios? Okay, so stress testing, what are the components? First, its importance increased after the 2007 and 8 crisis. Okay, it evaluates extreme scenario that are unlikely but plausible. Okay, extreme events like GFC was an extreme event. It was unlikely, but it is plausible in the future that it can happen. Same thing can happen. Okay, so it just on paper, okay, this is the scenario. Now do what? Now tell me what you are going to do. Okay, so it evaluates that. Second, it is used in conjunction with VAR and ES analysis to understand the risks better. Okay, then scenarios are very different from those for VAR and ES, because VAR and ES are built on current historical data. Okay, so it's more like current scenario, but here the scenarios are extreme. Okay, so for example, unemployment rate goes to as high as 35%. GDP decline is like 4% per annum. Okay, inflation rate is at 18%. The macro factors I'm talking about, not all of the other factors are also there. Let's say government increases the yield on their bond by 200 basis points. Okay, in a very short period of time. Now, how you're going to react to these things? Okay, how you will adapt accordingly? How will you manage your resources? How will you manage if there are risks posed? Of course, there will be risks, right? So scenarios are very different. There are two types of risk stress testing. First is regulatory. Second is internal. Regulatory means it is mandatory. The central bank of that region will ask you that, okay, you have to do this. These are the scenarios. Now give me the report. What you will do? I'll give you, so let's say 1 month, 2 month, 3 month time. Prepare a report. Give me what you're going to do. And it also tells now that at the time of crisis, let's say if you're not prepared for it. So during the time of crisis, you will start thinking then, okay, what all the other alternatives do we have? But if you have done stress testing, you already know that, okay, I could use this, I could use that, I can do this, I can do that. There are multiple tools already, you are aware of it. So you're not wasting a lot of time in brainstorming as to what to do. Okay, and time is precious. You need to react quick and react swift. Okay. Then you have internal stress testings. Big banks also do internally stress testing just to check their uh, efficiencies internally. And generally, internal stress testings are way too extreme, even extreme than regulatory. Okay, they assume that worst will happen with us. Okay, and then we have to see what we can do. Finally, helps in estimating stressed VAR and ES measures. So stressed VAR or ES measure means you are creating what you are trying to estimate what should be your value at risk and expected shortfall during a stressed period. Okay, so you generate stressed scenarios, or maybe you take from history, you select that period which was stressed and use that historical data to calculate the VAR today. Okay, that is what we call a stressed VAR or ES. If you are using historical data, if it is let's say non-parametric, let's say if you want to simulate scenarios like Monte Carlo simulation or something like that, then you just take this extreme assumptions. Okay. Now, what are the scenarios? So there are two things: a stress test scenario, and then there is time horizon. So what is the scenario, and what if, for how long I am going to keep this scenario? What is the time horizon? Over what period this crisis will unfold? Okay, is it only for a few days? Is it for extended period like months, or is it like in years? Okay. So short horizon can be 1 day or something. Long horizon can be 3 months or 1 year, anything. Okay. Short horizon actually helps in estimating stressed VAR and ES. Okay, because in short horizon, we are mostly worried about 1 day or 1 week. So VAR and ES are sufficient enough. And then it usually picks 5 big movements from many different stressed periods. Okay, 5 big movements, like what happened to this factor, what happened to that factor, and this, let's say, CDS spread. Um, 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 what was it? Haircut. What was happening to the haircuts? What is OIS spread? And then maybe a lot of things can be there, like the housing prices or something like that. Okay, few important factors are considered, and then they are used to find out what should be my VAR and ES in that case. Okay, in case of long horizon, there are two types of scenario: historical, which assumes all variables behave as they did in the past. For example, the COVID crisis, yes, or you can say the great financial crisis, or you can go even beyond that. Then you have modified scenarios, where you assume a past adverse scenario and it is made more extreme. Okay, so you assume COVID scenario and you make it more extreme. So all the parameters, GDP decline was, let's say hypothetically 7% for an economy. Okay, you make it 14%. Okay, unemployment rate was 12%. You make it 24%. Okay, you take a scenario and make it more extreme. That's what modified scenario means, and it is done for a longer time period, and then you see how you're going to survive. Okay, then risk factors are multiplied by a certain amount, as I said, and assumes a linear relationship. That's what I said. No? 6, 12, 12, 14. That's the thing that is doing linear relationship. Then ad hoc tests, like history never repeats itself exactly. Okay, and managerial judgment is necessary either to generate new scenarios or modified existing ones based on past data. So that's why we have ad hoc tests. Okay, where what we do, we select scenario. Okay, like scenarios should reflect the current economic conditions, what is happening. Scenarios should reflect the firm specific exposures, and scenarios should also reflect future adverse events. Okay, they may take reference from history, that okay, something like this has happened. If something similar to, like for example, GFC, an event similar to GFC is nearly impossible, at least for the next 50 years, I think. Okay, the conditions that led to GFC. Okay, I'm not saying that crisis such huge is not possible, but the conditions that led to that specific crisis is because things improve, right? So you have to take that into consideration, that in the past, if this was happening, then these things were wrong. Okay, so I need to take into consideration the past events, but again, I have to make it more reliable by incorporating current conditions also, like currently what is being done. Okay, then changes in government policy. There have been shift, like before COVID, before that GFC, there were government policies were very relaxed. I talk about the US and UK markets. Okay, US and European markets. Now it's a little bit more stringent. Still, it is relaxed, but not too much. It's more stringent. Okay, then you have to take into consideration the changes in Basel regulations also, like how the Basel norms have changed over the years. Scenarios suggested by professional economists. You see, there are economists, there are people, these are good at it. Okay, they devote their whole life towards these things. Okay, so if they are suggesting certain scenarios, they can all these scenarios can also be taken into consideration, that what if certain, like something like this happens, then what the bank can do. Okay, finally, brainstorming sessions of senior management, board, and economists. It is really important to decide the ad hoc test scenarios. Okay, you have multiple ideas. You sit together, all the people who are aware, who are knowledgeable enough, and then you brainstorm. Okay, that what to do, how the scenarios can be created, and what can be made, what can be done to make it more worse, because this is done by the senior management and they don't actively take part in the management of the risk. Okay, they just create the scenario, then send it, that okay, this is the risk, tell each the departments what you guys are going to do. Okay, and once they tell this, then the actions need to be taken, then everything has to be formalized, channelized, and things like that happen. Okay, now, regulatory stress testing. Okay, so regulators in US, UK, EU, they require banks, even insurance companies, to carry out certain stress tests, which is mandatory. They cannot avoid it. In US also, for example, the Federal Reserve carried out stress tests for all the banks which have an asset, consolidated asset. Okay, worth $50 billion or more. Okay, they have to do a mandatory risk review. Okay, stress testing in other words, which is called Comprehensive Capital Analysis and Review, CCAR. It's basically a mandatory stress testing. Here what they do, they send scenarios to the banks. Okay, regulators create the scenario. Banks are not aware of it. Regulators create the scenario and send it to the bank. Report in a report. Okay, so these are the scenarios that is happening. Now tell me what you guys are going to do. There are 4 types of scenarios that are created. First is the baseline, then you have adverse, severely adverse, and then internal. Okay, now one might say internal means, okay, is it the internal stress testing? No. In internal scenario, what regulators do, they simply say the bank that, okay, create your own scenario, show me how you'll deal with it, I'll assess both of them. Okay, that's what happens in internal scenario. Okay, now adverse and severely adverse are hypothetical set of events. If I talk about adverse and severely adverse, they are hypothetical. It's you see, central banks have a lot of resources at their disposal, so they can, and they have a pool of knowledgeable people who can actually think certain set of hypothetical events, and that can then be sent to the banks in order to assess how they're going to perform in it. Okay, then it assesses the strength and resilience, how strong the bank is and how resilient the bank is. Will it survive it or not? Okay, then you have the baseline. Baseline is average projection from economic service. Like economic, they look the economic service and what is the baseline projection? Like this thing can happen, this thing will be bad, this thing will be good, what you will do. Okay, that's the baseline scenario. Okay, and then each scenario, actually, no matter whether it is either of the 4, each scenario should include 28 variables. Okay, we are talking about CCAR. Okay, it's only about CCAR. It's the Federal Reserve, the US. In the US this happens. Okay, not in India or any other country. So they include 28 variables, and these variables include both domestic as well as international factors. Okay, some geopolitical factors are there, exchange rate factors, a lot of things are taken into consideration. And then it helps actually the regulators to evaluate the ability of banks to survive adverse conditions consistently, because they are doing it on a regular basis. Okay, so it helps them to understand that whether the banks are able to do it on a consistent basis or not. Okay, now banks are required to submit a capital plan, document to justify the models they use, and the results of their stress tests. Okay, everything based on the scenarios that was sent to them. That what will be their capital plan, what are the documents, the theory behind the models they are using to simulate all the losses and all these things. They have to justify it. Okay, the documentation has to be given. And what are the result of stress test, whether you will survive or you will not survive. Okay, now when banks, for those who have consolidated assets between $10 billion and $15 billion, are actually add to DFAST, that is Dodd-Frank Act stress test. Okay, now the scenarios of DFAST is similar to CAGR. However, in this case, banks are not required to submit a capital plan. Okay, other things are required, the results of stress test and documents to justify the models they're using, but capital plan is not mandatory for them. Okay, this is for the banks with capitalization, or you can say assets worth $10 billion to $50 billion. If it is more than $50 billion, you have CCAR. If it is between 10 and 50, you have DFAST. Okay, and below 10, nothing. You're not required. Okay. Now, when you're building models, you have to take 2 things: stressed key variables, like you have certain variables that you have stressed them. Okay, you have increased the severity, and some ad hoc scenarios that you have decided based on brainstorming and all. Okay, and then you define few risk factors that will be the core factors, which are the major factors that will have severe impact. Okay, based on these 2, ad hoc scenario and the stressed variables, you will find the few factors that are actually contributing, that are actually posing the highest risk to the organization. Okay, then other risk factors are also there, which are peripherals. Okay, they give rise to knock-ons and everything. Now, when you combine other risk factors with the core variables, you build a model to relate core variables with the peripherals. So core variables will affect peripheral variables also. So you build a model and you try to understand that how they are interacting with one another. Okay, if core variables are changing in this fashion, how the peripheral variables are behaving and things like that. Then you build a full scenario that, okay, this is the scenario. on which I have to test that will my company survive or not. Okay. And then you test it, you assess the firm's performance due to the scenario. That's the end of the story. Okay, that's the model building. So what you have done, I'll just tell you, you took stressed variables and ad hoc scenarios. You combined them, defined core factors. Okay. And then also you defined the peripheral factors. Then you combine these two factors to build a model to understand how they are interplaying among themselves. Using this, you build a full scenario, and on that scenario, you test if the company will survive or not. Okay, that means you test the firm's performance. That's the whole model building process. Next is reverse stress testing. In reverse stress testing, what happens? It tries to find out that, okay, the company has failed. Now you are, you can say, reverse engineering you're trying to do. So you have rubbish in front of you. Now you want to know how this rubbish happened. Okay, so you are backtracking that, okay, this failed. Okay, this triggered the failure. So why this was triggered? Okay, this happened. Why this happened? Okay, this was the factor. Okay, this was also there. Okay, these two. Now, so that way you go back, and then you build a complete scenario that, okay, if in the market this and this variable behave in such and so fashion, then only my bank will fail, and or else it will survive. Okay, so you understand that what all factors can lead to the failure of the bank. So again, you are getting prepared by reverse stress testing, that if in the future you feel like, okay, certain things are happening which shows that it can lead to the failure, you can take immediate actions. You have done it in the past, you have practiced this, now it's happening in reality. You had a plan, you can use that plan now. Okay, so what are the reverse stress testing approaches? First, using adverse historical scenarios, and second, define few key variables and use models for full scenario construction. So only few key variables are defined and full scenario is constructed. Okay, here past scenarios are assessed, and it is determined that how worse each scenario should be to lead a collapse of the firm. So let's say you pick up GFC, okay, and you see that what was the value of the variables, or how much stressed the different risk factors were. And then you try to just find out how stressed these factors should have to be today in order to make my bank collapse. Okay, that's the reverse stress testing. Second is scenario leading to a failure is searched iteratively over all factor conditions. So you just take variables, you start building scenario, and you test your performance in each of the scenario, and you find those which are leading you to failure. If you are failing, you're picking up that and then assessing it properly, that what all happened that led to my failure. Okay, on paper, of course. So all these things are done. That's reverse stress testing. Okay, now reverse stress testing is actually an input to the work of a stress testing committee. Okay, the committee is likely to discard some of the scenarios, of course, because they feel like, okay, it's completely unreasonable. So let's say they say that the US economy, the US economy declines by 40%. So that's completely unrealistic. So they will discard some and they will keep some. Okay, and for some they will use it for further investigation. Okay, let's see why we collapsed here. Okay, this factor was this. Okay, this led to this. Okay, this led to that. So these are the things that are done. Okay, now let's understand what is the difference between stress testing and VAR and ES. Okay, so you see, ES actually solves the problem of extreme loss if the VAR is breached. One problem is solved, but still we want to know how the banks will function during the time of crisis. Okay, so I have already explained it at the start of the chapter. You see, there were two problems during the time of crisis, and stress testing and ES actually try to solve these problems only. Okay, so first is I need to know average loss beyond the VAR level, and I need to know if something goes bad in the economy, how will the company survive? Do I have a plan? For GFC, nobody had a plan. Okay, here, do I have a plan? So I need to have a plan. That's the idea. I need to have a plan, and for that stress testing is important. So your comparison has been done. So stress testing is forward looking and answers what if questions. What if this happens? What if that happens? VAR and ES, these are backward looking. Assume future to be the same as past. That means future repeats itself. That's kind of scenario. Okay. Then stress testing looks at limited scenarios that are mostly bad. Okay, in a stress testing, we are talking about bad scenarios. What worse can happen? Bring it up. We'll look what is happening, what we can do. Okay. In VAR and ES, we look at wide range of historical data. Both it can be good as well as bad. Okay, no matter what has happened over the last 500 days, I'll take that into consideration. Okay. Time horizon is much longer, usually 1 year, 3 months, 6 months, things like that. For VAR and ES, time horizon is relatively small. 1 day at max, we calculate VAR and ES for 10-day period. Okay. Next, macroeconomic variables that impact all the firms, all parts of the firm. So variables that are actually considered are the macroeconomic variables that affects all parts of the firm, even the economy overall. Here, variables are specific to portfolios, not the whole firm. So for example, let's say you are you're finding the VAR for a specific loan portfolio. Okay. Or a specific portfolio. Let's say you have 4 or 5 portfolios, which is into different things. Like one is a large cap, one is mid cap, one is a small cap portfolio. Okay. Now you are doing it. So you will only see variables which are specific to those portfolios, not your firm. Okay. But in case of a stress testing, things that are important for your firm also is considered. Okay. So that was the difference. And now finally we have the stressed VAR and a stressed ES. So in a stressed VAR and a stressed ES, we gather data from the stressful periods. I have told it already. Okay, that you select the historical data of your risk factors from a stressed period, like 2007 to 2009. Okay, and using that data, you find the VAR and ES. That is what we call stressed VAR, because here the historical data is from a period of stress. Okay. Now, if you compare it stress testing with stressed VAR and ES, again there is a difference. Stress testing, long horizon, even it is a stressed VAR or stressed ES. Okay, it is for short horizon. Okay, maybe 40 days, like for 5 days, 10 days, 15 days, that much. But a stress testing, it can extend up to years, maybe 1 year, 2 year, 3 year also. Okay, over prolonged periods. Now, traditional VAR measures are designed such that they can be back tested. However, it is not possible to backtest stressed VAR or the output from stress testing. Okay, so as I said in the next part, that is FRM part 2. Okay, when you will prepare for that market risk module, you will see that backtesting VAR is possible. Okay, and it's possible only for traditional VAR. That means the normal VAR and ES that we are calculating. But when we have stressed VAR or a stressed ES, or let's say we have some results from the stress testing, there is no way to backtest them. Okay, we cannot backtest such such parameters. Okay, parameters coming out of stressed periods or stress testing. Okay, now stressed risk metrics. Okay, so what are the advantages of a stressed risk metrics like that we discussed? Stressed VAR and stressed ES. These are the stressed risk metrics. What are their advantages? First, they are more conservative. That means they are only focusing on risk periods, on risky periods, on the crisis periods. Then they are forward looking. Okay, focus on longer periods of time, like for example a stress testing. If I say, okay, they are forward looking in nature. They are talking about what can happen in the future. They talk about longer periods, like if the crisis extends over 1 year or so. Okay, what are the disadvantages? First and foremost, poor response to current market conditions. They have nothing to do with what is happening right now. Okay, it's a hypothetical scenario. They are just doing things in the bubble. That's the kind of thing, again, a disadvantage. Then no loss probability distribution. Here you can't build a probability distribution that what will happen. Can I estimate the probabilities of different events? That's not possible. Okay, the scenarios have been given, just need to work around your way. Third, do not allow for effective backtesting. You cannot backtest it. Okay, you cannot test it like over 1 year ago or something like that. That's not possible in the case of stressed risk measures, like be it expected shortfall or be it anything else. Okay, so I think that's all for this lecture. And with this, we have concluded the session. I hope you guys enjoyed the session a lot. And I was really impressed to see the strength right from the beginning to the end. Almost all the candidates stayed in the meeting. So it's really good to see that. And I hope you guys have enjoyed it. So now I think you guys are really tired. The session went very long. So I'll not bother you much.
This video will be uploaded in the system?
Yeah, it will be.
And last class video is not session 2 FRP is not uploaded. Can you please upload it? FMP.
Okay, so
session 2, FMP session 2 was not uploaded, it's not works. If you have a kind look, then it'd be helpful for us. Thank you, sir.
Okay, okay. So I'll tell the team. In the meantime, if it's possible for you, you also message us on Telegram directly. They will look.
Okay, sir. Okay, sir. Thank you for a nice lecture. It's really helpful, and I really amazed. Thank you.
Okay, okay. It's really great. That's why we are doing it. Actually, one more thing. Someone just asked for a summary, right? I declined it. Yeah. So I think that's all for today, guys. So yeah, it was really nice talking to you. Have a good day. Bye bye. Let's meet tomorrow.